of the coronavirus pandemic. The Trump administration is doubling down on accusations that the virus originated at a lab in Wuhan, China. Right now, we have got the Dow Jones Industrial Average futures down about 1%. S&P and NASDAQ futures each off about 0.75%. Emily McCormick is with us this morning for more. Hi there, Emily.
Good morning, Alexis. And yes, a tough morning for global equities and U.S. equity futures. We have each of these three major indices down and on track for a third straight session of declines. And we do have a confluence of developments contributing to this. We have been getting a steady drumbeat of weak corporate earnings results as well as weak economic data. But at the same time, this morning, we now have that rising threat of higher tensions with China adding to this. Now, President Donald Trump said in a virtual town hall with Fox News yesterday that the U.S. would produce a, quote, conclusive report showing the origins of the outbreak in China. Now, this came just hours after Secretary of State Mike Pompeo said during an earlier media appearance that the U.S. found, quote, enormous evidence showing that the COVID-19 outbreak began in a laboratory in Wuhan, China, though he did not yet elaborate with evidence to substantiate this claim. U.S. officials have been saying for weeks that China did not go far enough to stem the spread of the outbreak and wrongfully silenced doctors who warned about the disease at its onset. We had Trump saying last week that tariffs were one avenue that the U.S. could pursue as a punitive measure against China, although we haven't gotten any updates on that just yet, on when, how, or whether even the U.S. will follow through on these measures. Alexis?
All right, Emily, I'm taking a look at travel stocks today, airline stocks in particular, taking a beating. And this is after Warren Buffett said over the weekend that he has sold all of his holdings, all of them, in the U.S. airline industry. Of course, Yahoo Finance was once again the exclusive broadcaster of Buffett's Berkshire Hathaway annual shareholder meeting in Omaha, Nebraska. Emily, what else did Warren Buffett have to say about those airline holdings?
Well, the key quote here, Alexis, was that Buffett said, quote, the world has changed for the airlines after first disclosing his stake in this industry back in 2016, that he has now completely exited through Berkshire Hathaway. So we are seeing shares of Delta, United, American, and Southwest, all of those airlines that had comprised Berkshire's portfolio, getting hit hard in early trading. Southwest down about 7.6%. And then at the high end, we've Delta down about 10.28%. So really seeing a steep sell-off here in addition to the declines, the double-digit percentage declines that we've seen in these airline stocks for the year to date. Of course, when you have the Oracle of Omaha withdrawing his bet on the industry, certainly not something looking good for the industry outlook.
No, indeed. We're seeing those stocks get hit this morning. Also, we've got the weakest earnings season in more than a decade continuing to roll on Wall Street. We've got about 150 companies in the S&P 500 out with results this week alone. Among them, Tyson Foods, which came out with its earnings just a short time ago. What are the results there, Emily?
Well, some mixed results here on the top and bottom line. We saw a 4.3% gain in sales on a year-over-year basis, but we did see a decline on adjusted earnings per share and some margin pressure. And this is coming as Tyson has been contending both with factory shutdowns as well as a shift in demand towards its retail side of the business and away from some of these restaurants that usually make big purchases of these meat products. Of course, many restaurants are closed now due to social distancing measures. CEO Noel White said in a quote, during the quarter, we witnessed an unprecedented shift in demand from food service to retail, temporary plant closures, reduced team member attendance, and supply chain volatility as a result of the virus. Despite these challenges, we were able to adjust our product mix and redirect products to the appropriate channels. Although at the same time, the company did say in a later quote that the volume increases in retail were not sufficient to offset the losses in food services. And as a result, the company does expect decreases in volume for the second half of 2020. We are seeing shares down just over 6.5% right now. So Wall Street not taking this report too positively this morning. Again, we do have shares trading around $56 in the pre-market. Alexis?
Hey, Emily, did the CEO talk about the possible meat shortage and if he's experiencing that yet at his company? Because they are the nation's #1 poultry producer.
Well, we did say that Tyson is saying that because of these factory shutdowns, they are going to be having some concerns on the supply constraint aspect of the business. They did say that these factory closures are expected to continue for the foreseeable future in 2020. These really started in earnest in April. So that is definitely something that could continue to impact this business.
All right, Emily McCormick, thanks for the roundup. Let's head over to Europe now. And Oscar Williams-Groot standing by in London, because over in the UK, the government's getting ready there to announce the roadmap for exiting lockdown. Good morning, Oscar, and what can you tell us?
Morning, Alexis. Yes, we've had no official announcement as of yet, but leaked documents are starting to appear in the press. And what they set out are essentially the fact that there really is no return to normal. And when we do get out of lockdown, it will be a new normal. The guidelines for businesses include things like staggering shifts in office buildings to reduce contact, lifts at half capacity, physical screens to separate people. And office canteens being closed, no hot desking, face-to-face meetings being discouraged, really a huge wealth of changes being proposed by the government to try to limit and stop a second spike in infections. As I said, we've had no official announcement as of yet, but reports are we should get the official announcement towards the end of the week when this lockdown is reviewed. We are expecting another extension, but then Boris Johnson should set out what the exit starts to look like.
Meantime, we're getting some more information on job losses in Europe, throughout Europe, specifically for the manufacturing sector. What can you tell us there, Oscar?
Well, this comes from IHS Markit and its closely watched PMI survey. The survey of Eurozone manufacturing activity in April shows the sharpest drop in employee numbers since 2009, of course, the great financial crisis. And really across the board, it's devastating numbers: output, new orders, exports, purchasing activity, all plunging at record rates, and confidence hit its lowest level across the manufacturing sector since the IHS Markit survey began in 1997. As you'd expect, Italy was the worst hit given the incredible toll that the virus has taken on the country there. However, this wasn't unexpected. It's largely priced in, and we've seen little move in the euro so far in response to this morning's numbers.
All right, Oscar Williams-Groot live in London this morning. Thanks for that. And we have hit another grim milestone in the fight against COVID-19. More than 3.5 million people worldwide have been confirmed to have the virus. The U.S. makes up about a third of that number, with over 1.16 million. The numbers are climbing, but Florida is starting to reopen parts of its economy today. Some stores and restaurants are now partially open, but schools, gyms, and bars remain closed. Meantime, Secretary of State Mike Pompeo is backing up White House claims that the coronavirus was manufactured in a Wuhan lab. He said this weekend, quote, "A significant amount of evidence exists." He would not elaborate on just what that evidence is. All right, joining us now to discuss more about the coronavirus pandemic is Yahoo Finance medical contributor and Columbia University Associate Professor of Emergency Medicine, Dr. Derek Cass. Doctor, thanks again for being with us. Good to see you. You know, the U.S. has succeeded in flattening the curve, but we're seeing here the number of new cases each day, the number of new deaths have not fallen much, especially in contrast to what you're seeing in Asia and in Europe. Why do you think that is?
So I think that the real answer for that is consistency. We don't have a consistent approach to testing and tracing. We don't have a consistent to open our environments, even if we decided in two different communities to open up different businesses. Let's say one community wanted to open up maybe a small coffee shop or other kind of low traffic areas, and maybe somebody else chose a manufacturing plant. It's the same metrics that we would want them to have. How many tests do you have? How's your ICU capacity? How many patients have you seen in the past 48 or 14 days that have had the virus? And it's the inconsistency and really the lack of kind of federal guidance that I think is why we're seeing these very different pockets of infection. And unfortunately, it will probably lead to an ebb and a flow over the country over the next few months.
Doctor, my Twitter feed was filled with photos this past weekend in New York City. Lots of people out. Didn't look like they were social distancing to me. When you see photos like this, do you think we're at risk or running the risk of a pretty big second wave infection in the later half of this year?
It's not the later half of this year, right? The stuff that we're doing now, we're going to see evidence of in 2 to 3 weeks. It's way sooner than you would expect. And yes, I live in New York City, and it was a gorgeous weekend. And we saw a lot of people getting closer than they should, not wearing masks in public. And actually, what it spells to me is we need better guidance how to live in this new normal over the summer. It's going to get increasingly less comfortable to wear a mask in public, especially if you're going to stay out by a pool or if you're going to stay in a park. And maybe it means that we need to have much better oversight of how people gather in parks and other outdoor environments. What I know is that people will gather, and that's okay because we have to resettle on this new normal. So we need to know the first question anybody out in a park should ask themselves is, where's the nearest place I can get a test in my community? If you can't answer that question right now, you probably shouldn't be going outside.
So, doctor, to follow up on that, who should be going outside? Is it just those people who have had a test? There are a few of them we know for antibodies. They say, okay, look, I've got the antibodies. So somewhere along the line, I had this virus, so I'm free to go back into society.
So I think actually everybody should be going outside for a short period of time. I think that the outdoor air is good for you and that it does remind us that we need to reframe ourselves and get some fresh air. But I think it's really about how we walk deliberately in the environment. If you have had the coronavirus and you have documented antibodies, it is true that you likely have a low risk to get it again, probably no risk, but we haven't proven it, and that you're wearing a mask really as a message to your other citizens that we're all in this together. But I have had the coronavirus, I have antibodies, and I walk outside with a mask. And so I think it's really about being in this together rather than looking for the immunity passports that are going to give us this next opportunity to engage in a very different way.
You know, I want to talk to you about some possible treatments because Gilead, has been in the news with its remdesivir treatment. They're saying that it could arrive in hospitals this week. Are you hearing the same thing?
Yeah, and I think remdesivir and its addition to the treatment options for patients that are hospitalized with coronavirus is very encouraging. But again, remember that this is a very small subset of the patients that are critically ill and hospitalized with this virus. We're looking at maybe 100,000 doses of remdesivir being available in hospitals over the month of May, and that matches less than the number of patients that are hospitalized. So we need to remember that it's one of our options, and if we can get people from the 11-day hospital stay to an 8-day hospital stay, which was the difference that they showed, that's encouraging. But it's certainly not the panacea that's going to change how we treat this virus from a public health perspective.
Dr. President Trump suggested that we may have a vaccine for the coronavirus before year end. Does that seem likely to you based on everything you're seeing?
So I think that the president suggests a lot of things that are optimistic and hopeful. And while I appreciate his optimism, I think we've never seen a virus get constructed for a vaccine for a coronavirus, and certainly not this fast in our history of creating vaccines, sorry. So I think that although we hope that a vaccine is created safely over the next few months and a year, it's certainly not what we need to lean into to figure out how to respond from a public health perspective. But I would be obviously overwhelmed and very excited at the idea of a vaccine coming out and being safe and then being able to be scaled and executed as it needs to actually get us back to any other normal than what we're seeing right now.
I'd like your perspective. Probably tough for you to answer this, Dr. Cass, but do you see schools getting back in session only when there is a vaccine? Because without it, how do kids go back to school?
So I think that that's what we need to be thinking about over the next 3 months, right? Using the summer as a series of honestly successful and failed experiments on gathering with the idea that the fall is our real goal to figure out how do we get kids back into school? How do we get our workplaces back to a new normal? I do see an environment where kids can get back into some sort of on-site learning without a vaccine, but it will be very different than what they were in even as recently as last December and January. We're looking for ways to keep kids safe and protected. The CDC came out with guidelines last week on how to gather in schools and day camps, maybe over the summer, but they're very prescriptive. They have a lot of limitations on how kids should gather. So I think we need to start thinking about those options and looking into them, because the vaccine I just don't see coming before the school year starts next year.
All right, Dr. Dara Cass, thanks as always for your insights. Appreciate it.
Thanks for having me.
All right, coming up next, we're going to deep dive into the semiconductor industry with Micron. Stay with us. Welcome back to Yahoo Finance Live. We want to take a closer look now at the chip sector, the health of the chip sector during this coronavirus pandemic. And to help us do that is Manish Bhatia. He is Micron's Executive Vice President of Global Operations. Good to have you here, Manish. Thanks for making the time for us. You're joining us from Singapore, we'll add. I know Micron was out with its results a few weeks ago, stronger than expected results for second quarter fiscal 2020. Nonetheless, though, top and bottom lines both declined on a year-over-year basis. We'd love to know what business conditions look like right now for Micron.
Yeah. So, like many others, we're dealing with the uncertain macroeconomic environment. Right now, frankly, the COVID situation has spurred strong demand growth for us in certain areas that are associated with the way we're living and coping with the COVID pandemic around the world, where all of us are working from home, we are learning from home, we are shopping from home. Video conferencing is the new norm for all of us, and so that's driving demand for our memory and storage products, whether in the cloud or in networking or in personal computing. So these areas are certainly experiencing strong strength. And then there are other areas that are more consumer driven, such as mobile phones, smartphones, and automobiles, where the demand is a little less certain right now.
Manish, how are you thinking about redesigning your supply chain at Micron? To your point, we're all working from home now. There's 5G devices on the way that will help us work from home even smarter and faster. How does this situation send you guys back to the table and think about changing to speed up your supply chain even more?
Yeah. So I think the first thing that we have to do when we look at the supply chain is to think about having more resiliency in the supply chain, right? So what we've been doing is even from the very early days of this COVID-19 outbreak back in kind of around the mid-January timeframe, is making sure that we had the ability to build our products in multiple different geographies and to be able to source our materials from our suppliers also in multiple different geographies, additional qualifications, bringing online additional suppliers, so that as the virus moved from one region to another, we were able to move and maintain full production output at all of our factories, because we could source materials from different regions, and then we were also able to keep our factories running at full output. So we think about the resiliency that we have there, and then certainly as we think about potential acceleration of some of the remote capabilities that the kind of industrial Internet of Things will bring for really all manufacturing, but certainly semiconductor industry leading in that way. We have done things like having remote operating control centers where we move the center of operations outside of our clean rooms so that all of our equipment can be monitored, all of our production movements can be sent off via remote operating control centers. And so thereby our technicians and engineers are able to control our production without having to go into the clean room. So a lot of these things are going to be spurring innovation and accelerating our path down the kind of smart manufacturing of the future track.
Manish, what has Micron's response been on a very local level in the markets where it operates, in terms of helping to supply relief to maybe local areas, local healthcare workers? What are the efforts like there?
Thanks, Alexis. I'm glad you asked. I mean, I think we've really tried to really take care of the communities in which we operate. We have designated a $35 million commitment across all the different communities where we have either manufacturing operations or development operations around the world. That consists of $10 million direct grants or matching of Micron team member contributions. It consists of donations in kind that we're making to local regions, whether it's personal protective equipment. But we made that commitment right away. We've made a commitment to small businesses throughout our supply chain, where we're going to shorten the payment terms that we have, where we would whatever our normal payment terms would be. We're going to shorten all of them just to make sure that the small businesses that supply us have liquidity right now. And then for our employees globally, we've done a number of things. We've made a commitment along with many other companies. Our CEO Sanjay Mehrotra made the commitment that the 90-day pledge, no layoff pledge. We've also made a one-time assistance payment to almost 70% of our global workforce of the equivalent of $1,000 US, and of course translated into their currencies, just to help them with any of the things that could come up during this time, to make sure can manage through this with their families, whether they're medical needs, additional care needs, whatever they may need. So we've really tried to take care at the community level, at the businesses in our local supply chains, and also, of course, our employees.
Manish, you mentioned strong demand returning in some parts of the market. What are you seeing in terms of smartphone demand in China? I think a lot of people invested in the tech space are looking to China to come back pretty strongly. Are you seeing it through Micron's business?
We are starting to see some demand coming back. Certainly, it was a big reduction in our last quarter because supply of smartphones weren't available because obviously so many of the smartphone factories were just shut down back in calendar Q1. We've seen those start to come back up, and we've seen some consumer spending happening. But I'd say that certainly the bigger trend that we're seeing in China and then globally is cloud and data center continues to be strong. And that happened in China, when they first started experiencing the quarantines that they were put in place, and then expanded globally. So that's really the strongest part of our business is data center and cloud computing right now, whether it's and personal computing, all those things that it takes for us to all of us to be able to work from home and continue with our lives, and also what governments and scientists are using great computing environments to be able to come up with treatments for COVID. You talked about on your previous segment about remdesivir, treatments for the virus or vaccines for the virus, or even just doing contact tracing requires tremendous amount of big data analytics, which is driving demand for our memory and storage products in the cloud.
Manish, just on a personal level, what are things like in Singapore right now during this pandemic for you, and what's the lockdown situation like there?
Yeah, so I think Singapore originally did a very good job, and we actually went for a good bit of time, even post the initial outbreak in China, where there were cases in Singapore, but we actually went a long time without having to have a shelter-in-place equivalent kind of order. I'd say for February and March. And then as April came, really there were two things that happened in Singapore. One was there was an influx of Singaporean residents or citizens coming back from infected areas in North America or in Europe, and that led to more quarantines and more actions that had to be taken here to what the government calls the circuit breaker had to get put in place at the beginning of April to try and reduce the risk of community spread. And then there have been some issues in foreign worker dormitories where there has been a growth in cases, which has kept the government very focused on making sure that they're keeping control of the situation. But right now, I'd say we've been able to, at Micron, been able to continue our operations here in Singapore. We have 3 large factories here in Singapore, and we've been able to continue full production operations throughout this entire time. And really feel like we have good cooperation with the Singapore government, with all of our team members and our suppliers here in Singapore to be able to accomplish that.
All right. We're going to have to leave it there. I'm glad to hear that. Manish Bhatia, Executive Vice President of Global Operations at Micron. Thanks for being with us.
Thank you.
And stay with us. We're going to take a look at the airline industry just before the opening bell. All right, welcome back to Yahoo Finance Live. We have got stocks under some pressure here as we near the opening bell. Airline stocks in particular taking a hit, Jared. Jared Blickery is with us now with the charts. Jared, that's after Warren Buffett said he got rid of all of his U.S. airline holdings.
Yeah, so a vote of no confidence there. And you can see on the Wi-Fi interactive heat map, just the carnage that we're looking at. American Airlines, for instance, 11% down. You can see they're still up over the last 3 days, but it's going to be a nasty open here. And very similar situation, for instance, for JetBlue, Alaska Airlines, United, Delta, all of these under pressure right now in the pre-market. We can also see the cruise lines under pressure as well. We just have some breaking news with Carnival that they will begin phasing service back in starting August 1st. But you can see in the meantime, Carnival's down about 6% in the pre-market, Royal Caribbean down 8%, and Norwegian is down about 9%. And we can take a look at the Dow Jones heat map here and see some of the what's going on in the pre-market. Really nothing in the green so far. We're probably going to open up a few hundred points in the red here on the Dow. We're seeing staples under pressure along with energy and financials. The big banks not doing particularly well right now, Alexis.
All right, thanks very much. You mentioned energy. I just want to take a quick look at oil. I guess also under pressure, off about 2% right now.
Yeah, we have crude oil. It's been kind of rocky overnight, but we can see it's down about 1.37% right now. And if we look at a chart of the overnight action, we can see it's actually been rising as of late. But you take a look at over the last 5 days, it's been very volatile. Although it is up, I don't know if I believe that right there. Let's take a look at the year to date. And we can see it's still down about 66%, just under $20 per barrel. And as we were saying last week, $20 seems kind of high right now, but kind of a crazy situation that we're dealing with right now.
Yeah, crazy is the word. All right, we've got a new trading day and week about to get started. Let's pause here for the opening bell. There we have it, a new trading day underway on Wall Street, and Treasury Secretary Steven Mnuchin, in an interview just moments ago, said that bipartisan discussions have begun on whether more federal government relief funding is needed amid this pandemic. And as we know, Congress getting back to work this week, and they have plenty on their plate. We've got the Dow Jones Industrial Average under pressure here in the early going. We're going to be right back with Paul Schatz of Heritage Capital coming up next. We have a down market here in the very early going with the Dow off about 270 points. And this just crossing the wire. GE Aviation is going to cut 25% of its workforce because of this coronavirus pandemic. And GE stock is under pressure right now. Want to welcome Paul Schatz now, president of Heritage Capital, to the program. Paul, always good to see you. We haven't talked in a few weeks. What have you made of market action over these past few weeks? The fact that we've gotten some really bad economic data, but the market has seemed to hold up okay.
And good morning. I hope you're well and staying sane. A couple things. So the last couple of times I've been on, I've had a common theme, and that is regarding the markets, not the health crisis. It's always important to see what the reaction is to bad news, not what the bad news is. Everybody knows bad news. But when stocks trade higher on bad news, that's a super, super bullish sign. So that's kind of the big picture. Shorter term, I thought last week markets went about as far as they were going to go. So you want to call it Dow 25,000, we'll round it. That's fine. I think we're in a range. Let's say it's 22.5 on the downside and 25,000 on the upside. And now the market's going to digest and maybe catch up with some of the news and maybe some of the turns we're seeing in earnings.
Paul, I know you were glued to the Yahoo Finance exclusive live stream of Warren Buffett's annual meeting this past weekend. So when Buffett comes out here and says, I'm exiting all my airline stocks, the fundamentals of these businesses have changed, does that signal to you a short-term market top?
Absolutely not. I did watch yesterday. I thought Andy did a great job in the intro segment, and kudos. It was really nice. So Buffett, I think, is being Buffett. He's being candid. He's got $134 billion in cash. On the airlines, it wasn't new news. That came out, I think it was a week or so ago. So the fact that it's the second or third time he's invested in airlines and gotten burned, he's clearly not an airline investor. And I would argue in the rest of his life, he's not going to invest in airlines again. The only thing that surprised me, think about it. I'm sure he was all jacked up with the billions, ready to make one of those crazy, desperate deals that the companies needed capital to survive. And then the government came in with the nuclear arsenal and said, nope, not going to happen. The only thing that surprised about Buffett was during the collapse in March, he was not a net buyer in those 5% positions in companies he just would love to own. That was the only thing that surprised. Other than that, what are you going to do when the government comes in and says, we're going to backstop America?
But
hey,
Paul, I would argue real quick, though, that what Buffett did with the airlines, that applies to a lot of other companies, cyclicals, industrial companies. All these companies are taking on more debt, and it remains completely unclear when demand will come back. And you've seen this market rally on the notion that we get this V-shaped recovery later this year, and maybe we don't get it.
So I've argued since the beginning, there won't be a letter to describe the recovery. It's not going to be a V. It's not going to be a U. It's going to be something a lot more complex. But I take Buffett at, first of all, I said early on, there's a certain segment of the markets and the economy, the airlines, the cruises, the restaurants. You can go. We all know what they are. That they will not, those restaurants, they will not immediately bounce back. They're going to have, most will be zombies, frankly, for several years to come. But on the flip side, you've got a whole segment of the economy that is going to boom out of this. So it's going to be so much clear haves and have-nots. I know I'm not flying anytime soon. I will not get on an airplane. I'm not getting on a train. That's me. Maybe I'm on the crazy end of the spectrum, but I'm not. I'm not going to Disney, and I'm not going on a vacation where I've got to be around a zillion people. I think he gets it. The airlines have a unique challenge in front of them, just like maybe the casinos do. And it's going to take a lot more time and science for people to be comfortable. Think of all those conventions in Vegas. People are not going to run back to those huge conventions in Vegas anytime soon. So I think Buffett gets it. Why keep a position that you're going to be wrong for the foreseeable future? But on the industrial side, Brian, I'm going to push back a little bit. I think there are going to be a lot more opportunities than seems on the surface once you get out of kind of the discretionary part of industrials.
Hey, Paul, before we let you go, I know you're not a huge fan of the Federal Reserve under Jay Powell. What do you make of what they've done thus far? What more should they be doing?
You're right. I have not been a fan of the Fed and certainly Chair Powell. I will say this. I was applauding with both hands and both feet the entire way. Everything they did, I kept saying, do more. You got to be bigger. You got to be bigger. And they pretty much accommodated my wishes. I'm so disappointed. I'm disgusted, frankly, that they decided to go into the junk bond market. I mean, they got to a point with munis, and we all know they've been in every market, commercial paper, treasuries, mortgage-backed. They should have stopped before they got to junk bonds. Junk bonds are called junk bonds for a reason. They have the highest amount of risk in the fixed income spectrum. They should have stopped there and not gone to junk. Investors, some people have to be punished, number one. And two, it makes it so easy now in the next crisis to be Japan and start buying stock index futures or ETFs. And all this does is this creates zombie companies. The Fed should have stopped and not done junk bonds, and there will be major unintended consequences in the mid-2020s from this. But other than that, I like everything they did.
All right. See, I knew you had something to say on it. Paul Schatz, Heritage Capital. Be well, and thanks for being with us.
You guys too. Thank you.
All right. Coming up next, our editor-in-chief, Andy Serwer, fresh back from Omaha, Nebraska, and Warren Buffett's annual shareholders meeting. He's going to join us right after this. Berkshire Hathaway's annual shareholders meeting, which happened this weekend virtually. Yahoo Finance was once again the exclusive broadcaster of that meeting. And we learned a lot about Warren Buffett's thinking about the current state of the world. Our editor-in-chief, Andy Serwer, was there. He is here now with us, having flown back from Omaha, Nebraska. And we're going to get to your experience flying and what that was like for you. But you and I have both been to the Berkshire Hathaway meeting over the years. It is usually a bustling crowd. You have all of the vendors there from the companies, the various companies that Berkshire Hathaway has a stake in. None of that happening this year. What did it feel like not having those crowds there, Andy?
Surreal, bizarre, lonely, empty. I mean, instead of 40 to 50,000 people there were about 10 people there. I mean, I think I was really the only non-Berkshire Hathaway person there. I mean, they desperately did not want people to come. It would be violating CDC regulations, protocol, guidelines, et cetera. So they didn't want to do that. So I was in an empty arena and with just Charlie and, with Warren Buffett and Greg Abel on the stage. And it was just a bizarre experience, really.
And Andy, what did Mr. Buffett say about trying to predict the future of the markets?
Yeah, obviously you and Paul and Alexis were talking a little bit about, parsing what Warren Buffett had to say, which is, just fascinating. And I think basically, while he was sort of positive overall, I think he was extremely cautious on the short term. Here's what he had to say about that, Brian.
I don't know. And perhaps with a bias, I don't believe anybody knows what the market is going to do tomorrow, next week, next month, next year. I know America's going to move forward over time, but I don't know for sure. And we learned this on September 10th, 2001, and we learned it a few months ago in terms of the virus. Anything can happen in terms of markets. And if you can bet on America, but you have to be careful about how you bet, because simply because markets can do anything. On October, whatever it was in 1987, October 11th, I believe, Monday, markets went down 22% in one day. In 1914, they closed the stock market for about 4 months. After 9/11, closed the market for 4 days. We hustled to get it going again. But nobody knows what's going to happen tomorrow.
Yeah, and I think the big point here, while he was giving this big speech about never bet against America and the greatness of America, I mean, he was really doing that in a way, you guys, to sort of couch the fact that he's not exactly bullish right now. And, over the balance of the year and even going into next year, and you guys were talking about the airlines, and I think it's a reflection of that. I mean, it'd be easy to say, hey, hold on to your stake or even buy airlines right now, because of course they're going to bounce back. But what he's saying is that this is going to last for a while. And he even said, talked about the market not getting back to where it was in 1929 until 1954. And that's an extreme. But we've got several years of being in the soup here.
Oh, I like being in the soup, and that we are. Andy, we asked some people to write in and ask you a few questions about Warren Buffett. You've known him for a very long time. You've interviewed him on many different occasions, and we got some pretty good questions from Twitter. So I want to share some of those with you, okay? First up, this is from @BuffettCash. He asks, why has he, Warren Buffett, chosen to be so quiet during this crisis compared to 2008? I guess my first question is, do you think he's more quiet now than he was then? And if so, why do you think?
Yeah, I think that's a very good question. And I think it's because he was taking it all in, that it's such a unique crisis, so different from other ones. It's not a financial panic, not anything he's used to. I talked to him in the second week of March, and he, still said, I'm not going to sell my airlines at that point. He told me that. So I think at one point he referenced Keynes. What do you do when you get new information? I change my mind, sir. What do you do? So I think there was very much of that going on. And, at first he told me he was only going to do an hour for the annual meeting this year, and then it ended up being 4.5 hours. So I think that he was very careful to not sort of go public until he had to, which is the annual meeting. And he just wanted to continue to gather information. And he got, frankly, progressively more concerned, I think, Alexis.
And talk about stamina for especially a person of his age, which leads me to this next question from @CamBarber. He asks, what is Warren's exercise regimen to stay so lucid? I want to know because I want a piece of that, Andy.
Yeah, I mean, I don't know. That's a great question. I have to go back and ask Buffett, but I'm sure he basically eschews exercise. I mean, this is, he's sort of famously like going to McDonald's and eating candy and drinking Cokes. And he's not like, on a Peloton. I'm sorry to say, Brian Sozzi. He's not like Brian Sozzi on a Peloton. Yeah, not all the time like that, and I'm sure. But he's probably doing a little bit of something because, I'm sure the doctors, et cetera, have had him doing stuff. But to your point about stamina, that was one huge takeaway. I mean, we were kind of getting a little antsy, a little tired, 4.5 hours in there. And, you know, the mental acuity of being 89 years old and being able to essentially talk for 270 minutes straight, and to have all these things sort of top of mind, and to be able to reference very complicated, you know, mental stuff. And, you know, Whitney Tilson referenced that as well, saying that, you know, he wasn't better than he's ever been, but he was as good as he's ever been. And, you know, there are people on Wall Street who were sort of saying, oh, Buffett's lost it, and, you know, he doesn't, not quite there. I would say that, you know, his faculties are still pretty much 100%, you know, intact. Could he be a little more svelte, Alexis? And could he do a little more yoga? Probably, but that wouldn't be the Warren Buffett we know. And so maybe we shouldn't ask him to do that. I don't know.
Couldn't we all be a little more svelte and a little more yoga, Andy?
Not Brian Fosby. Not Brian Fosby. Couldn't possibly.
And I have
Maybe I
one
should
more.
drink more soda. I don't know.
Right.
So this one's from @Henry on Twitter. He says, does Greg's presence mean he will be the successor of Warren? And by Greg, he means the vice chair of non-insurance operations, Greg Abel, who was there, and I guess instead of Charlie Munger, who's usually, you know, Buffett's right-hand man. What's your takeaway from Greg being there, Andy?
Well, you know, at first, a lot of people were, in fact, making a lot out of that. Like, whoa, you know, this obviously is the new Charlie Munger. He's sitting right up there. Greg Abel is the guy who's going to succeed Buffett. And that very well may be the case. But, you know, Berkshire director Ron Olson warned us, cautioned us against reading too much into that. And he said, listen, was more a matter of logistics. There are 3 vice chairmen. Charlie Munger, 96 years old, is not going to fly in for this event, right? That's not happening. And Ajit Jain on the East Coast, also really no reason to go. Greg lives nearby. So that made more sense for him to go. And I think that, you know, Buffett really wanted a wingman. And at various points, you know, you probably saw during the meeting, you know, and Greg is, you know, not the most talkative person on the planet, and especially in the presence of Warren Buffett. So at one point, Buffett gave a long answer, and he turned to Greg and did his usual, like, what do you have to add? And Greg goes, I've got nothing to add. And Buffett kind of went, oh, we got another Charlie Munger here. Because, you know, that's Charlie Munger's famous line. But, you know, you could see the banter with Greg Abel. And, you know, the one thing about Greg Abel is, you know, it's probably the case that Charlie Munger's not going to succeed Warren Buffett, right? I mean, that's not going to be the case. And so, I mean, Greg is a younger guy. So, you know, it is very possible. I think it's going to be kind of a committee, you know, and a final thought here, you know, Warren Buffett said, oh, the company's going to be better off without me. Well, I'm not so sure about that. But it's a nice line. Although on the other hand, final thought, you know, probably the best thing that Steve Jobs ever did at Apple, was to find Tim Cook. Because, you know, a lot of people, if you had sold the stock the day that Steve Jobs died, you would have left an incredible amount of money on the table. And so the successor, and this is not lost on Buffett, the succession issue is number one, the number one most important thing, and that's not lost on it.
No, for sure. Great analogy and great work this weekend at Berkshire Hathaway. Thanks so much, Andy Serwer.
Thanks.
Stay with us. A deep dive into the Senate getting back to business today. We'll be right back. The Senate is getting back to Washington and getting back to work today amid big questions over another relief plan that could include billions for states trying to keep their budgets afloat. Let's talk about this now with Greg Valliere, Chief U.S. Policy Strategist at AGF Investments. So, Greg, good morning to you. Does Congress really have the appetite to do this? I mean, especially after Mitch McConnell said the states should just go bankrupt.
Well, it's a mess, frankly. I thought a month ago, on the first Monday of April, I was astonished to see how unified Congress was. I mean, they were determined to do whatever it took to keep the economy from going into a depression, and they did some really good work. Now, here we are, the first Monday of May, and they're totally off the rails, just a bunch of demands made by all sides. I mean, the president last night said he wanted a payroll tax cut, which I don't think is going to happen. Nancy Pelosi is saying she wants $1 trillion for state and local governments. Mitch McConnell is saying he wants a liability lawsuit relief, and on and on and on. Everyone has their agenda. We'll get something, but it's going to be a messy slog for the next couple of months.
And you're there in Washington. Just anecdotally, what are you seeing there? I mean, it was beautiful weather this weekend. Yeah. I'd imagine the same as in New York City. Lots of people were out and not exactly social distancing.
No, I went for a long run and I saw a lot of people out without masks in groups. I went by the Lincoln Memorial in the mall. There were thousands of people there. I think the majority did not have masks. They were all crowded in together. And you know, that's another thing, Alexis. A month ago, I think the country was very unified that we were going to stick this out, practice social distancing. But over the last week or so, you see that fading. And I think the bottom line here, sadly, is that a V-shaped recovery looks increasingly unlikely, with I think a lot of people afraid to go to malls because people aren't practicing social distancing, and because Congress is so dysfunctional right now.
Greg, what do you think lawmakers could push through in terms of stimulus ahead of the election?
Well, there's going to have to be something for state and local governments. Maybe the Fed does it. And by the way, that's one of the good things that's about the same now as it was a month ago. The Fed gets very, very high grades, in my opinion. So, yeah, I think we could get state and local government aid. I'm not sure they're going to do more for small businesses. It's been a fiasco with a lot of companies that didn't deserve anything, prep schools and lots of companies getting money they shouldn't have gotten. But I think there'll be almost definitely a big chunk of money for state and local governments.
Greg, what do things look like for President Trump as we get closer to that November election? What are the latest polls telling you about how people feel about how he's handling this pandemic and how his administration is handling it?
Well, I tell you, Alexis, his numbers aren't great. They've slipped. They're not in the danger zone. His approval rating is still sort of mid-40s. That's where he's been for the last 3 years, but people don't give him high grades, and maybe his numbers have come up a little in the last few days. But I'd say the main thing he's got going for him, quite frankly, is Joe Biden, who has been, in his basement in Delaware, who has not shown a lot, who now has a sex scandal that he's got to work his way out of, and somebody who may be hurt by a third-party candidate, the libertarian. So I'd say that the biggest plus for Trump right now is that he's not facing, to me, a super formidable opponent.
All right, Greg Valliere of AGF Investments, always great to have you on, and be well.
Stay healthy.
You too. Thanks so much. Yeah. And taking a look at the markets now, folks, the NASDAQ now in the green by just a bit, up about 4 points. The Dow off 250 points. The S&P down about 18. We've got oil trying to make a comeback here now, just under $20 a barrel. Stay with us. Much more Yahoo Finance Live to come right after this break.
Welcome back to Yahoo Finance Live. You're seeing the markets under a bit of pressure to kick off this trading week as many investors watch or saw what Warren Buffett did or announced at his annual meeting with regards to airlines, completely exiting his positions in those airline stocks and voicing a little concern on the path forward for the market. Let's get right to Inez Ferre, who's closely watching the markets right now. Inez?
And Brian, just taking a look at the airlines, which are really getting hit after Warren Buffett's comments on Saturday during Berkshire Hathaway's annual shareholder meeting, is saying that Berkshire Hathaway sold all of its stake in the 4 major airlines, and also saying our airline position was a mistake, noting how badly the industry really has gotten hit because of COVID-19. Also saying even if the business comes back 70 or 80%, you still have too many planes. And also, speaking of aircrafts, taking a look at GE, General Electric, down more than 3% after GE Aviation said that it will be cutting 25% of its workforce as aircraft demand has taken a hit from COVID-19. It already has done some cost cutting. This just adds to the measures to scale down. And then taking a look at Tesla this morning, that's up more than 4% this morning. On Friday, the stock was down about 10% after Elon Musk had tweeted that the stock price was too high in his opinion. That sent shares tumbling today, recouping some of that. And then taking a look at Honda, that is down more than 1% after Honda released its April sales numbers, with Honda sales down 54% in April. The company says it did see signs of improvement in the final weeks of April, especially customers with increasing traffic online and through dealers. But still, Honda sales down 54% last month, Brian.
That is a whopping decline. All right. Thanks so much, Inez. Let's stay on the markets here and bring in Scott Clemens, Chief Investment Strategist at Brown Brothers Harriman. Scott, good to see you as always. Lots of focus this morning with regards to what Warren Buffett announced with the airlines and in the markets more broadly. What do you make of his comments?
Well, first of all, it was a wonderful way to spend the weekend catching up with Uncle Warren, and I'm a big fan of his. And I guess every investor has their Achilles heel. Maybe the airlines or Warren's only Achilles heel. But I think this decision is motivated not so much by the current impairment of airlines, but by the anticipated change in consumer behavior, even once we're beyond all of this. And I think the technology, such as we're using right now, is such that a lot of people in the future, business travelers, are going to think maybe that's more of a video call, maybe it's a Zoom call, more so than flight. So I think that's one of many areas in which consumer behavior and corporate behavior will change, and Buffett's simply getting ahead of that likely change.
Hey, Scott, what do you not like right now? I know Warren Buffett is out of airlines, but what are some of the sectors that you're staying away from? We heard this morning that Carnival Cruises says it's not going to be cruising at all until at least August 1st. That's when it hopes to start to come back with some cruises. So what do you not like right now?
Well, we're thinking ahead towards the way in which these consumer patterns change in the future. But the one area that concerns us right now, where we think there's probably more bad news to come, is in the banking and financials sector. This is an environment in which we're at the very early stages of figuring out what kind of mortgages won't be paid, what kind of loans won't be repaid. Of course, banks in the first quarter earnings season tried to get ahead of that by posting very large reserves for loan losses, but it's still to be seen how that plays out. The banks look cheap if you just compare them to book value, but therein lies the problem. Book value is a concept that's very difficult to nail down in such a rapidly moving environment.
Hey, Scott, it's Heidi Chung here. So one thing looking at the markets that sort of caught a lot of market participants' attention is the fact that even as stocks had this massive rally in April, bonds sort of held their own as well. When you look at the 10-year yield, it's been flirting with those new highs. So I want to get your thoughts on what you think about this sort of conundrum, if you will.
Heidi, I think what happened on the 23rd of March was really important. I mean, we think of that. I'm a stock guy, so we think of that 23rd of March as a stake in the sand. That was the low in the markets, maybe the low for the cycle, maybe a low that will be retested. But that was also the date on which the Federal Reserve launched 4 or 5 different credit market facilities, and in doing so, basically established themselves as the buyer of last resort, buyer of first resort in some markets. And in doing so, I think effectively poured a lot of oil on the troubled water of a variety of financial markets, but fixed income in particular. And it is no small thing. If you look back to the end of March to where we are today, the Fed's balance sheet is 2.6 trillion with a T dollars larger. That's an extraordinary amount of liquidity that's gone into financial markets. And it's calmed markets down, at least for now. That shock and awe type monetary approach has worked so far.
And Scott, just staying on, going back to Warren Buffett here, he made up a good point. It's not, I see your point. I get your point on the consumer demand with airlines, but the other side of this is that a lot of the companies are taking on more debt to survive this. As you look forward, because of those higher interest payments, that increased debt, you're going to see, or you could see, fewer dividends, fewer stock buybacks. Does this mean that we're looking at a decade of suboptimal returns for stocks?
You know, Brian, I think we're probably looking at a decade in which there's a greater differentiation between sectors and between stocks as well. I've never, as an investor at Brown Brothers, never been a big fan of leverage. Leverage, of course, magnifies both on the upside and on the downside. I've always preferred, and I think this will work over the next market cycle, those companies that have, let's call it, a greater than average degree of control over their own destiny. That usually takes the form of a strong balance sheet, less debt than normal. It takes the form of a lot of free cash flow. Those dynamics give a company the ability to pursue a variety of options. Hoarding the cash if they want to, as Buffett does at Berkshire Hathaway in anticipation of opportunities, paying dividends, buying back shares, a wide variety of options. Quality, I think, will be the order of the day going forward. And indebtedness is the other side of that trade. I would avoid heavily indebted companies. They're simply too close to the line.
All right, let's leave it there. Scott Clemens, Chief Investment Strategist at Brown Brothers Harriman. Always good to see you, and thanks for spending your weekend with Yahoo Finance, watching the Berkshire live stream.
Likewise.
We'll talk to you soon.
Thank you.
Switching gears, pharmaceutical giant Roche has won FDA approval for a coronavirus antibody test. The company says it's 100% accurate in blood tests. Here with the details is Anjali Kamlani. Anjali, I understand you spoke to the CEO of Roche. What is he saying about this test?
Absolutely, Brian. So we're talking about how this new antibody test joins several on the market that the FDA has given the emergency use approval for. And like some of its peers, Roche has talked about how it's a more accurate test than the others that are flooding the market, as we've seen from China, those manufactured ones. And the CEO has been pretty harsh critic of those, saying anyone can put together an antibody test in a garage, but it requires validation, and that's how we're going to get to reopening. So listen to what he had to say about that and about Roche's goals in ramping up their testing.
From a technology point of view, it is much easier to ramp up antibody tests versus molecular tests. So I'm confident that we will be able to provide this test in high quantities and that this will allow the testing of broader parts of the population. Just to put this into perspective, in May alone, Roche will ramp up its production into the high double-digit millions of tests per month. So this is already at the very beginning a multitude of what we can produce of molecular tests. Also, very importantly, there's a broad base of instruments out with labs which can run such antibody tests. So I'm very confident that we can make this test available fast in high quantities. For the foreseeable time, molecular tests which directly measure the virus need to be used in a very focused way for people who have symptoms or people who are at risk. As far as the antibody test is concerned, it is a test which actually measures whether your immune system has responded to the virus. Here, testing will be available to the broad population. Initially, also antibody testing will be focused on people who are at higher risk or at people who think that they might have been infected and never tested for it because they didn't show very strong symptoms, for example. But eventually, the big advantage with antibody tests is that you can go much broader. And that, of course, will allow us to target measures in terms of lockdown, etc., in a much more targeted way.
Talking about the restrictions still, even on the antibody testing, in part to do with the ability to ramp up and in part to do with his belief that it shouldn't just be a widespread everyday sort of situation. Brian.
All right, Anjali Kamani, good interview. Talk to you soon. And do stick around. We'll have much more on the Berkshire Hathaway annual meeting that was exclusively held on Yahoo Finance over the weekend. Stay tuned. Welcome back to Yahoo Finance Live. Berkshire Hathaway's annual shareholders meeting is normally a celebration of investing with thousands of Warren Buffett fans and investors in attendance. But this year, it was just 12 people. And Yahoo Finance, of course, was the exclusive network broadcaster. Warren Buffett was supposed to go on for a total of about an hour, but instead, Mr. Buffett gave us a masterclass on investing and life for a whopping 4.5 hours. Our in-chief Andy Surrer was in the room for it all. Andy, it should be noted, you were the only person in that room. What was it like?
Yeah, I was the only person in the room who didn't work for Berkshire Hathaway. I think that's actually, in fact, the case. And although Warren's daughter, Susie, was in there for a little bit as well. So a family member in addition to me. But, you know, it's interesting when you mentioned this part about how long he was going to speak. And we were all surprised. I mean, you're right. He did indicate to me that it was going to be about an hour, and 15 minutes of that was going to be the business part of the meeting, you know, the accountants and ratifying the votes and that kind of stuff. And then he was going to take 45 minutes of questions that were going to come from Becky Quick of CNBC. She was getting those all from shareholders. By the way, the reporters those aren't their questions they asked. Those are questions from shareholders. Just clarification there. And so what's interesting to me is that, you know, he said, well, I'm going to talk for a little bit. And, you know, he ended up doing this soliloquy about American history that went on for well beyond 90 minutes. I mean, and we were just sort of shocked as it kind of kept going and going. And at one point he said, well, this is a little bit longer than I thought I was going to do. And then, you know, Becky Quick told me, you know, she gets a lot of questions and she just tees them up and keeps going until he wraps her. We all know what that phrase is in our business. And Buffett just kept on going, just kept on going.
But it was, I have to say that we were surprised too. We're like, when's he going to stop? But it was delightful and always great to hear what he has to say and to get his insights. But I want to talk a little bit about the auto insurance industry, where Buffett stands on that, especially when it comes to Geico.
Yeah, that's right. It's actually interesting. Going back to when I spoke to Buffett in early March, Alexis, I asked him if he was already starting to see things in his businesses that were changing because of the coronavirus. And he told me, well, we're starting to see less accidents because people are driving less. And then the questions would become, well, is that good for Geico or not? In any event, he delved into that a bit here at the annual meeting. Here's what Warren Buffett had to say about Geico.
At Geico, we're the second largest auto insurance company, and different auto insurers are handling a sharing of the better experience with their policyholders in different ways. Our plan will deliver back $2.5 billion roughly or so in recognizing the reduced frequency of accidents during this period. What we don't know is how long this will continue. I mean, people want to drive their cars still, but conditions have reduced that driving dramatically, obviously. Now, we have instituted a program that runs saving people money for 6 months, and so far, other people have largely been 2 months, but some of them have given a little more for those 2 months than we give per month. Our total is the greatest at $2.5 billion, and in addition to that, we and all the others in the industry, it's not just Geico, we've also, and insurance commissioners in many cases, I believe, have required it, but we have, we give people more time to pay if they aren't paying, and if they cancel their policy or if they don't end up paying us, we've in effect giving them free insurance during that period. And the delay in payments is obviously increased. Delay of payments on, if you got a shopping center getting rent, the delay in payments is what happens during a period like this. And that will be a significant cost to us. We don't know how significant it will be. There will be more uninsured motorists driving, and they cause a disproportionate amount of accidents.
So I think what he was saying is kind of a mixed bag for Geico. On the one hand, people are driving less, so that'll mean less claims. On the other hand, people won't be paying their premiums, which will be negative. And, you know, another thing I should point out about Geico, you guys, is remember that Todd Combs, one of his investing lieutenants, has gone in temporarily to run that business. That happened before the coronavirus. And, you know, he's got other stuff. He's on the board of directors of JP Morgan, as well as running the healthcare initiative for Berkshire Hathaway. So Todd Combs, and never mind running the investing, co-managing the investing operations for Berkshire. So Todd Combs has a lot on his plate right now.
Yeah, to say the very least. Andy, but we can't let you go without talking about these the moves in the airlines. Mr. Buffett dumping shares in the 4 major airlines, certainly getting a lot of attention this morning on the street.
Warren Buffett and airlines. It has not been a happy relationship historically, you guys. And yet again, they are biting him in the you-know-what. And, you know, it's interesting because at first it looked good. It looked like it was really working out for him. I mean, Delta, what a great story that was. But, you know, surprisingly, I think to some, he sold out the whole thing, lock, stock, and fuselage, right? And, you know, what it says is it's actually a pretty scary thing because he's saying it's not worth holding these things for a year or two until they come back, meaning there's so much uncertainty and it's going to take so long. I mean, he said it. There's too many planes out there. And he said that, you know, the passengers just won't get back to the levels, the pre-coronavirus levels that we had for maybe many years to come. I mean, I was flying this past weekend out to Omaha. And on one plane, I was on an Embraer 175 that holds 70 people. There were 3 people on the plane. Okay. I mean, that is a money-losing proposition. The other flights I was on, you know, maybe 25%, but it's scary. You know, you're looking at someone coughing, people are wearing masks. Then there are people who won't wear masks. I'm not going to wear a mask. You know, well, great. Thank you very much for that. You know, so It's really a very fraught situation there. And Brian, I think you said it. There are other businesses too that are, as I like to say, Alexis, in the soup. So it's metaphorical, his airline investment, and not in a good way.
Andy, real quickly, what were the airports like when you traveled there?
I have never had such a beautiful experience in O'Hare in my entire life. It was empty, pristine, and clean. Yeah, I mean, you could, just eat off the floor. I mean, you wouldn't want to do that. But I mean, it was you never seen so much scrubbing and polishing going on. I mean, the Portland, Maine airport was completely empty. Literally, there were 2 of us in the entire airport. O'Hare, there were like, a dozen or so people. Minneapolis was a little more crowded. Omaha, a little more crowded. Philadelphia, for some reason, was crowded. There were all kinds of people running around in there. But maybe that's Philadelphia, and you can email me about Philadelphia if you don't like my comment about it. But it was pretty funny. But just very different, a very different experience. For the most part, no people, Brian, no people at all.
All right, Andy Serwer, awesome insight. Great coverage over the weekend. We'll talk to you soon.
Thanks.
Do stick around. We'll dive into a Yahoo Finance trending ticker. That's straight ahead. Welcome back to Yahoo Finance Live. Let's take a look at one of today's trending tickers, Canopy Growth. Shares of the cannabis company are moving higher after Constellation Brands made some moves to take a bigger stake. Heidi Chung has the latest. Heidi?
Brian, finally, some good news for Canopy Growth investors. We are seeing shares up about 5% here in early trade, and that's after Constellation Brands boosted its stake in pot company Canopy Growth by about 5% over the weekend, bringing Constellation's total stake to about 38.6%. The beer giant exercised 245 million Canadian dollars worth of warrants, and the company also made that move ahead of that warrants expiration Friday evening. Constellation CEO Bill Newlands saying in a statement, quote, "While global legalization of cannabis is still in its infancy, we continue to believe the long-term opportunity in this evolving market is substantial. Canopy is best positioned to win in the emerging cannabis space, and we are confident in the strategic direction of the company under David Klein and his team." Now, in terms of optics, this obviously looks good that Constellation is boosting its stake. This move not only signals its confidence in Canopy Growth, but also in the broader cannabis industry. And we've been talking a lot about this industry because the investors of this industry have been struggling. If you recall, pot stocks have just been beaten down over the past couple of years. shares, taking a look at just the past 12 months here, shares of Canopy Growth are down 69%, Tilray down 85%, Kronos down 66%, Aurora down a whopping 92%. All of that while the broader market is only down about 2% here. So finally, some bright news coming out of the space. That being said, it's sort of a wait and see to see if all this legalization happens here in the US, which is, of course, the biggest market for cannabis.
Yeah, Heidi, I think you hit it, right? It's legalization. There's no global legalization of marijuana, at least not on the horizon anytime soon, especially I have to think the pandemic has sort of pushed that back a little bit. But I'm curious what Constellation Brands' long-term goal here is. We know Constellation Brands owns Corona Beer, among other brands. It's taken it on the chin because of the coronavirus, right? The names being the same has not been good for that brand. But going forward, are they looking at CBD products? I mean, how do they want to sort of maybe incorporate Canopy Growth into their own product line?
Well, Constellation, Alexis, is one of those companies that is not a cannabis company, but was looking to really dip its toes in the entire industry. That being said, like you mentioned, beer sales just have been taking it on the chin for several years at this point. So this really is a move to broaden out its portfolio, putting its bet on cannabis, hoping that potentially, you will see CBD be approved by the FDA, and you can start making consumer products such as beer, just an array of products that include hemp as well as CBD. So it's just an early bet. It hasn't really paid off for the company yet, but this is just a move to broaden out that portfolio.
All right, let's leave it there. Heidi Chung, good to see you. Enjoy Cinco de Mayo tomorrow.
You too.
All right. Just stick around. We'll be right back with John Rogers, Ariel Investments Chairman, Co-CEO, and Chief Investment Officer. Stay tuned. Welcome back to Yahoo Finance Live. Let's get right to Inez Ferre, who's watching the markets and several earnings reports out this morning. Inez?
That's right, Brian. And I just want to take a look at the Dow right now. You can see a pretty mixed picture. We've got energy and technology, which are outperforming, but you've got industrials and financials. Those are leading to the downside right now. And as you just mentioned, earnings, looking at Tyson Foods, with Tyson Foods adjusted earnings coming in at 77 cents a share for the latest quarter on revenue of 10.89 billion. Earnings and revenue coming in below what the street had been expecting. The company saying that it faced challenges with plants temporarily closed, lower demand from food service outlets as that shifted more into retail, and supply chain volatility. And it cannot anticipate for how long these challenges will last. That's a year to date of Tyson Foods that you're looking at, down 39% year to date. And then taking a look at Dave & Buster's, that's the year to date of Dave & Buster's, down 72%. Today, that stock is down 17% after the company announced Jefferies has agreed to purchase $100 million of Dave & Buster's common stock. It also granted Jefferies the option to buy another $15 million of shares, and the company will use the proceeds to help strengthen its balance sheets. And lastly, just taking a look at oil. Oil is seeing a bit of a pop today with WTI for June delivery up more than 1% at just hovering above $20 a barrel. But as you can see, over the last 10 days, just a lot of volatility there for oil, Brian.
All right. Thanks so much, Inez. Our next guest has seen it all. He started Ariel Investments nearly 30 years ago. That is John Rogers. He's chairman and co-CEO of Ariel Investments. John, good to speak with you. Thanks for taking some time this morning. You've seen a lot of financial crises. Where do you make it? What do you make out of the cycle we're in now, and where do you see value in this market?
Well, you're right. We have seen a lot of crises over the 37 years of Ariel's existence, but this has been the most stunning, the deepest, sort of the most heart-wrenching that I've been through. But as Warren Buffett talked about this weekend, the America that we have, the magic that we have in America always brings us back from the precipice. And so we're in there buying, we're in there leaning in, looking for opportunities. And it's been a great opportunity to find some iconic brands that have really gotten hit. Madison Square Garden Entertainment that owns Madison Square Garden, that iconic part of America. We bought Vail Resorts. We think there's no substitute for Vail. And it's just been a great time to be able to add to wonderful businesses like that.
John, have you started kicking the tires on any of these cruise lines? Now, I talked with Carnival's CEO last Friday, and he said they're looking to raise a good amount of debt, but he came away hopeful that they might begin sailing before year end. Are you any interest in these cruise lines?
We already have a modest exposure. Royal Caribbean was one of our best stocks coming out of the financial crisis and did extraordinarily well. Richard Fain is a terrific CEO. Donald Arnold's a very good CEO at Carnival. So we have a modest exposure. The one thing that we've added to the most, though, has been One Spa, which does the spa treatments for passengers on all the cruise lines. They have about a 90% market share. It's a very asset-light business, unlike the cruise lines that's sort of an asset-heavy business. So One Spa has been our way of adding to the sector without taking some of the overall risk of the major cruise lines.
I'd also love your take on media companies right now, John. We had the Viacom-CBS merger happening, I guess, just before this pandemic really hit. But do you think that they're on track for good things post this pandemic? We know that advertising has taken a hit. Hollywood has been shut down. What do you make of the media companies right now?
We're still optimistic longer term. We think clearly right now, as you suggest, advertising has been devastated in this environment. But at the same time, content matters. And companies like Viacom, CBS have extraordinary content through Showtime, through Paramount, through all the brands that Viacom brought along from Nickelodeon, et cetera. So we think ultimately whether people are actually tuning in always to the Viacom stations, they can sell their content to all the others, most of the other live streaming businesses. So we think that over time these companies will work out. We also think the local news is a powerful engine today, especially with all the political advertising that's going to continue to come and it's going to grow as we move into the fall. So companies like Tegna and Meredith that have local broadcasting stations, we think will do quite well once we get past this COVID crisis.
John, I've always known you to be very plugged into corporate America. You sit on the McDonald's board, but as you take a step back here, what is the one biggest concern that you're hearing from leaders in corporate America in moving beyond this crisis?
Yeah, in the boards that I'm in, I think people are concerned about the virus coming back in the fall. And, the worry that maybe all the things you do to get things back on track will be derailed in that period and, waiting anxiously for the vaccine. I think that's been the sort of the theme that I've been hearing is that, and also the theme is that people aren't going to come back as fast as maybe a lot of us have been hoping, and that we have to sort of be cautious and conservative, make sure we have the balance sheet strength to weather the storm, and just prepare for the worst, even though hopefully the worst doesn't happen.
John, you started this fund way back in 1983. You lived through lots of financial downturns and upswings. You say it's really important to remain patient right now. What are you telling clients? How can they remain patient during such an uncertain, anxiety-ridden time?
Yeah. I just remind people, it's, what Warren talked about this weekend that I referred to earlier, but he talks about it every year, how, the last century, we had a great pandemic in 1918. We had 2 world wars. We had the Vietnam War, many, many recessions. Horrific things happened. But America always bounced back and the market always marched higher. And so that's why I always tell our investors, just look out over the horizon, stay the course, be patient, believe in slow and steady wins the race. And it's always worked. And it was great to hear it being reinforced this weekend by the Oracle of Omaha. And so I think that gets people, when they sort of look back with that historical perspective, people are able to be more patient and understand that it works if you can stick with it and lean in during the tough times.
John, based on what you did hear from Warren Buffett this past weekend, and I understand there are sectors in this market, there are opportunities potentially, but do you think he indicated some short-term top in the market?
Yeah, he didn't seem to have quite as he was being very cautious, but he constantly reminded us that no one knows where the market's going to go in the short term, and. But he also was very clear that certain sectors are going to be profoundly impacted, the airlines being the number one. But I think he was also sort of alluding to the travel area will be tough. And so I would be, somewhat concerned about business travel coming back the way it used to be. And therefore, maybe you don't have the same kind of hotel occupancy that we've seen in the past. Because as we know, businesses drive hotel occupancy at many, many of the major chains. So I think he was alluding to certain sectors really will have a profoundly difficult time coming back to normal.
All right, let's leave it there. John Rogers, Ariel Investments Chairman, Co-CEO, and Chief Investment Officer. Appreciate you taking the time, and please do stay safe out there.
Well, thank you.
And some sad news before we go to break. Breaking news, Hall of Fame NFL coach Don Shula has died at the age of 90. Absolutely stellar career here, 347 career wins, most in the NFL, coached only perfect season in NFL history, 2-time Super Bowl champion, 1968 NFL champion, and 4-time Coach of the Year. Again, breaking news, Hall of Fame NFL coach Don Shula has died at the age of 90. Stay tuned, lots more ahead on Yahoo Finance. Welcome back to Yahoo Finance Live. We're watching a major retail name this morning. That is J.Crew. It's officially filed for bankruptcy protection, the first of many expected to go down that road very soon. Heidi Chung is back with the details. Heidi?
Hey, Brian. Yeah, the company officially reaching a deal with lenders to convert $1.65 billion of debt into equity. Lenders are also giving J.Crew about $400 million to maintain operations while the company goes through this restructuring. But, you know, we've talked a lot about this company, Brian, and it's been struggling for quite some time here. But I think it's fair to say that COVID-19 was sort of the nail in the coffin, if you will. J.Crew had some very big troubles with heavy debt load, but it was also hoping that that public offering of its favored brand Madewell would help it raise capital and ease that debt. But everything going on right now has made that very difficult. A couple of other issues with J.Crew was that extreme discounting that both Madewell and J.Crew had been doing for quite some time. And the company just has too many stores and outlets. As of March 2nd, there were 182 J.Crew branded stores, 140 Madewell stores, and 170 factory stores. And much like other retailers that have a big presence in those factory outlets, much like Tapestry as well, it's just not a place that a lot of people are going to anymore. And that being with tourism down as much as it is, making that ever so difficult right now in this environment, Brian.
No, Heidi, great point about debt. J.Crew has more than $1.6 billion in debt. That is too much when your sales have fallen off a cliff. Thanks so much, Heidi. And staying on retail, as brick and mortar stores face an ongoing coronavirus shutdown, e-commerce platforms are riding the wave that the pandemic has brought on. E-commerce company Shopify stock rose over 50% in April. Joining us now is Shopify head of retail, Ian Black. Ian, thanks for taking some time this morning. So you heard Heidi, J.Crew has filed for bankruptcy. Frame this. How does what is happening in retail and what may unfold over the next couple months? A lot of bankruptcies, a lot of inventory liquidations. How does that impact a company like Shopify?
Of course. Well, first off, thanks for having me on this morning. And it is a tough time for retail right now. And so as a company, Shopify is trying to do all the things that we can to help retailers and all merchants through the current crisis. So one of the main things that we're focused on right now as a company is launching our new Shopify POS. And that's a point of sale to put the most powerful technology for running a retail business in the hands of small retailers. And it may seem like a weird time to be launching a point of sale system for retail stores. But the important thing is that Shopify marries the offline and online worlds. So what we're doing with this new product is allowing retailers to connect their offline stores to online customers and continue to make sales even when customers still aren't in stores today.
Ian, to bounce off of that, what does your business look like when we do go back to quote unquote normal life? How will this experience for us change the way we shop and the retail landscape?
Yes, I think so many retailers are struggling with that question today. And we see three major changes happening amongst retailers that we think will stick with us as slowly consumer traffic returns. The first is retailers have shifted their sales online, whether through online stores or email. We've seen that very clearly on the Shopify platform. Secondly, retailers are using their retail stores as distribution hubs, whether for curbside pickup of local orders or as fulfillment sites for shipping more broadly. And thirdly, we've seen retailers start to use their store staff to engage with customers outside the four walls of a retail store. So these are four trends that we're seeing on the Shopify platform are helping retailers survive and get through the current crisis. And we know it will be some time before consumer traffic picks up as it was before 2 months ago. And so we think these three trends are key to retailers surviving. And that's really what our new point of sale technology is about, is enabling those types of shifts on behalf of retailers.
Ian, several retail sources I've talked to the past couple of weeks suggest a lot of online brands might want to pick up some of this real estate being discarded by a lot of mall-based retailers. Does Shopify have any interest in getting into the mall and having a physical store presence?
Well, our focus has been strictly on building the technology to help retailers. But you're right that we've seen a big trend even before the current crisis of digitally native brands, so online brands, starting to open up physical locations because real estate or physical stores are a more efficient way for them to earn new customers and acquire new customers. We really think that trend will acquire as real estate prices are depressed. We're trying to help retailers expand their presence in brick and mortar, which is a bit counterintuitive given the current time, but we think it'll be a very efficient way for brands to acquire customers in the months and years ahead.
Ian, I want to get back to that new Shop app that you recently launched. Shopify is making that service available only as a native mobile app. Why did you decide to do that, and why now? Was now the right time to launch this?
Well, what Shop does is bring together powerful package tracking features that we've had in market for a long time, but also combines it with in a view of all the stores open on the Shopify platform. And so Shopify is about trying to help brands get in front of customers and build their businesses, but still behind their own brand and still owning the customer relationship. So we see the Shop app as a very important step forward to helping retailers and merchants of all type reach their customers in new ways. Really, our whole platform is about giving merchants the ability to build relationships with their customers, own their brand, and still grow their business using traditional e-commerce tools.
Ian, are you having any? You're working closely with a lot of these physical retailers. Are you having any difficulty getting paid for them? A lot of them simply are running out of money.
Well, Shopify as a company has done a few things to help retailers. One of those things is extend our free trial so that offline businesses that are hurting and need to quickly shift their business online can do so without worrying about the cost. Similarly, as we launch our new Shopify point of sale system, we're not charging any price for the first 5 months of that product. So really, we're about trying to help retailers and merchants get through this current crisis. As evidence of that, we've launched $200 million of Shopify capital equity not equity, but financing to help merchants get through the current time period. And we've released new features like curbside pickup that we know are helping retailers transition their business online and continuing to make local sales. So really, we're from capital to new features to price relief. We're doing everything we can to help merchants through this time.
Okay, let's leave it there. Ian Black, Shopify head of retail. Thanks for taking some time this morning.
Thanks so much.
Do stick around. We'll dive into Disney straight ahead. Welcome back to Yahoo Finance Live. A quick reminder, today is Monday, and not only is it May 4th, but it is also considered Star Wars Day with May the 4th be with you. Say that a couple times fast. This is usually a time for fans of the franchise to get a hold of new merchandise or content, but Disney is using it as a reason to launch The Rise of Skywalker on Disney Plus 2 months early. Yahoo Finance editor-at-large Dan Roberts is here. Dan, does it make sense to release this early?
Yeah, I think it does, Brian. And what they're really touting is all 9 of the Skywalker movies are now on Disney Plus. All the Star Wars movies except Solo, which comes later on in June, I believe. But those 9 Skywalker movies, it's a way for them to tout the service and try and reap new subscribers. Now, of course, the most recent subscriber number we had for Disney Plus was 50 million. Back in early April, that was shared, and that's a big number. But I expect that when we get Disney's earnings tomorrow, especially because the company is going to be looking for some kind of good news to tout, we might get an updated figure, and maybe it'll be significantly higher than 50 million. They're trying to add to that number right now by saying, hey, if you've held off on paying for Disney Plus, now you've got the newest Skywalker movie. Don't you want to see it again? Of course, mixed reviews, more mixed than the other Skywalker movies, but it did very well in theaters. So I suspect that it should work in getting at least a few more people to finally pay up for Disney Plus or start their trial.
Hey, Dan, the news the street's really talking about this morning, and probably why the stock is coming under pressure here this Monday, is because of a downgrade by an analyst at MoffettNathanson, downgrading Disney to neutral from buy. What's his thought process there?
Yeah, so this is going to be Disney's Q2 earnings. So it includes February, March, and April. And it's very likely that the earnings will not be good. A lot of people are projecting that even once kind of the coast is clear from coronavirus and various states have reopened, which of course is a process already starting to happen, even once Disney parks have reopened, and of course all the parks in the US are still closed, a lot of people are now kind of projecting that there will be damage to the park's traffic even all the way till 2022. I think that goes a little far personally, but no one really knows anything for sure. And a lot of analysts now are agreeing that the picture is not going to be very rosy for Disney, not only for 2020, but at least 2021. And as I mentioned, a lot of people think it'll take a couple of years for the parks to come back. The thinking is even once the parks have reopened, you know, people might be afraid to go, social distancing. I mean, it's not like the virus is going to be gone completely, even if there's treatment or a vaccine. So, you know, Disney has begun selling character-themed masks, and they're probably going to have to test people even when the parks reopen at the gates. And this changes things. I mean, you know, I think in many ways the Disney parks are a bit similar to the problem with summer camps right now. I've been writing about whether summer camps can open this summer. Someone in an article I wrote said social distancing is the opposite of summer camp. And I think Disney parks are the same way. I mean, it's very hard to imagine the parks opening and trying to keep people 6 feet apart and wearing masks. I mean, there are kids all over the place. They're touching everything. So to bring it back to the MoffettNathanson downgrade, which is to neutral from buy, you know, this analyst makes clear to say we've always been big believers in Disney, especially in the portfolio of IP and their brands. But this time really hurts this company. And it's not just parks and resorts, it's cruises. And it's not just cruises, it's the studio division, because filming is on hold. So a lot of the Marvel original shows that were slated to hit Disney Plus weren't quite finished and weren't quite polished and ready, and now cannot hit Disney Plus on time and have been delayed. You know, Falcon and the Winter Soldier, Loki. Now, luckily, The Mandalorian season 2 was finished, so that's going to hit in the fall. But it's even affecting Disney Plus. And then, of course, if you want a third example of Disney businesses that are hurt, ESPN. There's no live sports right now, and that affects ABC, which is also owned by Disney. So a lot of reasons to expect that tomorrow's earnings report is not going to be very good. But if you're a believer in Disney, you believe that this coronavirus hit is eventually going to be handled.
Hashtag deep thought, Dan Roberts. I've never seen a Star Wars movie, but maybe I'll watch that today, right ahead of there.
You must.
I know. It's been a tough life. All right, Yahoo Finance editor-at-large Dan Roberts. Thanks so much. All right, let's get right to Inez Ferre, who has a close look at the markets. Inez?
Brian, I'm surprised you haven't seen a Star Wars movie, but let's take a look at what's happening right now with the airlines. Airlines really under pressure after Warren Buffett's comments on Saturday during his annual shareholder meeting. Berkshire Hathaway selling its entire stake in the 4 major airlines, U.S. airlines, with Buffett saying our airline position was a mistake. So you can see these airlines today severely under pressure, and just year to date, really, they're all down about 60%. Southwest as well. Also, Buffett noting changing behaviors because of COVID-19 affecting the airlines. And even if the business does come back 70 or 80%, you've still got too many planes. GE under pressure today, down 4%. Year to date, this stock is down about 44%. GE announced that GE Aviation will be cutting 25% of its workforce as aircraft demand has taken a hit because of COVID-19. Tesla gaining back some of what it lost on Friday after Elon Musk had tweeted last week that he felt that the shares of Tesla were too high in his opinion. Today, they're up 4%. That comment had sent Tesla shares down about 10%. Brian?
Yeah, Nez, who tweets something like that? Come on. All right. Nez Ferre, thanks so much. As for me, I'll plug an interview I have coming up, talking to Clorox CEO Ben Odor shortly. We'll have that interview exclusive tomorrow morning on the move and the first trade. But do stick around. We have much more ahead on the markets, Warren Buffett's annual meeting, straight ahead on Yahoo Finance Live. Stay tuned.
Happy Monday to you. I'm Adam Shapiro. This is Yahoo Finance. It is Monday, May 4th. We're watching markets a little bit mixed here. The S&P 500 and the Dow are trading down. The Dow is off, as I check, about 200 points. NASDAQ is trading higher. It's up roughly 10 points. Oil is also trading higher, despite the things Warren Buffett said during the weekend, that production will continue to go down. He said it doesn't pay to drill. We're going to talk more about Warren Buffett and what he said about the airlines a little bit later this hour. Retailer J. Crew filed for bankruptcy this morning. They got rid of, or attempting to get rid of, more than $1.5 billion in debt. GE Aviation is cutting 25% of its global workforce. Tyson Foods reported earnings this morning. They say they will temporarily close plants to fight the coronavirus. They are saying as well that the demand for beef and pork and chicken, although it is up, it's not enough to offset losses from restaurants and catering businesses, which are shut down. Carnival Cruise Line says it will resume cruising in a phased restart of its industry August 1st. Most of Florida is reopening for business, but with limited occupancy at stores and restaurants, just 25%. Broward, Dade, and Palm Beach counties are not included in the reopening. Also, Swiss diagnostics firm Roche is saying that it will begin producing millions of COVID-19 antibody tests every month now that it's got FDA approval. We're going to talk with Anjali Kamlani, who spoke with Roche's CEO about that in just a few minutes. COVID cases worldwide, 3.5 plus million. The number of dead worldwide, 249,000. In the United States, we have 1.189 million. We're almost at 2 million positive cases, with more than 68,000 of our countrymen dead. President Trump tweeted this morning, quote, "Getting great reviews finally for how well we are handling the pandemic." We'll talk about all of that in a minute, but let's talk about markets. To help us break all of this down, JJ Kinahan, TD Ameritrade Chief Market Strategist, joins us from Chicago. And we're talking about,
hey, Adam.
It's good to see you, JJ, but we want to talk about the Investor Movement Index, what you folks saw there, but also the fact that April was a good month for the Dow. It was a good month for the S&P 500. And your clients, you were watching them be net buyers for things like Delta, Carnival, Boeing, Bank of America. What gives?
Well, a couple of things. So they were net buyers overall, as you said, Adam, but they tended to, I'll break it off in a bifurcated buy. What I mean by that is where I think they took a little bit more risk would be in, as you mentioned, the airline stock and the cruise stocks. But they also bought, very much S&P stocks. If you look at some of the names, you see AT&T, Disney, Microsoft. So some ExxonMobil, some of those highly cashed stocks that I think people would consider more Dow type stocks. Now, going back to what you're talking about, the Delta, United Airlines, American Airlines, Carnival Cruise, those are stocks that you might not expect people to go to. And obviously, as you referenced, Mr. Buffett this weekend certainly didn't help that, as you're seeing all the airline stocks today down about 9% across the board. But what I think it is this is the part of their portfolio they're saying, longer term, we think, A, the country needs the airline, so they are going to come back. But B, this is an investment that if you're making, you better have a long-term view, because it seems awfully hard to believe that they're going to ramp up pretty quickly. And in fact, the CEOs of the airlines are exactly telling us that.
JJ, it's Julie here.
Hey, Julie.
That sort of speaks to a question I have about your users' behavior in normal times and right now. In other words, do you have a sense of how long they're holding stocks for versus what they were doing 3 or 6 months ago? Are they getting in and out of things more rapidly? Are they doing sort of more day trading? Or are they buying and holding the deltas of the world?
Well, I think, Julie, as you've seen more clients certainly come to us, as we released our earnings, and we have a lot more new accounts, I think that you are seeing certainly a percentage of our clients who are day trading more than we've seen in the past. With that said, that's still not the primary amount of business. A lot of our clients do use derivative products in terms of options and futures in order to hedge their portfolios or enhance their portfolios. That certainly hasn't changed. But I think the overall clients that are, in our IMX, they tend to be ones that maybe hold things a little bit longer.
You also break it down, the IMX, with just millennial buyers, and you've talked about this. Help us understand millennials. I am clearly not one. But for instance, Carnival. You seem to be optimistic, we were talking before we came into the stream, about Carnival and about the future with millennials. Why?
Well, millennials have been the leading buyers of Royal Caribbean and Carnival over the last few months. They're the ones who seem to say, okay, we think that the cruise industry is going to get back on its feet. Now, the general population has sort of came along in April, but in March, we saw those being top buys are millennials. So you may look at that and say, what are they doing? Well, you know what? I believe Carnival announced today that they're going to ramp back up. You reported here at the top of the hour, Adam. I would think millennials are your first target audience. They're the ones who seem to believe, and it makes sense to me that if I ran a cruise line right now, I would probably cut prices pretty significantly just to get things going, to get people on board, as many restaurants are doing now, just to keep the kitchen staff working. So if you're going to cut prices and you have a group that seems to believe in the stocks, why wouldn't you market toward that particular group? And let's face it, when we were in our early and mid 20s, we all think we're invincible. So those are probably the people who are also most likely to go out, whereas the traditional, I think, cruise customers, probably an older person who in these times, the most susceptible group to COVID-19, is probably a lot more reluctant to go on a cruise at the moment.
Hey, JJ, it's Brian Chung here. I want to broaden out the broader equities market. I mean, it seems like the bearish tone that we heard from Warren Buffett was kind of in contrast to the rally that we've seen in equities over the past, let's say, week or two. So I'm wondering, it seems like a lot of that was driven on the optimism that things are starting to reopen, like what we were just discussing with airlines or with these cruise companies. But I think there's kind of this realization, on the other hand, that the demand destruction might not be there even if these companies open back up. Where do you land in terms of that kind of debate right now, and really maybe where equities should be trading based on those risks?
Well, Brian, I think you hit on something really important. And to me, the biggest risk that the market has right now is actually at the end of this month. At the end of this month, you'll see more states start to open up, in my opinion. And so with that, maybe getting back to work, et cetera. And I always think about what I would call the middle seat test. How long does it take? None of us have ever wanted the middle seat. But how long now does it take till anybody is comfortable taking the middle seat? And in the middle seat, I just don't mean airlines. You can broaden that out to a lot of things. Talking about festivals, talking about going to a ball game, whatever it may be. So I think we face this big test because it's going to be, in my opinion, very difficult for stocks to continue to perform, because I just don't see the demand in the shorter term that may have been priced into some of these stocks on the optimism that people are optimistic we're going to get going. But at what rate? And it seems hard to believe that everything just picks up pretty immediately, because even if, tomorrow they told you guys, studio's clean, you can go back to work. I don't know that necessarily every business is going to say, well, let's run right back in, or let's run in with a full crew. You might start with 1 or 2 people and then continue to add people over time. So how long does that take then the market to get going?
JJ, it's Julia LaRoche. I think that's such an interesting point you just made about the middle seat test. That's something we'll definitely want to watch. Just kind of going back to the behavior of millennials, I was wondering if you could talk just about the activity that you all have seen, since we are all in pretty much work from home, remote lockdown environment. Is that kind of creating a boost in activity? Because look, we're not, at our desks anymore. We're not, trading during a lunch break per se, but are you seeing more activity because of that?
Well, yeah. And again, going back to the earnings we just released and those of our competitors, you are definitely seeing people more engaged with the market than they have been. And I think there's a couple of reasons for that. Number one, people are at home all day. And with that, I think people are I think that many businesses are going to say that their productivity is off the charts right now, because you are home and it's 7 o'clock at night. You're like, why don't I go take a look at this thing I have due next week? I may as well get it done today. And there's a lot of that. But what does that also mean? During the day, you may have a chance to look at your investments in a way that you haven't had the opportunity to before. So I think that that's actually helping people activity and helping people do more research into what they are going to invest in. So that's kind of an interesting dichotomy overall. It's kind of interesting. I shouldn't say we joke. One of the things that I think every business has to prepare for is the fact that when we go back to work, what's the first thing everybody's going to say? I want a vacation. I've been working nonstop and I've had nowhere to go. So I think, even in terms of when we get back to work, how is that going to affect productivity when everybody's back?
JJ Kinahan, TD Ameritrade Chief Market Strategist. Good to see you. Stay healthy. And just so everybody knows, that is Lake Michigan behind you. JJ was joining us from Chicago.
Guys.
Great
Have a
view.
great day. Thank you.
All the best to you. Want to turn our attention to some major news regarding Roche, the Swiss company announcing, along with the FDA, that they've got emergency approval for their rapid antibody test. And Anjali Kamlani spoke with Roche's CEO. Here's a bit of that discussion.
We have increasing evidence from physicians around the world that Actemra indeed helps patients who are severely ill and who suffer from pneumonia. And the mechanism of this medicine is that it dampens the immune response. So what typically happens if people get not typically, but what often happens if people get very ill, there's an overreaction of the immune system. So we have evidence that this mechanism is working. However, there are still robust, randomized big clinical trials going on, and we will see the results in June next month. So let's keep fingers crossed that this will also contribute for COVID-19 patients. It is complementary to antiviral medicines. Antiviral medicines you would typically take very early on, so that you can block the increase of the virus in the body. And this medicine would rather be used for patients who are at the later stage of the disease.
Absolutely. And one of the things that's been a concern and continues to be a topic of conversation, and this is stemming from pre-outbreak, is the idea of pricing of drugs. So what have you been considering when it comes to accessibility of this drug? Are you planning to donate or provide for free access to this if it proves effective?
We will certainly make sure that access is not a hurdle for Actemra in case it should be used in a broader way. What we also should consider, and that will also help us to take care of the financial burden for societies, is that typically this is a medicine which is used for diseases, chronic diseases, where you give this medicine many times, and the pricing, of course, is designed accordingly. Now, for COVID-19 patients, you only need one dose. So this in itself will limit the financial burden for societies. We will see how the clinical trials read out, how much the demand as a result of that will be, and then we will at any rate make sure that this medicine is broadly available for patients in need.
Let's bring in Angelique Kamlani to talk more about the discussion you had with Severin Schwan. Tell us more about this.
Right. So he's talking in that clip about the the treatment that they're currently testing. So we know that Gilead got their emergency use approval for remdesivir, the antiviral. And then we had Dr. Anthony Fauci talking about how that opens the door to see what other drugs either A, work comparatively, or B, could work in parallel with the antiviral. And this drug could work in tandem with Gilead's antiviral, is what Schwan was just saying. They've already seen the sales of that drug spike 30% year over year, according to what he was saying during their earnings call recently. And so that really opens the door to see how much more effective drugs like this are going to be on the market, Adam.
What about the testing issue and the FDA approval of the rapid testing? Because I was reading that they've already got the device that reads the results in 100 labs here in the United States. How quickly could this be accessible to all of us?
So they're already shipping out those testing kits. And according to what he was saying, when I did ask him about that earlier, there is no concern about a shortage of supplies in the same way that there was for the nasal swabs. However, he still holds the idea that it should still be restricted on who gets access to this. While it can be available broadly to the public, it's one of those things that should start off with access for healthcare workers and those on the front line and those who are more severe or more vulnerable to the disease, to make sure that they haven't had it and know whether or not they need to protect themselves. Because as we recall, the antibody test is going to indicate if you've had the disease of the virus, or compared to the PCR test, the nasal swab, which will tell you if you currently have it.
Angelique Kamlani, thank you very much. We're going to turn our attention to Disney. I believe they report tomorrow, but already some concerns about what they might be telling us as they try to get that business righted. Dan Roberts covers Disney for us and a lot more, so let's bring Dan in to talk about that. There's also this lawsuit against Quibi, but first, let's talk about Disney, Dan. It's going to be a tough quarter.
Yeah, it is, Adam. I mean, all of the U.S. parks are shut down, and it's not just the parks and resorts. I mean, it's the cruises, it's the studio division, because they can't film new projects. A number of these highly anticipated Marvel shows, like Loki and Falcon and the Winter Soldier, that were headed to Disney Plus, they weren't quite done and polished, and so those have had to be delayed. Now, luckily, The Mandalorian season 2 is done and ready, and that's going to hit the service in fall as planned. But every pillar of Disney's business right now, I mean, even ESPN, obviously, and ABC, those are owned by Disney, and there's no live sports. So this is not going to be a great earnings report. It's the Q2 earnings, so it's February, March, and April. Some of these other companies we've heard from recently, Adam, their earnings report has covered the last 3 months, and so coronavirus didn't really hit until mid-March. And so maybe it wasn't so bad for a lot of these companies. Disney's earnings report is probably not going to be so great. And today there was a Moffett-Nathanson downgrade of the stock to neutral from buy. A lot of analysts are predicting that even once the parks are allowed to reopen, they might see a huge hit in foot traffic that could last all the way till 2022 because people might still be concerned. Obviously, coronavirus isn't going to go away completely. And I think that's a little far to project out. I mean, I think if people have been waiting to go to a Disney park, they're still going to go. But it is true that it's hard to imagine Disney parks with social distancing. It's kind of antithetical to the idea of a Disney park. I mean, there's kids running around everywhere. They're touching all kinds of things. So tomorrow's earnings report from Disney is probably not going to be great. I do think one silver lining might be that Disney is likely to update us on the number of subscribers Disney Plus has. And the most recent number was 50 million. I imagine now the number might be incrementally higher.
Hey, Dan, do we know who's going to be on the call today? Because there's been a lot of chatter about Bob Iger's current role at the company. Of course, he was going to step back and allow Bob Chapek to take over as CEO, but now there seems to be maybe not uncertainty about their technical roles, but uncertainty about their effective roles.
Yeah, Julie, look, Bob Chapek is still the CEO. There was all that coverage about how Bob Iger has taken back the reins. And then we saw the same kind of stories about Jeff Bezos at Amazon. Now, of course, the difference is Bezos is still the CEO. But neither of those stories surprise me. And of course, the person who is the face of the company has taken the reins again internally and reasserted control amid this very clear crisis. But it isn't as though Disney has come out and said that Bob Iger is now the CEO again. Maybe he is CEO in all but title, but he's no longer got that title. The CEO is Bob Chapek. I imagine both will be on the call, but I haven't seen the actual answer to that. You know, if Iger is the one answering the analyst questions, then that would be sort of like the company making clear, okay, he really is the CEO again. And, you know, I think that there's a reason they haven't come out and said, okay, Iger has actually taken back the role. So I imagine that Bob Chapek as CEO is going to be on that call as the CEO of the company.
Dan, let's turn our attention to this Quibi lawsuit. Paul Singer's hedge fund, Elliott Management, is helping finance a suit against Quibi. The suit is coming from a New York-based company, Echo. You might not have heard of Echo, but it's about their technology and the way Quibi is using their technology. Can you tell us more about this?
Yeah, it's a patent infringement lawsuit, Adam, regarding Echo's technology. And of course, what's so interesting about this is we're talking about mobile tech, and Quibi launched amid coronavirus. Now, the whole rub of Quibi was that it's mobile only. The idea was it's quick bites. None of the videos or episodes are longer than 10 minutes. And all of the advertising before coronavirus was showing people watching Quibi videos on their phones. So maybe you were on the subway, maybe you were standing at the bus station, maybe you're in the bathroom. But launching amid coronavirus, it was a big drawback because people aren't really watching things on their phones right now. I mean, obviously we're all using our phones, but since stay at home is happening across the country, people are watching shows and movies on full television sets.
Yeah.
So we faced quick pressure to launch on TVs. So there is some irony here to the idea that it's now facing a potentially $1 billion lawsuit over mobile tech and infringement from Elliott. Of course, Elliott, a very common foe for a lot of companies. You know, Elliott is the company that came in and shook things up recently at Twitter and finally came to a deal with Jack Dorsey to keep Dorsey as CEO.
Is there any kind of review of Quibi and what they're offering? Is there anything worth watching? Are they going to make it past COVID-19?
You know, it depends who you ask, Adam. You know, they came out recently and said they had a few million downloads, which I guess was good after only 2 weeks. I think the number was like, 2.8 million downloads, but it's hard to compare it to Disney Plus, which I mentioned has 50 million, and Netflix. Of course, that's really not a fair comparison yet. It's not apples to apples. Quibi's brand new. Man, coronavirus really crimps this service because a lot of the daily shows that were planned for Quibi are from big names like ESPN and other daily news programs, but they can't be done amid coronavirus. Now, on the other hand, a lot of people still think that once we emerge from this, it's a good idea, that it's a fresh, unique idea in the streaming wars because it's short, little, digestible videos on mobile. So the jury's out. Personally, I have not signed up. I'm not that interested.
Dan Roberts, not signing up for Quibi, but you're going to Disney, aren't you? You've got a trip planned to Disney.
I hope the parks reopen, yeah.
When we come back, thank you, Dan. When we come back from break, we want to talk about an issue that is building and going to possibly get worse. That's renters and mortgage payers delaying those payments. More after this. We want to talk about what could be a growing housing crisis as we approach August, when a lot of the measures that have been put in place, eviction delays and delays on paying rents, will expire. The reason we mention this, 3.8 million homeowners have sought mortgage relief. And according to the latest data, almost 10% of renters have missed or only made a partial payment. Usually it's about 5%. So that number is growing, may not expect it to be better. Bringing into this discussion, my partner, Julie Hyman, as well as Julia LaRoche and Brian Chung. Julie Hyman, what do you do with this? Because there's this movement nationwide to maybe, quote, cancel rent.
Well, there are municipalities and some banks that are doing this, right? And certainly we've seen that increase in mortgage forbearance requests, which I know is something you're also watching, where if you have a mortgage, you call the bank and say, can you put off my payment this month and tack on to the end of the mortgage? What I'm really curious about as we continue to watch this phenomenon is the ripple effects, right? Because you have two kind of ripple effects. If people aren't spending on rent, what kind of effect does this have on their spending? How are people prioritizing their spending? What are they spending on and what aren't they spending on? And the other question is, what is this going to mean for the companies and entities that own these buildings? If you're talking about apartment buildings in particular, there are a number of large publicly traded real estate investment trusts that own them. Equity Residential, I believe, is the largest of those, but there are a lot of private investment corporations that have invested heavily in real estate over the past several years. Who holds that? And what is the ripple effect going to be among those entities? Is some of it also in pension funds or in other types of holdings as well? So I think there are going to be a lot of questions about all of this.
Yeah, and guys, think about it. We just had David Zervos from Jefferies, the chief market strategist, on this program, and he was talking about, maybe what the Federal Reserve can do. And I'd love to hear Brian Chung's thoughts on this. But specifically, Zervos was pointing out, if you go back to the last crisis, yes, a totally different crisis, but there was this kind of perception and I guess perception of the Fed that they were a bit more Wall Street focused than Main Street focused. And Zervos, who is an alum of the Federal Reserve himself, said, one of the ways they can kind of repair that image is to focus more on Main Street, specifically with the residential mortgages. So, Brian, I would be curious what you think and if that's something that the Fed might actually act on.
Yeah, I mean, there was a lot of chatter, Julia, a few weeks ago about whether or not the Fed would set up a 10th liquidity facility to specifically deal with mortgage servicers. So we have to keep in mind that as these, landlords are unable to collect on any sort of rent, it all ripples up, right? And they need to pay back the person that actually underwrote the mortgage. In many cases, the bank that actually underwrote it shops it off to some other mortgage servicers, to a non-bank, like, for example, Rocket Mortgage, right, which is owned by that privately owned company, Rock Holdings, owned by Dan Gilbert. So there's a lot of concern about all the different moving players there. And you also have to consider the FHFA, right, their role in all of this with Fannie Mae and Freddie Mac, and how those companies have quasi companies, if you will, have been in conservatorship ever since 2008 and 2009. They're now left holding the bag if those mortgage servicers can't collect on those mortgage payments. So the FHFA on their part has tried to do some efforts to increase liquidity in the area by actually allowing companies. They announced this about 2 weeks ago. They said that a servicer can advance 4 months of missed payments on a loans, and then after that, they'll have no further obligation to advance any sort of scheduled payments. So it seems like there is some risk taking from the government on that end. But again, still questions about whether or not the Federal Reserve needs to provide their own facility. There's a lot of waffling down in D.C. between the Treasury, the FHFA, the private mortgage servicers, and then the Federal Reserve to try to figure all of that out. A very complicated story, as you can understand.
Brian, Julia, and Julie, we're going to keep looking at this, especially as we approach that August 1st seems to be kind of deadline, but something we have to look at right now. Our trade war with China, it is still alive and essentially well, with the president threatening more tariffs on Chinese goods that come into the United States. When we come back, we're going to be speaking with the president and CEO of the American Apparel and Footwear Association. Welcome back to Yahoo Finance. We're watching the market sell off right now. The S&P 500 is off about 15 points. The Dow is off roughly 230 points. NASDAQ is trading higher now, up almost 30 points. And crude is also trading higher, about 0.5%. Want to turn our attention to the trade war with China because President Trump and the administration are threatening additional tariffs on $370 billion worth of Chinese goods. You may have forgotten that there are already tariffs in place. For instance, a 25% tariff on hats and handbags, backpacks, gloves, travel goods. That's already affecting the retail industry, and we saw J.Crew filed for bankruptcy this morning. To discuss this and where we go from here, we want to bring into the stream Steve Lamar. He is the president and CEO of the American Apparel and Footwear Association. Steve, it's good to see you. And this is, it's an understatement for retailers. They missed the spring season of selling. They're going to miss back to school selling. And with the inventory they've already got in place, it looks like a horrid nightmare that's coming at your industry.
Adam, thanks for having me on the show. We're trying to save American lives and American livelihoods, and taxing U.S. companies that are supporting those U.S. jobs, that are rushing to make and deliver PPE items, personal protective equipment, things like masks and gowns to our hospitals and doctors is not the way to do that. We paid about $1.5 billion in tariffs last year. Can you imagine how many more jobs we would have been able to keep on our payroll if we'd been able to direct that money to payroll, or if we could have been able to not pay those additional tariffs on masks and gloves. Incredibly, we're still paying tariffs on those items. How many more of those items we could have been able to deliver. So one of the things we're asking for from the administration is please remove that crushing tariff burden from us, either in the form of deferral or in the form of actually suspending some of those tariffs.
Tariffs notwithstanding, hi, Steve. It's good to see you. It's Julie. I'm sure that many of the folks who are watching, as well as probably you yourself, are getting increasingly sort of panicked offers in our inboxes from various retailers with ever deeper discounts and attempts to sort of get us to buy the excess inventory that they have on hand. If you could just sort of give us an overview of how dire things are. We have J.Crew as one example, but what are you hearing from your constituents right now as to how much longer they're going to be able to keep this up?
Yeah, things are pretty dire. I mean, look, the retail industry, they did their part by closing stores, by making sure their consumers and their workers were safe, by practicing their social distancing requirements from a very early stage. Back in March is when we started that. And we're looking forward to that restart, that safe restart of our economy, but that's going to take time. It will take a number of months probably before we can get all of the stores back open in a safe manner. And once that happens, it will be time before that demand begins to happen. Retailers, they're important for two ways. One is, we're a consumer-driven economy. So as consumers come back into the stores, as it's safe to do that, we're going to be looking for retailers to provide those products that they're going to want to buy. But retailers are also a source of jobs. 1 in 4 jobs in the U.S. economy are supported by the retail industry. If those retailers are if they're able to stay intact through the provision of liquidity, and we've been making a lot of recommendations on what some of that liquidity could look like, then they'll be around so they can retain those jobs and they can rehire those jobs as America, gets back to work.
Steve, I'm curious because you have proposals to the AAFA to modify the CARES Act to provide liquidity to companies. But one of the issues facing retail is the fact that the actual amount of space devoted to retail was greater, according to some guests on our program, by a factor of 2 to 1. And that what we're witnessing now, although painful, is an accelerated decoupling from that. Wouldn't that be, in the end run, a good thing to bring into line the appropriate amount of space to the appropriate amount of demand for retail?
Well, I think one of the things you see in retail is we're constantly going through that evolution where there's either not enough retail or there's too much retail. And I think that's a cycle that's going to continue, the current COVID crises notwithstanding. But what we're looking at is trying to find a way of stabilizing both the retail employment engine and empowering that engine to to continue to grow in the summer and in the fall as America gets back to work. And and also making sure that as consumers, we are a social people. We like to get out. We like to visit with people, that there is a safe place for folks to do that when they're out shopping as well. It's not all just online. It's brick and mortar too. And that's going to be an important function, an important part of our retail ecosphere going forward.
Yeah, Steve, it is interesting. You mentioned we are a consumer-driven economy. 70% of GDP is from consumption, and that you guys are a huge source of jobs. I didn't realize that 1 in every 4 jobs is in the retail sector. I guess if you had to kind of think about what the future looks like when we come through the other side of this, what does that look like, and how would that experience be different, not only from the employer side, but just the consumer side? What can we expect?
I think we're probably going to go through a period where some of these social distancing requirements are still part of the norm. Consumers are going to feel comfortable doing that. I think basic health and safety requirements are going to dictate that. And we don't know how long the COVID crisis will be with us. Is it something that is for a few more months or for a few more years? And companies and consumers are going to probably exercise the better part of caution to make sure that that they're safe and healthy, that the workers are safe and healthy. The retailers are going to make sure that the consumers are safe and healthy as well. So I wouldn't be surprised if we continue to see some form of social distancing retail for a while. One of the things we're talking about now is shopping by appointment. Is there an opportunity to make appointments to shop? And companies are actively exploring some of those software technologies to see whether that's a way to help a faster but safer restart.
Steve Lamar is the president and CEO of the American Apparel and Footwear Association. Always good to see you. Thank you for joining us here on Yahoo Finance.
Thank you.
When we come back, Warren Buffett said he would not sell his airline stock. And then in late February, Berkshire Hathaway actually bought more shares of Delta. Guess what? They sold everything. More on that with Andy Serwer right after this. And welcome back to Yahoo Finance. We're watching markets for you right now, and the S&P 500, it's off just about 10 points. The Dow is off. Now it's actually pulling off some of its lows, but it's still down about 190 points. NASDAQ is trading higher, up about 45 points. Of course, Warren Buffett, there was the Berkshire Hathaway shareholders meeting, which you got to see here on Yahoo Finance, and our Andy Serwer, editor-in-chief, was there. although it was a much different meeting. And I'm going to bring Andy into the stream right now as we throw to a soundbite from Warren Buffett talking about what's happened to the airlines.
The world changed for airlines, and I wish them well, but it's one of the businesses we have. We have businesses we own directly that are going to be hurt significantly. The virus will cost Berkshire money. It doesn't cost money because our stock and various other businesses moves around. I mean, if XYZ, which is, say, is one of our holdings, and we own it as a business and we like the business, the stock goes down 20 or 30 or 40%. We don't feel we're poor in that situation. We felt we were poor in terms of what actually happened to those airline businesses, just as if we'd owned 100% of them. So that explains those sales, which are relatively minor, but I want to make sure that nobody thinks that involves a market prediction.
And Andy Serwer joins us now with more on this. Were you surprised by the fact that they had divested from all of their airline holdings?
Yeah, well, there's sort of two schools of thought on this, Adam, because we did get an indication in a filing a couple of weeks ago, I think about 10 days ago, that Buffett had exited airline stocks, but we didn't know the order of magnitude. But, you know, this is just a complete kiss off, right? And he says, I wish them well. Wow. Who says that to you, right? That's not a good thing. But then on the other hand, Buffettologists will tell you that this is how he rolls. In other words, he doesn't tiptoe in or out. He just goes in whole hog. And then when he changes his mind, he's out. But, you know, he did like a Keynes, right? When I get new information, sir, I change my mind. What do you do? And he changed his mind because back on March 10th, he said he wasn't selling airline stocks. Did now.
Hey, Andy, obviously it was a very different meeting. He didn't have that sort of energy from all of the people to feed off of in the way that he has in the past with all the Buffett heads descending there on Omaha. But even given that, I'm curious what you made of his tone and sort of just his vibe, for lack of a better word, this year compared with the past.
Well, you know, I saw him off camera a lot. Julie. And, you know, he was a sort of usual self-joking with Greg Abel and some other people. I mean, he's always, you know, his demeanor is pretty consistent. But I have to say, you know, a lot of people initially were, you know, sort of took the bullishness from the message of never bet against America, never bet against America. But I looked at it kind of differently because I think he was really using that to mitigate, which against what was otherwise a pretty negative message, which was, I sold out all the airlines. They're not coming back for a long time. And we don't know what this virus is going to do to the economy. I don't think it's going to be a good scene for the next year or so plus. And by the way, I'm not buying back Berkshire stock because I don't think it's particularly undervalued right now. So, you know, yeah, he's going to say long-term, I'm still bullish.
Hey, Andy, I think that's an interesting takeaway, too, is kind of reading between the lines as to what the undertones of the message really was. I guess, you know, just given where we are in this moment, how important do you think it was for people to hear from Buffett, specifically these messages? Just want to get your read on that, just based on the audience that we had watching.
Well, you know, I think people were really looking forward to that. I mean, our numbers are, you know, extremely high. We're going to release them at some point in the near future, but they were up a lot. You know, on the one hand, what else are you going to do? Can't go outside. But I think people were really looking forward to hearing what Buffett had to say. And, you know, Becky Quick pointed out to me by text that he had been sort of unusually quiet during this period. I mean, you might have expected him to come out. He did a big op-ed, you remember, in the fall of 2008, famously. And here he didn't. I mean, I think there was so much going on, Julia. It's so new that he just didn't feel prepared to go out there. I mean, you know, that one point he made also about, well, how come you didn't buy a lot of stuff? And he said, because the Fed came in too quickly and too strongly. I mean, he was sort of sorting that out real time. How is the disease unfolding? Real time. What is the economic implications? Real time. And so I just feel like he was waiting, and he knew he had this big forum. So when he did that, I think a lot of people were very interested to hear what he had to say. And I think that he didn't disappoint. And it was a pretty interesting 4.5 hours of talking by an 89-year-old guy, right?
Andy Serwer, our editor-in-chief, thank you. And don't forget, you can read several recaps of what Warren Buffett had to say. Miles Udland has an article up right now, a subtle tone shift from Warren Buffett. Andy was just mentioning there's a lot about what Mr. Buffett had to say. It's on the Yahoo Finance page right now. When we come back, we're going to be looking at some things you should be doing to prepare for your retirement, whether you're one day from that moment or several years. All right. A lot of people are concerned about their financial futures, and that includes people who are very close to retirement. Joining us to discuss this is Chris Hogan, author of Everyday Millionaire, and also help us address how a crisis like COVID-19 can change people's plans for retirement. Chris, it's good to have you here. Thank you for joining us on Yahoo Finance.
Well, thank you.
I want to ask you, one thing you pointed out is that even if you're 1 year from retirement, there are opportunities for investment right now. So if you're 1 year from retirement, where are those opportunities?
Well, the opportunities will lie inside the market itself. I mean, right now we're dealing with unprecedented times. We've got high unemployment. We've got wild market swings as we wrestle with this pandemic. But people that are a year out from retiring, they're going to have to adjust their expectations. You know, some of them may move forward and take an early retirement. Others may move forward, take an early retirement, but also have to work a part-time job. But I'm also talking to people that are regrouping and changing their expectations. They're planning to work another year or two longer while they allow this market to be able to really correct and really continue to move forward.
Hey, Chris, it's Julie here. It's good to see you. So what happens if it doesn't? Or what happens if they're, say, not able to find additional work if they need it? Are you seeing also people sort of not take out literal insurance, but what are the backup plans that you're either hearing about and or advising people on?
Yeah, and this is really real as people are really playing out those scenarios. But they're kind of walking through and looking and they're going, okay, what if it doesn't come back in 2020? And, you know, you can play these what if scenarios till you're blue in the face or until my hair grows, one or the two. But I'm advising people, let's control the controllables. And what I mean by that is looking at where you are, assessing your risk tolerance, looking at your asset allocation. Are there any changes that need to be made? But I'm warning people, do not make knee-jerk decisions without sitting down and talking to your investment professional, because then you would miss out on that rebound that is going to come. And here's the reality. We all know the market is going to come back. I mean, we can take a look at where we were in January and February, and just 45 days later, here where we are. And this is because of the pandemic. But we've walked through this with SARS. We've walked through this with Y2K. We walked with this in 9/11 and even the Great Recession in 07 and 09. And so we know it's going to come back, but it's these people that are in this retirement phase or close to it that are really having to adjust their game plan.
Hey, Chris, Brian Chung here. So a bit of an uncomfortable conversation, but some people who are particularly financially distressed might be considering needing to tap into their 401k or into their retirement plans to get funding now, to get financing now. I mean, if people are considering doing that, what's your advice? Is that something you would advise to do if people need rainy day money?
No, great question. I am literally trying to help people avoid tapping into their retirement as much as possible. I'm telling people the only two reasons I ever give people to tap into that is to avoid a foreclosure or to avoid a bankruptcy. But it needs to be a last-ditch measure. And I know with the CARES Act, they removed the penalty, but they didn't remove the taxes, and they haven't removed our need to grow money, right? I mean, we all know compound growth is how money grows, but inflation, it means the cost of living is going to go up. So I'm advising people to go into conserve mode, really take a look at where you are, what you're paying for, delete the subscriptions or the unnecessary, really be mindful of taking care of the things that are needed. I call it the four walls. That's your housing, your rent or your mortgage, the utilities surrounding that, food, and then keeping gas in your vehicle. But really kind of go into constraint mode. I've even advised people to take on part-time jobs before tapping into their 401k or 403b.
Chris, I'm curious, you talk about people still investing if they're working 15% of their income, but a lot of people have taken pay cuts.
Yes.
That's not unheard of, 25% for some people. Still put 15% in? I mean, it's much tighter under those circumstances.
Oh, it is a lot tighter. You're absolutely right, Adam. And in that constraint, if your income has been cut or your hours have been cut, you've got to take a hard look at where you are. 25% is a significant cut, but I still want people investing for the future. But here's what I've told some people. If your hours have been cut significantly or you've had a job loss, you can't attack debt or invest right now. Right now, what you're trying to do is stabilize your financial situation. So you would pause doing all of that right now until you got your income more stable, then look at going back and investing.
All right, Chris Hogan is author of Everyday Millionaire. We appreciate your being here with some insight for people as they plan for retirement or get ready to retire. All the best to you.
Thank you, my friend.
When we come back, we're going to check markets again. Welcome back to Yahoo Finance. We're watching the markets for you, and we are off the session lows today, but not by much. Jared Blickreed joins us now with the latest on what's moving these markets.
Yeah, Adam, we're looking at a mixed market right now. The Dow is underwater, down about 180 points, and the Nasdaq is in the green by about 0.2%. The S&P 500 down 0.25%. Here is intraday price action. We gapped down, recovered some losses, at least in the S&P, and we're just kind of hovering not too far from the unchanged line here. If we take a year-to-date look, we can still see that we're underwater by about 12.6%. We did note that a lot of shorts were put on last week between 2,900 and 3,000. That's this level up here that we reached on an intraday basis and also overnight in the futures. And we're just waiting for that next headline to see what comes next. I think the big one's going to be whatever Trump decides to do with respect to China, or maybe nothing at all. Here's the VIX index. We can see it's climbing towards 40 now after hitting about 30 last week. And we can also take a look at chip stocks. They are outperforming today, which is nice to see. Still underwater by about 11% year to date. And let's take a look at some of these sectors that are leading today. Tech doing pretty well. It is the biggest outperformer along with energy. The other ones are in the red. Taking up the rear here is industrials, and we're seeing Caterpillar lead the charge down on that, as well as financials. Those are also underperforming today. Here's a look at our Dow heat map. And we can see Microsoft in the upper left, that's up 1.8%. Apple up nearly 1% as well. Walmart in the green, up 0.2%. And talking about Caterpillar here, let's take a look at that chart. That's down about 4% today, still off 28% year to date. Boeing as well, that is off 4%, and Disney off 3.5%. I want to get to our Yahoo Finance premium idea of the day, which is Facebook. And this comes from a fundamental call by Argus Research, and they are saying that it is in a bullish trend, and they have raised their long-term price target to 240. So right now it's at about 204, and that would be a 17% increase. So let's take a look at the chart here and do some technicals. And they're also saying while Facebook weathered a precipitous decline in advertising demand at the end of the first quarter 2020, it still reported 18% revenue growth. And they're saying, although not immune to the effects of COVID-19, the company has hardly paused, made a major investment in geo platforms in April, and continues to roll out new services. Now, they also raise a red flag, and that would be the regulatory investigations from the FTC, the Justice Department, the House Judiciary Committee, and attorneys general from 40 states. But looking beyond that, they are looking for that price target of 240, and that is a long-term play. If you were looking to protect yourself with a stop, you could do it under the 200-day moving average at about 190. That would come in right here. And if you'd like to sign up for Yahoo Finance Premium, you can get a 14-day free trial at our site. Adam?
Jared, thank you very much. As we head to break, stick around. We have more from Warren Buffett's Berkshire Hathaway shareholder meeting this weekend, as well as Torsten Slok, Deutsche Bank Securities chief economist, on a timeline for reopening not only the U.S. economy, the global economy.
You're watching Yahoo Finance Live. I'm Julie Hyman. Thank you for joining us. We've got a mixed picture for stocks today. The S&P 500 down about 1/3%. The Dow falling by about 0.9%. However, the NASDAQ is higher today by 0.6%. So not as much sort of decisiveness being exhibited in the market today. We've got a number of headlines that we're tracking. Warren Buffett saying at Berkshire Hathaway's annual meeting over the weekend, confirming that his firm has sold out of all of its airline holdings. Airline stocks are falling in today's session. Tyson Food shares are also under pressure after that company's earnings fell by 15% amidst production disruptions. All of this as we are seeing some states begin to reopen. Florida becomes the latest state to begin a phased-in reopening today. And speaking of phase-ins, Carnival, the cruise says it's going to start to phase in new cruises starting in August. So that's something to keep an eye on as well. Something else, a historic thing happening today. The Supreme Court is going to be hearing its arguments by teleconference, and the public can listen in. Obviously, that's the first time that's ever happened. Among other things, they're going to be looking at a case involving disputes over President Trump's financial records. And speaking of President Trump, he has been doubling down or reopening criticism of China and what he says was a cover-up of the early reports of the virus. He is now floating once again some kind of tariff action, increased tariff action against that nation. And the latest in the numbers on coronavirus, 3.5 million cases now total worldwide, according to Johns Hopkins University. 1.2 million of them nearly are in the United States, and the worldwide death toll at 248,000, with nearly 68,000 of those in the United States. One point of good news, however, out of Governor Cuomo's daily presser regarding New York State, as of May 3rd, new deaths in the state at 226. That is the lowest since the end of March. So we will see if that trend does continue. I'll be joined by my co-host Adam Shapiro over the next hour to discuss this, as well as Yahoo Finance's Rick Newman and Dan Howley. But I do want to get to Buffett, first of all, because he not only talked about airlines, he talked about the general state of the markets in the U.S. and the economy, and expressed a lot of uncertainty with regards to our trajectory.
I don't know. And perhaps with a bias, I don't believe anybody knows what the market is going to do tomorrow, next week, next month, next year. I know America is going to move forward over time, but I don't know for sure. And we learned this on September 10th, 2001, and we learned it a few months ago in terms of the virus. Anything can happen in terms of markets. And if you can bet on America, but you have to be careful about how you bet, simply because markets can do anything. On October, whatever it was, in 1987, October 11th, I believe, Monday, markets went down 22% in one day. In 1914, they closed the stock market for about 4 months. After 9/11, closed the market for 4 days. We hustled to get it going again. But nobody knows what's going to happen tomorrow.
So Buffett sounding fairly grim there, even as he talks about don't bet against America, about the uncertainty that's occurring right now, even as we get, as I talked about, reopening. I should mention as well, coming from the press conference for Governor Cuomo, he talked about that May 15th is the date on which the regions of New York can begin to discuss a phase reopening, but they have to meet certain criteria, including, he talked about, 2 new patients per 100,000 residents. So only 2 new patients per 100,000 residents. So still some criteria to meet here that are perhaps quite steep. I want to bring in Torsten Slok now to talk about reopening and the economy. He is the chief economist at Deutsche Bank Securities. Torsten, it's good to see you. If you can unmute yourself, we can talk about what this economic situation will look like. I know you're you're focusing on states and regions across the United States and the unemployment picture. What then is this sort of patchwork reopening going to mean for a potential regrowth in the economy?
Yeah, this is really important. I mean, one very important dimension that makes today very different from 2008 and 9 is that the unemployment rate in some states has gone up much more than in other states. If you take Utah, take South Dakota, the unemployment rate there is only like 6, 7, 8%. But in other states like Michigan and Pennsylvania, the unemployment rate is 25, 30%. So that means that there are huge, huge differences in the starting point for this recovery. In some sense, you could almost start thinking about, well, which consumer in better shape? And those consumers that are in better shape should generally also imply that you should have a faster rebound and therefore more cash flow coming to the bottom line of corporate. So therefore, the very important part of your question, Julie, here is that yes, and what today's so different is that some states did go into a lockdown and others didn't. And those that didn't now look better simply because they did not see such a significant increase in the unemployment rate as we have seen in other states. And that makes the starting point for where we stand right. We probably have the worst behind us in terms of economic data, but makes the starting point very different from 2008 and 9, where everything went up and down in sync. The unemployment rate went up and then it went down.
Torsten, it's Adam. Good to see you. The worst may be behind us at this point, but this was so dramatic and so quickly. And with the places that are reopening, they're limiting capacity at 25%, even at 50%. You can't make a profit. So what kind of further stimulus is this economy in the U.S. going to need from Congress?
Absolutely. So, I mean, we clearly, with the unemployment rate, we went up the elevator and we're definitely going down the escalator. It's going to take quite some time to get the unemployment rate down. The Congressional Budget Office estimates that the unemployment rate at the end of this year will be 10%. So in other words, if we do get 18% on Friday, where the numbers, which is what we expect, it will take quite some time before we get back to the 3.5 that we had in February. So to your question, what is needed? I mean, the conversation is beginning to change away from just liquidity support, just supporting households with some temporary money, just supporting small businesses with some temporary money and loan, basically now to a conversation about solvency. Are so solvent the problems we're seeing in mortgage markets and commercial real estate? Those solvency conversations are opening up questions about maybe we saw more people not pay their rents on April the 1st and on May the 1st. But if you get to the 1st, you get to the most important indicator is the 90-day delinquency rate. And the 90-day delinquency rate across different kinds of asset classes does become very important. So that's why when we're looking out for more signs of this switching from a liquidity conversation to a solvency conversation, we're looking for underperformance of auto loans, credit cards, commercial real estate, residential mortgages. We're seeing the cascading showing up elsewhere. And this is back to your question, probably a good indicator for whether more support is coming from Washington, D.C. or not.
Torsten, hi, Rick Newman here. I want to ask you this question about, is the worst really over? Some of the analysis I've seen shows that the overall rates of infection and death in the United States are improving largely because they're improving in just 3 states here in the Northeast, New York, New Jersey, and Connecticut, but that the measures for many of the other states are actually getting worse. So what are you actually modeling when you're trying to figure out where this is headed?
No, you're absolutely right, Rick. That's why for equity investors and credit investors, it actually becomes a whole new dimension of investing. The things that we've been talking about for many other factors driving markets, and a whole new factor driving markets now is exactly this issue of asking the question. The company I'm looking at, that in the tri-state area, where you probably will see now, at least in the next few weeks, when the numbers are down, you will probably see some signs of corporate cash flows beginning to come back. Whereas in those states that are still seeing rising numbers in terms of the number of new coronavirus cases, they're probably going to be at least more vulnerable from that dimension. So right, it is a whole new thing to begin to think about in which states are we seeing the virus curve flattening out and which states are we not. And this becomes critical also in the conversation about the reopening and this issue of what is the starting point with the unemployment rate. So that's why, from equity perspective, there are really 3 dimensions, namely, who will first reopen that, of course, will be helpful, broadly in terms of thinking about what are the opportunities for seeing cash flow. But the next question is, well, what is the unemployment rate in those countries? What are consumers' purchasing power, if you will, if they can really go out and buy, or if they can't go out and buy? And the third and final thing is also this, well, okay, that's all helpful, but if the curve does begin to reaccelerate, to your point, you could get worried about some of these states that are more relative to others.
Thorsten, this is Dan Howley. I kind of want to go into whether or not we'll start to see consumers come back right away, or if they will kind of slowly trickle in, kind of getting testing the water to see whether or not it's safe to go to certain areas. I guess, how big of an impact will that have on the balance sheets of companies who are relying on people to come in droves to prop them back up from the losses that they've suffered?
Absolutely, Dan, and this is a very important question. So people that are more than 65 years old, they account for 20% of consumer spending. People that are more than 55 years old account for 40% of total consumer spending. And given the risk to the older generations, there's significant risk to consumer spending overall. And this is not only restaurants, cruise lines, and airplanes. This is also risk to durable goods. We're already seeing in some of the daily data from the auto numbers that people that are more than 55 years old, they are not out shopping cars the way the younger generations are. So you're absolutely right, Dan, to your question. Not only will we see some health requirements about distancing in crowds, sporting events, concerts, airplanes, but you will also probably see reluctancy, in particular among older generations. So that's why this gets back to that this is just a whole different dimension of investing. This is why the quant models and all those who just have simple mathematical frameworks and sophisticated mathematical frameworks for thinking about investing, they are being challenged quite a bit at the moment, because we have these whole new ways of thinking about what are the opportunities in the stock market, and they are driven very importantly by your question, namely, what are the drivers which determine whether consumers come back, and do I have those drivers in my framework for when I think about whether companies are going to do well, and in particular also this issue about regional aspects of which companies are present in which regions. A restaurant chain, is a chain present in the tri-state area, New York City area, or is it present in parts of the country where you're not going to see the same growth rate come back as quickly?
So, Thorsten, given what you're saying, remind us, because I think we talked about it the last time we spoke with you, what your GDP forecast is, and whether you have a range for that forecast that is wider than usual because of all of these factors that you're talking about, from regional effects to what do rolling reopenings look like, to what does consumer spending look like, and do people come back? What kind of predictions are you able to make right now?
Absolutely. I mean, I think the clip you just showed from Warren Buffett illustrates everything. We know what will happen over the next week. That's why putting together a GDP forecast for the Fed, for us, for the Congressional Budget Office, is very complicated, because I just don't have a toolbox that's very equipped to understand these issues that we're talking about here. Namely, where in some states have a much higher unemployment rate and others have a low. What does that mean? What are the different probabilities of a second wave, not even in the fall, but even here in the short term? As we just spoke about, that the overall virus curve is barely beginning to move down in the US, is moving here where we are in the New York City area, but it's not moving down at the nationwide level. So you're right, GDP forecasts have those forecasts have a much wider deviation than usual, which complicates also a lot of these things. But I think from a market perspective, what's most important is that the Fed, and Jay Powell said this last week also, I know you also spoke about this, of course, on Wednesday and Thursday, namely that when we don't know what will happen, then Jay Powell is literally throwing the kitchen sink at it and saying, we just hope that we will not get the financial market turbulence to magnify the downside risks. It's sufficient. We already have a significant downside from the doors being closed in corporate America. So the answer to your question, Julie, is I really don't have a very good scientific model for what can tell you exactly what the unemployment rate will be. But I do know that the Congressional Budget Office says that it will be 10% a year, and I do know that this quarter will be worse. So what we are seeing at the moment is that it looks likely, the jobless claims, which is hard data, things are slowing down in terms of the deterioration. So it looks likely that the data is gradually getting better, but we have dug ourselves into a hard, deep hole here that it will take quite time to crawl out of. I think that's something that we can all agree on.
Yes, indeed. Unfortunately, that's one of the only certainties out there right now. Thorsten, it's always good to see you. Stay well. He's the Deutsche Bank Securities Chief Economist. Thanks, Thorsten.
Thanks for having me.
Well, as we talk about reopening by region, we also have to talk about reopening by industry, right? Because even the plan that Governor Cuomo just unveiled for a phased reopening has reopenings for things like construction that will happen first. We're joined now by Megan Fitzgerald. She is a private equity investor, author of Ascending Davos, and healthcare policy professor at Columbia University. She's also a former nurse. Megan, it is great to see you again. So one of the industries that we have to talk about reopening is healthcare, which is ironic, right? Because obviously this is an industry that has really been taxed by this crisis, but it's an industry that's only operating at a fraction of its usual self because of people aren't going to the doctor as much as usual. They're not getting elective surgeries. So what does that phased reopening need to look like?
Yeah, hi, Julie. And back to your GDP question, we just shed 43,000 jobs in healthcare, which you guys probably know better than me. I think that was one of the highest on record in decades. So what does the reopening look like? I think we have to get used to doing two competing things at once. First, we have to continue to test because we're grossly under testing how many people have COVID, and we have to accelerate the reporting of that test. Second, and this is somewhat conflicting, we have to be able to see patients who need essential care. Many patients, because of the closures and the hard shutdown, put off stents, put off biopsies. 25% of US patients that have cancer said there's delays in treatment. So I don't think those patients can wait any longer. And I think a slow and methodical opening of the US healthcare system is now warranted.
Hey, it's Adam. Thank you for joining us. What can we do to speed what you've just suggested up? Because in a lot of parts of the country, parts of Georgia, rural areas, hospitals were already closed. And people live in parts of Maine. They're 30 minutes to an hour from the nearest hospital. So what you're proposing doesn't happen overnight. How could we speed that process up?
No, you're exactly right. This is going to be a slow opening. It was a hard shut off, like a light. And most physicians and hospitals tell me you can't just flip it back on, especially when you furloughed so many healthcare workers. So 3 things I would offer that we can do. First and foremost, let's just be intellectually honest about what is elective versus a surgery that could wait, like cosmetic surgery. Second, let's look to best practices that are happening right now in local markets in Ohio, Texas, and Florida, where they're using the local physicians and the local hospitals to deem how to reopen. For instance, a local hospital knows if it has enough ICU capacity, should there be another COVID surge. They have a very good handle on their supply of medicines and PPE and whether they can see patients. They can alter workflows. They can alter transit patterns to even shut down parts of the hospital if they need to isolate patients. And finally, we really need to pick up on medical social distancing and make patients very comfortable that that is a new way to live. Your new waiting room is now your car. You're likely going to have to go in by yourself, wearing a mask. You're going to have to be spread out more than 6 feet. It's probably going to be more like 50 feet. Your temperature is going to be taken. And if you have a fever, most likely your procedure is going to be canceled. So we have to pick up on the medical social distancing because so many patients are afraid. Even if we open tomorrow, many still fear that they will get the virus, and they're trading that off between getting a stent.
Hey, Megan, this is Dan Halley. I just kind of want to ask, if you are going to a healthcare provider, getting tested, we talk about testing so much, but you can get a test and then the next day come into contact with someone potentially and become infected. So I guess, will there be a regular cadence to testing that people will have to undergo over time to ensure that businesses can reopen, that the economy can go back to some sense of normalcy?
Yeah, it's such a great question. Right now, 1 million people have the disease. So that means pretty much the entire population is still, quote, under observation, as we say in public health speak. We want 30 tests per 1,000. So that requires 30 trackers per every 100,000. And we don't have that many trackers yet. So I think we're going to be in a perpetual state of tracking for the next 2 years. And that's something people are going to have to get used to. As I understand, we've only tested around 6 million patients. So we have a long way to go. It's a good question.
Hey, Megan, Rick Newman here. I'm so intrigued by the idea of how the waiting room is going to change. I mean, sometimes that's just the most miserable part of the visit, worse than even getting probed by the doctor. You feel like you're sitting among sick people. So you said your car will be the new waiting room. What about in cities where people, don't pull up to the place in a car? And is there some way to just get rid of the waiting room forever and replace it with something better?
Now you're breaking news. We're going to get rid of the waiting room. Such a good question. I think we should use telehealth. As I mentioned before, I think a lot of patients are really scared, and you're going to have to do a lot of the triaging and pre-selling ahead of time with phone calls and telehealth. So is it possible to use your phone and telehealth to say, listen, we're ready to see you? You do this at restaurants all the time. You do this when you're buying supplies or phones. They're letting you know when they're going to be ready for you within 30 minutes. Why can't that now be applied to medicine? Because you're right. I don't know anybody that likes to wait around in the doctor's office, let alone now, waiting 20 feet apart from somebody else. So I think it's a really interesting concept you brought up, and I think it's going to require some clever solutions.
I really like that solution, Megan, for it. But I also want to ask about telehealth more broadly, right? Because it has been touted during this crisis as a really useful tool. I'm more curious about the limits of telehealth. For example, could be very useful for something like mental health counseling. But aren't there a number of things that can't easily be diagnosed using telehealth, first of all? And second of all, what about places that just don't have good broadband? Again, going back to a lot of rural areas of the US.
Yeah, it is not a wonder or a cure, telehealth. Listen, I think it can work in a lot of preventative disease, and a lot of times I think to help triage patients. But let's be honest, if you need a blood test, telehealth can't do that. You're going to have to go to a lab and get a blood test. And I think the more acute conditions, you need a visit. And that's part of what I'm pushing for is we need to open up people being able to go get a cancer biopsy, being able to get their gallbladder removed, a stent. None of that can be done on telehealth. But I think telehealth is good at the first part of the visit, the consultation, the dialogue. Hey, Julie, here's how it's going to work today. I'm going to call you. You're going to have 20 minutes to get here. You have to wear a mask. You can't come with somebody. So I think telehealth plays an important role, but by no means can it substitute a lot of the acute care that we're talking about today.
All right, Megan, it's always good to get some time with you. Hope to see you again soon. Megan Fitzgerald is a private equity investor, author of Ascending Davos, and a healthcare policy professor at Columbia University. She joined us from Florida. Thank you so much, Megan. Well, coming up next, we're going to get a further check on what's happening in the markets, as well as some of the changes that Uber is making to adapt to this pandemic. We'll be right back. You're watching Yahoo Finance Live. I'm Julie Hyman. I'm looking at shares of Uber today, which are down about 3%. The company is rolling out some new rules for what you have to do when you take an Uber, even as it's also reportedly making some changes to its business. Dan Halley's watching all of that for us. So perhaps not surprisingly, you're going to have to wear a mask when you get an Uber from now on.
Yeah, when you get an Uber, or if your driver is riding around in the Uber, they will have to wear a mask. And this is something that was originally reported by CNN, and they confirmed it with Uber, basically saying, "Look, we're going to figure out a way to ensure that our drivers, as well as riders, wear these masks when they're in the vehicles." Apparently, Uber is working on some kind of recognition technology where, similar to their Real ID technology, where they can identify the drivers themselves. The camera will scan the driver's face and potentially see if they have a mask on, and you would think give them some kind of alert if they didn't, telling them they need to. For riders, that's something that's totally different, though. You don't have a scanning technology built into the Uber app right now. Will you have to take a picture of yourself before you get in? Will drivers be able to kick you out if you don't have a mask on? These are all kind of questions that the company's going to have to answer, and how long this policy remains in place. There are certain areas that are reopening. Obviously, we've been discussing that. Other areas still locked down. They've seen, however, Uber ridership plummet dramatically as the lockdowns have gone into effect and coronavirus has spread throughout the country. Drivers need to get back to work. And will Lyft follow up with something like this? They don't have a business like Uber Eats to rely on. They are a pure play ride sharing platform. So it'll be interesting to see how all of this kind of comes together.
It is interesting that you mentioned Lyft. Those shares, by the way, are down about 8% today as I check my Yahoo Finance app. But what's also fascinating to me is now that Uber reportedly is going to scale back some of its Eats businesses in not the largest cities, smaller metropolitan areas. And what's interesting to me about this is because the narrative, if you remember, when Uber came public, was that it was the stronger player because of its international business, because of its Eats business, because it was more diversified. Then that narrative, even before all this happened, had really begun to shift. And now we have Uber sort of scaling that back.
Yeah, and we saw that internationally, right? Where they were using Uber Eats and then they had to sell off or just give up outright markets to competitors. I think that's something that we're going to continue to hear about, especially now. I mean, we have huge competitors from the likes of Seamless and Grubhub, same company, but DoorDash, Caviar, everything along those lines is something that Uber has to contend with. And I think if they can't get the notifications out or the word out that they're offering something like they are with Eats, it's a business that has the potential to be huge. As you said, we discussed it ad nauseum when Uber was going public, because it seemed like the best growth opportunity for the company outside of the ride sharing platform itself. But yeah, they're really starting to shrink there and seeing issues as far as growth.
Yes, indeed. Thanks, Dan. Well, speaking of shrinking, GE's aviation unit announced today it was going to be laying off workers. This ahead of the report that we're all bracing ourselves for on Friday, the jobless report or jobs report for last month. Inez Ferre has a check on GE and what else is going on in the market right now.
And Julie, just to take a look at GE shares right now, down more than 4%. This is after GE Aviation says that it's cutting about 25% of its workforce, or 13,000 jobs, as aircraft demand has taken a hit because of COVID-19. Now, GE Aviation manufactures plane engines. It also has a plane leasing and finance business, which has taken a hit as well. Now, the company had previously furloughed some of its workers and announced job cuts, but this is a further measure to scale down its business. Also taking a look at shares of Carnival, that stock is up more than 3%. This is after Carnival Cruise Line says that it will begin a phase-in of resumption of service at some of its North American ports this summer, starting on August 1st, with a total of 8 ships that will be sailing from 3 U.S. ports. Now, the pause in other North American markets and its Australian market will be extended through August 31st. Now, last month, Carnival had announced that it was raising more than $6 billion in capital through a combination of debt and equity. Year to date, though, Carnival down 71%, and its peers also down more than 70% as well. Julie?
Inez, thank you so much. And one of the companies that we'll be getting numbers from coming up will be Clorox. They already reported, but we will be hearing from the CEO of that company, Benu Dor. He'll sit down with our Brian Sozzi in an exclusive interview. That will be tomorrow right here on Yahoo Finance. You don't want to miss that. Coming up next, we'll be talking to the head of a restaurant group headquartered in Baltimore about how he is weathering this coronavirus pandemic. We'll be right back. You're watching Yahoo Finance Live. I'm Julie Hyman. We have been talking on an ongoing basis about what restaurants are facing right now. We're joined now by the head of a restaurant group, Atlas Restaurant Group. The CEO, Alex Smith, is joining us from Baltimore. Alex, you've got 15 restaurants overall. 14 of them are now closed. You guys have been expanding rapidly. What happens now? I know you've laid off a lot of your people. And so what does the roadmap look like, especially when, as I know in Maryland, Larry Hogan, the governor, hasn't given a plan yet for when the state's going to start to reopen?
Yeah, so like you said, we have, first off, thanks for having me on. Like you said, we have 15 restaurants, 14 have been shuttered. We do have 2 that'll open this Friday in Texas. So Lockbar and Uzo Bay in Houston, Texas will open this Friday, which will be great because we'll get to roll out some of our new safety procedures and slowly phase into what will be eventually hopefully opening all 15 of our properties. We think that Governor Hogan is going to open up sometime in the end of May or early June, and hopefully we can get our Atlas family members back to work as soon as possible.
Alex, hey, it's Adam Shapiro. Thanks for joining us. What does going to a restaurant look like as places reopen? And other than doubling the tips that we give staff to help people get through this, what as customers can we do to assist?
Yeah, I think what you as customers can do to assist is realize that you're no safer in a grocery store, in my opinion, than you are in a restaurant. I was just in Whole Foods today, and there was many people inside the store. I saw a number of people grab a bunch of items. I think that if restaurants do it the right way, which is, servers wearing masks, servers wearing gloves, social distancing, spacing tables apart, clean and sanitary procedures over and above what they were doing before. I just want the consumer to know that you're definitely safer in a restaurant than you would be in a grocery store or a Target or a Walmart. So from that side, it's good for our guests to know that, hey, when you do come back, you're going to be eating in a safe environment. Other than that, I think that the new normal is going to be exactly that. I mean, social distancing, tables spread out, less occupancy to start with. And it's all for us. The challenge is going to be, how do you operate in a profit when you have such a limited occupancy?
Hey, Alex, Rick Newman here. That's exactly what I wanted to ask you is, how are restaurants going to make money? I mean, most restaurants don't have a huge profit margin, and we're talking about measures here that sound like they're going to reduce revenue by, who knows, 30, 40, 50% as you space people out, lower occupancy, some of the things you just described. How are restaurants going to turn a profit?
I'll tell you that one good thing for us is the PPP. We just got approval in the second round, so hopefully we'll be funded in the next few weeks. I think that gives us 8 weeks of runway to bring everybody back to work and operate with a limited payroll. Because obviously there's going to be a grant for payroll and occupancy. What concerns me is the second wave of, if there is a second wave of, hey, look, we made it at 25 and then 50 and then 75% occupancy all the way through July. What does August look like if there's a second wave? What does August and September look like if this thing starts to flare up again? That's what's more concerning to me. I think that anybody who has been approved for PPP or has gotten a SBA Express loan, I think that for the next 6 to 8 weeks, I think we're okay to make it through that. The more concerning thing for us and the people I talk to in the industry is what happens if there's a second wave.
Alex, have you been talking to some of your regular customers? And I'm curious what they've told you would convince them to come back. I mean, I think it's a point really well taken about a grocery store versus a restaurant. But even if your servers are wearing masks and gloves, something that we've been talking a lot about during this reopening conversation is how willing people are going to be to come out and go to restaurants or other places.
Yeah, so I think it depends on age. I really do. I've talked to some older clientele that are certainly concerned, and I understand their concerns. I mean, it's very concerning. But, from the other side of the point, under the age of 40, under the age of 50, the numbers are drastically different. In the state of Maryland, through the end of this week, I think under the age of 40, we had 22 deaths and 7,500 cases. And if you compare that to 2018, we had over 500 deaths just from drug and alcohol abuse under the age of 40 in that same time period. So, I think that it's an age factor. And I think that the older generation should stay until there's something positive that comes out as far as a vaccine or treatment for this thing. But I think that the younger demographic, under the age of 40, I think they'll be more open to coming back. So look, all we can do is open up our doors and hope for the best, and going above and beyond as far as safety precautions and procedures, and hopefully make people feel that they're comfortable to come in and have a great experience again.
What kind of pressure do you think there's going to be on restaurant owners and managers from Congress, not just at the state level, to raise wages and provide health benefits to staff as we move through this? And as Rick pointed out, margins are already tight. How are some of these people going to survive that new pressure?
I honestly don't see a scenario where 50 to 60% of restaurants don't close through this. I think that if you were profitable before, and you had a profitable operation before, I think that the PPP gives you runway, and that you should take a chance and open back up. And that's where we are. We were in pretty good shape before. We're going to take out some loans, line of credit, go for PPP, and then try and get our 1,000 furloughed employees back to work. Health insurance, we covered health insurance before, and we're going to cover health insurance for our employees after. So that's just how we operate our business. But you're right, the margins are thin. Food cost is going up because there's runs on pork and beef and chicken, and there's issues in the plants, so they're closing plants down. So what does the new normal look like? I would love to sit here and tell you guys. I'm going to find out Friday in Texas, but I can tell you that, I think that at a 50% occupancy rate, we break even, maybe lose a little money. At 25%, it's certainly not sustainable. And our goal basically is survival. How do we hold on for the next 3 months, 4 months, until this thing passes and the majority of the general public feels safe to come out again?
Alex, finally, I wanted to ask you about one of those things that you're going to need to deal with for survival, and that's paying your rent. I don't know what your situation is. You've got a pretty large swath of restaurants, whether you own any of the buildings or whether you're getting rent forgiveness. How is that all working out?
Good question. So we're dealing with a few different landlords. We've sent letters asking for abatement and then deferment to the end of the lease. All of the landlords basically sent back, hey, we don't know what we're doing yet, and we'll let you know as soon as we get there. Our attorneys have been in contact with landlords. I've been in contact with landlords, and the answer we're getting from everybody is we're not sure what we're doing yet. And I think it's because their concerns are if they're federally or state mandated for us to operate at a 25% occupancy, then technically they should reduce the base rent by 75%. So I think every landlord right now in the country is trying to figure out what does that mean for them, and where do they go from here. I mean, we obviously want to pay rent. We want to make sure that we have a great relationship with our landlord, but a lot of these landlords are receiving deferments on loan payments and interest payments. So I think that should trickle down into the retail space and to us. And then when we get back up and running, then we're happy to pay rent.
All right, Alex Smith, good luck to you. Joining us from Baltimore there, he's the CEO of the Atlas Restaurant Group. Really appreciate it, Alex. Thank you.
Thanks so much for having me on.
Thanks. Well, coming up next, we have talked a lot about the reliance that a lot of Americans have on Amazon right now, but what about the workers at Amazon? We're going to speak to one of the lead protesters who has been speaking out about the company's work practices. We'll be right back. You're watching Yahoo Finance Live. I'm Julie Hyman. Well, Amazon reported its earnings last week and took a big hit because of increased costs related to coronavirus. The CEO, Jeff Bezos, said the company has increased spending on things like worker safety, but there has been some dissent from within the Amazon worker ranks about that very issue. In fact, a vice president at Amazon, Tim Bray, did quit the company in protest over worker conditions. We are joined now by Chris Smalls. He is a lead Amazon protest organizer. In fact, he was let go from the company after protesting at a Staten Island warehouse. We're also joined by our own Alexis Keenan. Chris, thank you for joining us. So these protests seem to be ongoing. There was another wave of them on Friday, and the company is talking about that it is instituting increased safety procedures. What do you think Amazon still needs to do to bring itself up to par?
Well, the number one X factor why I started to raise concerns because the cases in the building haven't been resolved yet. What they need to do is shut down every building that has a case in them and shut it down for cleaning for a minimum of 2 weeks, that 14-day incubation period, just to separate everybody. You can't stop the spread of the virus once it's inside these facilities. So that's what they need to do. Any building that has a positive case needs to be shut down for a minimum of 2 weeks.
Mr. Smalls, good to have you here. Did you hear the news this morning that Tim Bray, Amazon Web Service Vice President, came out against the company saying, and he resigned, quote, remaining an Amazon VP would have meant, in effect, signing off on actions I despise. And he was talking about the targeting of men and women like you who are then getting fired, he says, by Amazon for trying to protect people. What do you think of all this?
Hey, he's absolutely correct. I believe that he didn't want to go down with the company for the things that they've been doing to us. And he's on the right side of the fence right now. So, hats off to him. And I did hear about it early this morning. And, I'm just grateful that people are actually stepping up and having the courage to come out and speak on the wrongdoings of this company because they have dropped the ball on this. And I guess, doing what he has done at that level, a VP level, that speaks volume and that corroborates the story that I've been telling all along.
Hey, Chris, Alexis Keenan here. I want to ask you about the New York Attorney General who confirmed with Yahoo Finance still this morning that the office is still investigating, but they said that they did make some preliminary findings in that Amazon safety measures in response to COVID-19, they at one point wrote a letter that NPR got its hands on and said that those measures were so inadequate possibly that the company may have violated both federal and state laws. Specifically on the federal side, they talk about OSHA. Have you seen, when you were still working there, any specific violations of OSHA in response to COVID-19?
Well, we were unprotected. I'm not familiar with the OSHA laws, the compliance of them. I didn't have the opportunity to really read those laws or guidelines. I did read into the CDC guidelines at the time, and we weren't in compliance with any of them. As far as I know, we were unprotected. We weren't prepared for the virus. We were for the entire month of March. That's when I started to raise my concerns, early March. Mid-March, we were in the middle of the pandemic. It was already in New York, and we were still throwing parties in my building in Staten Island. So as far as I'm concerned, we definitely violated some safety violations, and that's the reason why I continue to take further action. And somebody should be held accountable for that because this should have never happened the way it did.
Hey, Chris, this is Dan Howley. Are you still in communication with the other Amazon protesters, the climate change protesters who kind of came together alongside you guys to really go at the company as far as its reply to the treatment of workers in the factories? And I guess, have you heard anything from Amazon higher ups?
Well, yeah, to answer your first part, absolutely. Actually, Emily Cunningham, she's the one who sent me the article this morning at like 6 in the morning. We're in a different time zone. She's on the West Coast. But me and her and Maricosta and some of the other people that have been retaliated against, we communicate all the time via social media or through conference calls that I orchestrate. It's a very strong alliance that we built, and sort of like a family as well, because we all have one common goal, and we know that this is a giant corporation. We have together. We're going to try to do what's right for the employees and speak up on the voiceless. Um, what was your second part again? I'm sorry, I lost track. Can you repeat the second?
If anyone from Amazon has reached out to you from the higher ups.
No, the leaked memo, as far as I'm concerned, stating that I'm not smart or articulate. That's the only communication that I received was that. But in response to that, it's never going to be Amazon versus Chris Smalls. It's going to be Amazon versus the people. They got to answer to all of us.
So, Chris, it's Julie again. Sort of related to that, I know one of the protesters' demands has been that Amazon rehire some of the folks who they allegedly fired in retaliation, including yourself. Would you want to go back and work at Amazon after everything that's happened?
Absolutely not. I don't want to work for a company that's been exposed for not caring about people in general. Forget about the fact that they terminated me wrongfully. When that leak memo came out, after putting all the blood, sweat, and tears I did into this company since 2015, opening up 3 major buildings for them, finding out that the CEO of this company had that conversation, whether it was his words or the company he has around him, they're having conversations like that about it pretty much left a bad taste in my mouth, and I don't think I will be able to work for them again. I do want to be reinstated to rightfully resign in my own will.
Mr. Smalls, it's Adam again. I'm curious. I wasn't sure. Are you suing Amazon, and what could Jeff Bezos and the company do to make all of this right?
As far as the legal aspects, I can't really get into details yet, but we're waiting on a response from our demand letters, and then the courts are closed right now, so we have to take it step by step. And my legal team, C.K. Hoffler, she will come out in the public more once we hear back. But right now, we don't know yet. We haven't decided what we're doing. And what can Amazon do to make this right? Take care of their employees, pay all the employees that have been unpaid since the beginning of March up until present day. So we're talking 2 months now. They need to extend the unlimited UPT that they took away on April 30th. They need to be transparent about the amount of cases that are in these buildings. Stop hiding the numbers, because if they're double digits, that means that they're not keeping the employees safe. We don't know what we're dealing with coming into the building. And reinstate everybody that they terminated, definitely. They terminated people for speaking up on health and safety concerns. That doesn't make sense to me. All these employees, including myself, that been with the company for a number of years, there's no way that we all decided to be insubordinate one day. We spoke up on health and safety concerns that the company didn't provide for us, and all we wanted was some simple, solutions, and we shouldn't have been terminated for that. So they need to reinstate everybody. They need to pay their employees, take care of their employees, make sure that the PPE is provided at all times, and stop lying to the media and the public. These safety guidelines that they implemented now didn't exist in the month of March. They all started after they terminated me on March 30th. They did not start in the month of March. I know they did spend abundance of money, billions of dollars, but that's good. They should have been did that. It didn't exist. It didn't exist before they terminated me. So they need to tell the media and the public the truth. They dropped the ball. They need to apologize. They need to take corrective action so that people feel safe working there.
Chris Smalls, keeping up the pressure on Amazon. He's the lead Amazon protest organizer, joining us from New Jersey there. Thank you, Chris. Really appreciate your time.
Thank you for having me. Appreciate it. Stay
We'll
safe.
be right back. Thank you. You too. Watching Yahoo Finance Live, I'm Julie Hyman. We have been listening to some rhetoric from the president regarding China over the coronavirus and its origins. He's now talking about that perhaps we'll see some increased tariffs on that nation. Rick Newman's been tracking this for us. So it seems as though the intelligence is not conclusive about the origins of the coronavirus.
It sounded like it was conclusive not too long ago. The intelligence community supposedly found no evidence that this virus came from a lab in Wuhan. There is a virology lab there, a well-known one. But now the Secretary of State, Mike Pompeo, has said he's seen evidence that it has. So this is part of what is obviously a political strategy for the Trump administration. So they seem to have made a deliberate choice to try to vilify China to deflect criticism from President Trump's own very slow reaction to this problem. So this is catching on. This is one of those things that's just kind of becoming a common narrative among Trump supporters that the Chinese are responsible for this virus and that we need to punish them somehow. That's very oversimplified, and it's not exactly clear how we could punish China without punishing ourselves. Trump is tariff man, of course, so he loves the idea of using tariffs. But tariffs are a tax on us first. It's a tax on stuff we buy. That may down the road get reimbursed by the Chinese when they import stuff to us. So that does not look like a great solution. Taxing ourselves, not a great idea.
Rick, does the number of deaths that the administration expects, which is going to increase drastically, play to the advantage of the attack on China or against President Trump?
I guess it depends who you're talking to, Adam. I think it's reasonable to think that what voters want here in the United States is, okay, we understand there could be a problem with these live animal markets in China, which we thought was the original source of this, but how about we just address the problem here first? Trump is going back to the origin of this virus. At the same time, he's getting very low marks for his actual handling of the crisis. And Trump still, he seems like he's just going to take a hands-off approach to this all the way through the home stretch into November. He's kind of detaching himself from whatever the phase 4 stimulus might be. He wants to start traveling again. That's what he's going to do this week with a trip to Arizona. So Trump is kind of casting around for a storyline that will work and displace the storyline that he was very slow to respond here. I don't know whether voters are going to buy it.
We shall see. Rick Newman, thank you. And thanks as well to Adam Shapiro and Dan Halley for hanging with me over the past hour, as well as all of you for tuning in. Right now, the S&P 500 down about 0.5%, the Dow off 0.9%, and the Nasdaq's almost given up its gains now. It's just up about 0.1%. You're watching Yahoo Finance. Keep it right here.
Welcome into live market coverage here on Yahoo Finance. I'm Zach Guzman, and right now we have the major indices trading lower right now as we hit 1 p.m. Eastern time here in New York. We have the S&P off by about 0.5%. The Dow right now, the biggest legger to kick off the week, off nearly 0.9%. The NASDAQ, the lone major index, in green right now. We'll keep you updated on those moves. Crude oil, though, importantly, regaining $20 a barrel. We've seen that moving up higher. That's been the trend lately after, of course, we saw the front contract dip into negative territory last month. We will approach a rollover in those contracts by mid-May. So we'll keep you up to date on the June contract. But right now, holding at above $20 a barrel in oil. Also, when we look at a sector-by-sector basis right now, we are seeing energy, the largest gainer right now, off of that move in crude prices. On the flip side, though, the biggest laggard, industrials, largely by a wide margin, the largest loser today so far, only trailed by financials at about a 1.5% decline. Industrials off more than 2% right now. And the main reason why, folks, if you did not tune in to our exclusive coverage here on Yahoo Finance of the Berkshire shareholders meeting with Warren Buffett over the weekend, you can still watch a full recap of that. Of course, we brought it to you live here on Yahoo Finance, and some interesting headlines from the Oracle of Omaha at that event. Mainly the fact that he has completely exited his stake in the airlines, the major airlines, and we are seeing the moves to the downside in those stocks today. Right now, you have American Airlines, United Airlines, Delta, and Southwest, Alaska Air, the largest decliners in that industrial sector. Right now, all of them off by more than 9%. When you look at the specific moves, the biggest loser today, American, so far off 10%. The rest of them off by about 8 or 9%. Mostly due to what he said about those airlines, noting that he did exit completely about $4 billion worth of holdings in those airlines, roughly about 10% of the 4 world's largest airlines, saying that he did admit that it was an understandable mistake to take a position in those companies. When you look at the way that the world has changed for the airlines, admittedly, he did not see the coronavirus coming in terms of what the impacts would be on the sector as a whole. I think a lot of people, if not everybody, would fall into that camp. But he did note that it might take longer than 2 or 3 years for the airlines to resume to what they've seen traffic-wise last year. So quite some time in saying and explaining his reasoning for why he got out of the airlines, and we're seeing those fall as a result. Outside of the headlines on the airlines themselves, Warren Buffett did offer a pretty cautious view on the market right now, optimistic in the long term, which is, of course, symbolic of what we heard from Buffett for years here when we think about this rally. But moving forward, interesting to hear his thoughts on other sectors, of course, Berkshire through Geico, a major player in the insurance space. And that was the focus of a large part of what he weighed in on during the extravaganza. Again, I can't reiterate, you got to go back and rewatch it. But when we look at what he was talking about on the insurance front, interesting to hear him share his thoughts on Geico and the larger industry market as a whole. Of course, Geico, the second largest insurer out there in the auto space. When we look at what he said on that front, I want to play a quick snippet of what he had to say about the insurance market and dive deeper into it on the other side. Take a listen to what Warren Buffett had to say this weekend.
At Geico, we're the second largest auto insurance company, and different auto insurers are handling a sharing of the better experience with their policyholders in different ways. Our plan will deliver back $2.5 billion roughly or so in recognizing the reduced frequency of accidents during this period. What we don't know is how long this will continue. I mean, people want to drive their cars still, but conditions have reduced that driving dramatically, obviously. Now, we have instituted a program that runs saving people money for 6 months, and so far, other people have largely been 2 months, but some of them have given a little more for those 2 months than we give per month. Our total is the greatest at $2.5 billion. And in addition to that, we and all the others in the industry, it's not just Geico, we've also, and insurance commissioners in many cases, I believe, have required it, but we have, we give people more time to pay if they aren't paying. And if they cancel their policy or if they don't end up paying us, we've in effect giving them free insurance during that period. And the delay in payments is obviously increased. Delay of payments on, if you got a shopping center getting rent, the delay in payments is what happens during a period like this. And that will be a significant cost to us. We don't know how significant will be. There will be more uninsured motorists driving, and they cause a disproportionate amount of accidents.
So there you go. Free insurance as well as record uncertainty. When we look at it, no doubt a very interesting time to be playing in the insurance space. For more on that, I want to bring on our first guest today, Brian Meredith, UBS Research Managing Director and North American Insurance Analyst. Joins us on the show now. And Brian, I mean, you just heard Warren Buffett's thoughts on the insurance space right there. Interesting to note the $2.5 billion that he talked about in terms of return to policyholders at Geico. How do you weigh that kind of cost there on that side, plus the benefits of fewer accidents on the road out there? What's the pro-con shakeout right now in the insurance space on the auto front?
Yeah, I would say the credits he's giving or the reduction in premium he's giving is probably not going to be to the level that you've actually seen the drop in accidents. I mean, we just look at the first quarter alone, and we're only talking about kind of really where March is where the shelter-in-place thing started. You had close to a 6% drop in accidents. Let's take that and roll that into the second quarter. Think about the magnitude of potential drops in kind of accidents out there. It could be 40, 50%. So the actual profit benefit, I think, will outweigh the 15% reduction in premiums for Geico. Granted, it's great that he's getting it back. A lot of other insurance companies are doing the same thing. They're doing it a different way as far as credits on your kind of monthly premiums.
Yeah, and I mean, it's obviously a large piece of the insurance pie here when we think about autos, but outside of that, Warren Buffett did weigh in on some of those other insurance giants who might be less focused on autos and maybe more on the underwriting of businesses that might be impacted by what we're seeing play out in coronavirus. On a negative side, you know, the positives of not driving, fewer accidents is one thing, but on the other side, you talk about commercial and peril there for insurance to think about business interruptions. He was saying that Berkshire wasn't necessarily overly exposed to that side of things, but he did mention other insurers might be. So when you look at that, who outside of that world might be most impacted there, and what do you make of the way that some people might be a little bit more exposed on that front?
Yeah, that's clearly one of the more controversial areas right now in the insurance industry, is this whole concept of business interruption coverage. And basically what it basically is in a property insurance policy, or as he mentioned, in a commercial multi-peril policy, there's this element where if your building is physically damaged or something happens, an insurance company, you can buy a limit. Insurance company will sell you a limit where it basically reimburses you for expenses that you would have incurred in that time frame and some lost profits. Now, the key here is, one, you're supposed to have a physical damage to your building, and the question that will be litigated going forward is COVID-19 a physical damage to an actual establishment or building, and therefore can you collect this business interruption coverage? Additionally, there's a number of insurance companies that have specific exclusions for virus or pandemic in their policies. Be much harder for a business to actually collect if that's in your policy. But I think what Buffett was trying to say here was that with respect to Berkshire Hathaway, they do have these physical damage triggers that you've got to have in your policies. They may have some policies out there that have that, an endorsement that basically says, yes, you have coverage in the event there's a pandemic. He didn't give anything as far as how much there is there, but he said it's relatively small. So probably not a big issue for Berkshire Hathaway.
Yeah, he also said that he was open to getting into it. Of course, we saw them underwrite interesting insurance policies in the aftermath of 9/11 when there weren't a lot of people who were willing to write that. Berkshire kind of in a unique camp in its own right there when you think about the cash that it has to underwrite some of these things and the risks that they're willing to take. Could look risky on the outside, but he seemed to be into the idea of underwriting that. But he also was asked about the idea of the industry, the insurance industry in the environment of negative interest rates. He seemed like he was a little stumped on that just by the fact that he's been stumped by negative interest rates since they've become a thing in Europe and abroad. But when you look into that, I mean, it is interesting considering the fact that the insurance industry makes money off the float of that on the front end and invests here. But when you look at negative interest rates, what would be the impact of that if they were to come here in the U.S. on the insurance industry, and how might that impact the names like Berkshire?
Well, I think you got to separate it between life insurance and property casualty insurance. The property casualty insurance businesses, which he's referring to with Geico and some of his commercial insurance businesses, remember, they've got two forms of profitability coming in. It's investment income off their investment portfolios, and they're heavily invested, most companies, in fixed income securities, although Berkshire Hathaway uses a lot for common equities. But there's also the underwriting profit component. You're trying to, the premiums that you take in being more than the losses and the expenses you're paying out. And one thing that's interesting about this industry right now is we're in what we call a firm or hard market in commercial insurance. That means that prices are going up because a lot of commercial insurance companies looked at the profitability of the business over the last 12 to 18 months or 24 months and said, it's not enough. We need to charge more money because, one, interest rates are so low as it is already. We need to charge more for our basic product to earn a good, acceptable return, on capital on it. So that's important. Plus, they also perceive that their cost of goods sold in the business was already going up a little bit with this concept of what we call social inflation kind of coming into insurance losses. So what I would say there is that in the P&C insurance business, negative interest rates, yeah, it's not good for return on equity because obviously it's part of your earnings stream, but you can offset some of that with just charging more for your insurance product and generating a better running profit. Life insurance, on the other hand, much more challenging.
I mean, as if there weren't already enough challenges out there to consider all the unknowns at this point when we think about the virus itself, the spreading there, when business goes back to usual. On top of that, what could be happening in the interest rate environment as well. A lot of unknowns out there to consider here. But Brian Meredith, appreciate you taking the time and remarking on all that Warren Buffett had to say on the insurance front. Thank you, sir.
Thanks.
And a reminder again, you can still watch the Warren Buffett exclusive coverage we had here on Yahoo Finance in full. The team did a great job of covering it all. And of course, as usual, Warren Buffett delivered the goods. We're going to take a quick break here on Yahoo Finance. On the other side, we will be continuing the discussion on the medical front in regards to the coronavirus crisis here in the U.S. Before we do that, though, a quick reminder that in the next hour, we will have Salesforce CEO Mark Benioff joining us live here in the 2 p.m. hour. A reminder to tune in for that and his thoughts on that crisis. On the other side, we'll continue the coverage here on Yahoo Finance in terms of what is expected on the drug front as Gilead moves forward with plans to roll out remdesivir, that Ebola drug, and how it's proving effective. But how much will it cost? The professor and director of Vaccine and Immunotherapy Center at MGH will join us to weigh in on that and why it could potentially cost Americans north of $4,500. Much more on that right after this. Welcome back to coverage here on Yahoo Finance. Right now we have all three major indices in the red. The Dow, the biggest laggard to start the week, off by about 1% as the NASDAQ now flips back into the green, pretty much at break even. We'll keep you posted on those moves. But right now, updates from President Trump in regards to expectations of how this country is responding to the coronavirus crisis. He told Fox News in a virtual town hall that he does expect as many as 100,000 Americans could die from COVID-19 as the crisis continues and states reopen their economies. We did hear from Governor Andrew Cuomo here in New York earlier today saying that it's not exactly feasible to expect the lockdown to continue indefinitely and that things will inevitably have to reopen. But a lot of questions surrounding how that can be done well in this environment. And a lot of that hinges on two things, mainly the progress being made on the vaccine front, as well as Gilead Sciences' drug remdesivir and the way that that's proven effective in helping patients battle COVID-19. And some interesting research on that front in regards to how much it might cost. A new report from Watchdog drug pricing group, the Institute for Clinical and Economic Review, put out its initial review for Gilead Sciences' remdesivir drug, saying that it could cost as much as $4,500 per drug patient out there. And that number is drawing some headlines and some skepticism there. But for more on that, I want to dig into it with our next guest in regards to how much that drug should actually cost, how it should be rolled out, and what promises we have for vaccine research. Joining us is Dr. Mark Poznansky, Halovac's founder and the director of Vaccine and Immunotherapy Center at Massachusetts General Hospital. And Dr. Posnanski, when we look at this, the president did give an update that he thought the vaccine for COVID-19 could come as soon as this year, which would be a little bit ahead of some people's projections. So what's your take on the progress on the vaccine front and whether or not that can actually happen?
Well, I think there's some very major and very much fixed issues that have to be dealt with when you're designing a vaccine, which take time in order to achieve, to get to like an effective vaccine. And those things, there are things that you can shorten the time period. There are others that are just take time, like just building the vaccine, building it in enough doses that you can test it for safety, doing the safety studies, make sure you've got the readouts that show that the vaccine is actually protective. That all takes time. And I'm not sure how, like certain things you can make a little bit shorter, but other ones like readouts, clinical readouts on safety actually take time and a lot of doses to be given to a lot of people to be able to be sure that the vaccine is safe. So, the 12 to 18 months that I've been hearing from Dr. Fauci sort of makes sense. There are maybe areas of that can be shortened, but the end of the year sounds aggressive at best. And it also cannot supersede the actual biology of this virus, which we're also learning at the same time as we're designing a vaccine. We're sort of laying the tracks at the same time as building a vaccine, if you see what I mean.
No, I mean, that's the hard part about hitting a moving target here is you're always constantly learning more things, but you're right to highlight Dr. Fauci's timeline. It's not quite as optimistic as President Trump's there. So, I mean, if you were to kind of obviously you're an expert in this when we think about people, perfect people to talk to, when you look at it and maybe put a percentage chance on actually getting everything right enough to meet that deadline of by the end of the year, what would you say in your expertise might be the percent probability of that actually happening?
I think it's really hard to do. It's really hard to do. I think the percentage chance is much greater that we could be at something within a year to 18 months. I mean, it's what the most experienced vaccinologists, even with the vaccines that are currently entering human studies now, would say, because they have to pass all the hurdles that are currently out there. Now, if some of those hurdles get removed, that will make a difference. But at the moment, I'd stick with the most likely timetables of 12 to 18 months, even with those that have already initiated in first-in-human studies. Yeah. And I just want to go back to this point about it's sort of like the devil is in the detail, and no one really wants to look at the detail. The detail is, as of today, we don't yet know what a protective immune response to the virus is. So we're building a vaccine to generate a protective response that we don't quite yet know what it is. So whether that's going to be 3 months, 6 months, or a year is the fundamental sort of biology of this that you almost can't get away from. It's like the gravity of virus development. It's just out there and it has to be addressed.
Yeah, no, it's a very important point, and also important too when you think about all the issues that we've had on antibody testing on that front too. Also weighed into all that when we think about the immune response to this virus and how difficult it is to judge. But with all those concerns out there on the vaccine front, it does kind of make the drug progress even more important when we look at Gilead Sciences' remdesivir. And we did get that report out over the weekend highlighting that it could cost as much as $4,500 per dose needed for a COVID-19 patient. But when you're looking at that, it is interesting because President Trump brought up AIDS and the HIV virus there in terms of how it might relate to how we respond here. But it's obviously a very different virus when we think about how it's passed from human to human. So, I mean, when you look at kind of the cost associated and the steps forward to deliver a drug like this to the global population, how should the industry be thinking about pricing? What do you make of that estimate of about $4,500? What's the way to think about it when you think about a novel virus like this?
Well, I'm giving you the academic physician answer to that. Obviously, we would like our drugs that are as potentially influential in treating disease as remdesivir to be as cheap and as widely available as possible. So, that's our bottom line. As physicians, we'd like to be able to give this to patients of in every country and every nation in order to treat this disease. I think the reality is that obviously industry decides on it, but governments have a big role to play in this, in helping guide that and guide the demand. I would say that at present, remdesivir is being trialed in the most severely ill patients. It's an intravenous drug. That doesn't make it accessible to people walking down the street to take an intravenous drug to prevent COVID infection. So it's a niche. At this time, it has the projection of being within a niche market around severe disease. And I would say one other thing, and the one thing I don't want to take away from is the fact that despite all of this, I'm hopeful that all of this drug development will get to a drug that changes the course of the disease. But I would say we haven't seen the final report on the Gilead remdesivir trial. We've heard the top line reports on this. You know, the devil in the detail is the detail of how the trial was executed, the patient groups, the comparisons between the different centers. And I think the judgment on this has to be held, the final judgment has to be held on the final details of the clinical trial.
Yeah, no, it's a very good point, and it's also worth highlighting that we also got those results from Gilead after a study in China was also not exactly delivering positive data on what happened there, though it was cut short based on the patients in that study. But very fascinating stuff, Dr. Mark Poznansky from MGH on that, and I appreciate you taking the time. Obviously, a lot of details to dig through here, but I appreciate you boiling it down for us today.
Thank you very much.
All right, we'll take a quick break here on Yahoo Finance. On the other side, digging into a way that local economies, local towns are weighing decisions to open up, as of course, there's a lot of pressure to get people back into the offices around the country, back working again as we continue to see record unemployment claims. Inside the tricky thinking on that front right after this. Welcome back to live market coverage here on Yahoo Finance. I'm Zach Guzman. Right now we have the Dow off by about 1% as we continue to get updates from a lot of companies as this is earnings season. And this morning we got an update from one of the largest food companies in the United States, Tyson Foods, delivering earnings, as well as an interesting move in the stock price. Tyson, right now we're seeing shares off by about 8%. When you look at those after the company did announce earnings that are quite interesting considering all the issues on the supply front right now as they deal with production facilities shut down due to outbreaks of coronavirus. And for more on what the company reported, I want to get to our own Heidi Chung, who has the details in the latest quarter. Heidi?
Hey, Zach. Yeah, like you mentioned, shares are off about 8%, but really the losses accelerated during the conference call earlier today. And like we expected, it was not a great quarter. And also, like we expected, the company was not able to provide financial guidance amid this COVID-19 outbreak. But what we did learn was that during the fiscal second quarter, revenue was actually up 4% from last year to $10.89 billion, and adjusted earnings per share down 36% from last year to 77 cents per share. Now, Tyson's second quarter results, of course, come as the U.S. meat industry really gets hammered by this coronavirus outbreak. But it's very important to note that things really started to hit the meat industry in April, and the second quarter results don't really capture all of the damage that was being done. So what we do know is Tyson has been very vocal about the entire meat industry and how that the food supply is being affected by the COVID-19 outbreak, and also regarding those closures of some of its processing facilities in Washington, Iowa, and Indiana over the last month or so. Tyson saying that it does expect the lower levels of productivity to persist amid the crisis. CEO Noah White saying in a statement, quote, "During the quarter, we witnessed an unprecedented shift in demand from food service to retail, temporary plant closures, reduced team member attendance, and supply chain volatility as a result of the virus. While we cannot anticipate how long the challenges presented by COVID-19 will persist, we remain focused on driving long-term growth." Tyson also expecting the pandemic to create even more disruption, which will increase costs and negatively impact volumes for the rest of the fiscal year. White saying on the conference call that with the current conditions, recovery is expected to start in the fiscal fourth quarter. So far, the company has laid off and furloughed 0 employees. White also saying that Tyson's facilities have shifted millions of pounds per week from food service production channels into retail demand amid the pandemic. Panic buying, though, has subsided, Zach, but the company is still seeing 15% to 40% volume increases for some products. However, that gain in retail is not going to be able to offset the damages and impact that the company is seeing on the food services front. And that, in fact, will lead to negative year-over-year growth for Tyson in the second half of the fiscal year. Tyson president, though, saying that it does expect somewhat of a U-shaped recovery, but judging by all of the analyst commentary that we've seen, they were quite surprised that management was so very doom and gloom on this earnings release.
All right, Heidi Chung bringing us the latest there in terms of Tyson's overall numbers, but let's talk about those actual consequences of reopening the economy, and for the case of Tyson, reopening plants across the country, because it's more than just earnings and profit and about hitting your numbers when we look at that story, and it's being seen across the country right now. Perhaps no town knows that more than Waterloo, Iowa. The town's home to Tyson's largest pork production plant, processing nearly 20,000 hogs a day to account for about 4% of the overall country's pork processing abilities here, according to the National Pork Board. As you can imagine, shutting down a facility like that was a lot of the focus of the earnings call today in terms of what problems it creates for the overall food supply. So much so that President Trump invoked the Defense Production Act last week to bring processing plants like that one in Waterloo, Iowa back online, and also called for the workers who staff those plants to return to work. Today, Tyson execs on the earnings call reiterated that they're doing everything possible to do that safely. But you have a very different recollection of the way that this crisis played out from workers on the front line at plants like Tyson's. They crowded together in the Waterloo cafeteria and said that lax policies directly contributed to prevent a spike in coronavirus cases there in that town. Overall, about 90% of the COVID-19 cases in Black Hawk County are directly tied to the Tyson plant, according to local health officials. And those cases have resulted in multiple deaths, including 65-year-old Tyson worker Jim Orvis, who started working at Tyson more than a decade ago. As the plant prepares to reopen, many in the town are fearing that the same story could play out as we see the plant come back online and workers called back in. For more on that, we're joined by the mayor of Waterloo, Iowa. Mayor Quentin Hart joins us now to discuss. And Mayor Hart, thank you so much for joining us. I know you're a very busy man right now, and you were actually extremely critical of Tyson Foods in terms of calling for them to shut the plant down when these cases were out there first. I understand a lot of people, including farmers in the area, depend on the facility to make ends meet here. But what do you think about the pressure that's now coming from the highest form of government to call workers back into that plant? And what's the feeling like in your town?
Well, hi, Zach. Hi, Heidi. With regards to invoking the Defense Act, of course, the president has the full rights and responsibilities to do that. And given that Tyson is vitally important to our overall food chain in this country, I mean, I can see how that has a global impact, but I want residents to be able to go back to work. I want businesses reopened, but not at the risk of their health or their life. But to force meatpacking plants or essential businesses to open when they've made the responsible move and deemed their facilities maybe a public health risk that is contributing to the spread, or if there aren't parameters that are in place to actually keep their workers safe, I think that's a huge step backwards. Pro-business means to be pro-workforce, and to be pro-workforce means that we have to be pro-public health as well.
Yeah, is that possible though? Because when we hear the updates, of course, Tyson's saying they're doing everything they can. The workers there on the line saying that hasn't been the case. When you look at even your own Emergency Management Commission in Black Hawk County, it didn't sound like he was seeing a lot of those ideas implemented there on the front line plant there. When we think about all this meat coming through and people working in close proximity, so are you at all sure, or do you have doubts that Tyson can actually make this reopen safe? I know tests are coming out now, but what are your fears about maybe that not being the case?
So on April 10th, the Black Hawk County Health Department and the Sheriff's Department did a walkthrough at the plant and talked to some of the management there. And there were serious concerns about worker safety and mitigation efforts. But we just had a meeting this past May 1st with people from the plant. I think they're president of pork and beef production. And they laid out a phase plan about worker safety from temperature screenings to mitigation controls, to testing for workers, to dividers, to sanitizing and procedural change, to mask and other PPE, and overall communication that they'll have with workers. So, and then afterwards, we actually went ahead and did a walkthrough to the plant to say, yeah, you said it, but what are we seeing actually in your plant? And our public health director said they have come a long way in a short amount of time to protect worker safety. So they're not opening up right now until all the testing is done and they can see exactly what they have for a workforce, and so that they can continue ahead to implement these safety factors. There's a lot of trust that needs to be built up between the workers and between the plant, but I am seeing steps to make that happen.
Hi, Mayor Hart, it's Kristen here. So obviously you've expressed, some fears and some concerns about reopening this plant in Waterloo. I'm wondering if you're asking or if you're looking for officials like Governor Reynolds or other officials in Iowa to try to push back on the president, who is trying to pressure you guys to open up perhaps a little bit too soon.
Well, with regards to this situation specifically, I am glad to see the officials at Tyson's taking a stance, because you can push and force people to go all back to work as much as you want to. But when you're missing 30, 35, 40% of your workforce, that has an impact on your overall work production. There's a correlation, I'm hoping people see this, between our agricultural base, a healthy workforce, production flow, and its impact to local and national economies. But you can push all you want to, but if you don't have people that are healthy enough to work, that's going to have global impacts. The steps that they are taking should be, we need to look at this as potentially having best practices, because this is new. Things happen very quickly. So we need to be taking a look at that. But one thing that I would also like to see that our governmental officials state is that the same amount of pressure that we're putting on workers to go back to work is the same amount of pressure legally that need to be placed on businesses to put in protective measures to mitigate the spread and protect workers. I like to see that happening, which I haven't seen yet.
Yeah, it's a very good point. And I mean, we talk about what Tyson's doing for its workers, an additional $500 in hazard pay being provided at a lot of the workers across these plants. Some people might say that that's not enough considering everything that's going on right now. When you do look at the timeline, though, knowing everything that you do about those measures being put in place right now, what would you say about the timeline to reopen the plant in Waterloo? As I said, it's the largest Tyson pork production plant here. And also, they've given timeline of a few weeks. That was a few weeks ago when we saw the plant closed down. So what's your take on when it will actually reopen?
I can't, I'm trying to stay away from dates. But the thing that I like to say that it shouldn't be about the dates. It should be about the protections that are put in place. The company officials have stated that we will work together as a team with our Department of Public Health, our Sheriff Department, our local municipalities. And this is our county, not just Waterloo, but our whole county is being impacted. So before they open, we are going to be on one accord because this is about trust. This is about people. This is about the incredible workforce that we have and keeping them protected. So we're doing it. It will be moved as a team effort.
All right, the mayor of Waterloo, Iowa, Quentin Hart, thank you so much for taking the time and good luck.
Thank you.
All right, we're going to take a quick break here on Yahoo Finance. On the other side, obviously, this is something that a lot of communities are dealing with, perhaps not on the same scale as Waterloo, Iowa, but the ideas behind it very similar across the country. What you should know about reopening plans in your neighborhood right after this. Welcome back to live market coverage here on Yahoo Finance. I'm Zach Guzman. Right now we have the S&P 500 off by about 0.5%. Still the weakest performer today. Industrials off more than 2% as the airlines take a big hit after Warren Buffett revealed on our air exclusively here over the weekend at the Berkshire shareholders meeting that he had exited the holdings, roughly about $4 billion in those four top airline companies. And we are seeing the moves to the downside in those names today. United Airlines, American Airlines, Southwest, and Delta all trading off by about 9 or 10% right now. That seems to be the major story in the market right now. Outside the market, we've been continuing to track the way that President Trump is assessing the way we should be reopening local economies across the U.S. as we continue to monitor coronavirus cases here in the U.S. And of course, a big question on that front has been what the president plans to do in both regards to holding China accountable for the crisis, something that he's talked about quite frequently, as well as how these cities should be monitoring cases as they reopen the economy. For more on both of those fronts, I want to bring on our next guest, Nan Hayworth, former New York Congresswoman and Independent Women's Forum board member, joins us again here. And Congresswoman Hayworth, it's good to see you again. When we look at what President Trump's been saying about this problem, he, of course, has highlighted China's involvement since the crisis began and has talked about tariffs, maybe implementing tariffs again. We've seen him do that before with China. What's your take on how he should be balancing kind of an approach to be focusing on things here and what needs to be done on the health front, but then also, I guess, holding China accountable at the same time?
Well, Zach, I would respectfully submit that it's really China's responsibility for this pandemic. I find it completely plausible that their mishandling of extremely dangerous material at their Wuhan virological laboratory may very likely have led to an inadvertent release. And then, of course, their actions subsequent to that, deceiving deliberately the World Health Organization, whom, of course, it is also manipulated so that the head of the WHO is someone who's favorable to them. I mean, there really is a malefactor globally, and it is China. That said, we know we have to deal with China. We are deeply interdependent with China. They hold a lot of our debt. They have an enormous manufacturing capability. We cannot simply cut off our relationship with China. The president, as we all know, has used tariffs as a tool. It is one tool among many. He invites debate whenever he makes these kinds of bold statements, and he listens to what all the opinions tell him. I like very much the fact that an economic coalition is being sought with friendly nations so that we can actually improve our global manufacturing capabilities and secure them within the United States and among, again, friendly nations so that crucial capabilities that are impaired by a pandemic or that require response within a pandemic are in fact secured. So I do trust the president to be on the right path and have his heart and his very sound advisors. And as you know, he's got a lot of free market guys and free trade guys among them, including Larry Kudlow. Believe me, he's listening to all of those folks. And that's what we have to trust in terms of the economy and global relationships going forward.
Well, that's the interesting piece of this, too, because it's not just that. And you're describing his reaction to being so dependent on China, specifically when it comes to PPE and health equipment here for doctors. I know you were a doctor. We heard the same thing from Governor Cuomo here in New York, saying that you can't be so dependent on China, basically calling it a national security problem when you're so dependent on China for medical equipment here, that he's calling on hospitals in the state to stock up on that equipment. So that is something we've been seeing from a Democrat as well, not just out of Trump's White House. But when we look at kind of the approach here, now that this is done, I want to put China and everything else aside. Blame, obviously, I think a lot of Americans don't necessarily want to go into that path when they think about the health risks here. So when we think about reopening the states, interesting divide right now. We've seen protests across the country. The mayor in Stillwater, Oklahoma, had struggled with instituting masks and a mask mandate there for anyone entering businesses, had to backtrack that, say they were strongly encouraged instead. After a staff worker of a store was threatened there. So, I mean, obviously, we know masks will help. As I said, you're a doctor. We know the medical benefits of wearing masks in public to cut down on this. Where do you think we stand in terms of politicians instituting that ban and saying that this is something serious that you should take up?
You know, the evidence is very persuasive, Zach. Jeremy Howard out of the University of California, San Francisco, has done some terrific work and looking at Taiwan and at Japan in particular, where wearing masks has been a way of life for a long time, and they've really intensified that. The death toll from coronavirus in both of those quite populous nations is significantly lower than it is elsewhere in the world. So if citizens themselves embrace those simple expedients, wear a mask, thorough hand washing, personal hygiene. Final common pathway is eyes, nose, mouth. If you protect that, will go a long way toward being able to open up. And we do need to open up because this crisis is not only epidemiological, it's not only public health, it's also economic, and that does cost lives and livelihoods. TJ Rogers, founder of Cypress Semiconductor, did some great work mapping out the death toll at 21 days past first death versus the time to shut down in countries and states, and very interestingly found no correlation, which is fascinating. So although lockdown probably does have some beneficial effect in areas of urban concentration across the country, it's reasonable, entirely reasonable for everyone to move forward rationally. Testing's going to be key. Mitigating, you had the doctor on earlier talking about treatments to mitigate the course of disease.
For sure.
That's going to be crucial. And we're going to watch all these laboratories of public policy across the country as they proceed. The next couple of weeks especially are going to be very revealing. And we do have to keep moving forward steadily. And fortunately, we are developing capabilities day by day.
Yeah, unfortunately, we hope that those continue as we see cases continue to rise here. But Congresswoman Nan Hayworth, appreciate you taking the time again. Be safe out there.
You too, Zach. Thanks.
All right, stick around. We've got much more live market coverage coming your way right after this. Welcome back to Yahoo Finance. Right now, the market's still digesting the update we got over the weekend from the Oracle of Omaha as Warren Buffett weighed in on the current state of the markets. Usually very confident Warren Buffett was a little bit more measured on the market in terms of all the uncertainty we've seen now, though he did reiterate the idea that investing in some stock and some index funds over the long term could be still a smart idea despite all the uncertainty and volatility we've seen recently. For more on that, I want to bring on our next guest. Alfred Eskandar is the SALT Financial President and the co-founder of the SLT ETF, and he joins us now. And Alfred, when we look at it, I mean, ETF, when you look at it, what is your kind of advice, your take on his thoughts here when we think about volatility in the market right now?
Well, I think markets now are reminding everyone about risk. When you have an upward trajectory market with very low volatility, we get desensitized to the fact that the markets can be very volatile and quick drawdowns are actually more common than people think. So, the two themes from last year are playing out again now. If you think about it, it was all about the Fed and the big trade deal. And things were moving positive. The Fed was cutting rates. The trade deal was getting done. Lots of optimism. And all of this was fueled by the unbelievable low unemployment rates and wages were working. So you really had a phenomenal environment for equities. Fast forward to 2020, March, scared the hell out of everybody. Not to mention, what we're all dealing with this pandemic, and the markets took a really nasty fall. We've had a uptick in April, right? So whether you think it was a great buying opportunity, and for some of those bullish guys, they did see it that way, and they used high beta funds as well as some leverage products, from folks like Direction, and got rewarded handsomely for it. Now that we're in May, over the weekend, the Trump administration is talking about holding China accountable for what's happened. And we see a much more of a risk off, measure today. And we've seen, obviously, the markets were off, thankfully not as off as they were this morning. But there are things for investors to look at.
Alfred, it's Brian. What element of the risk off market is also due to the Fed and what they've done over the last few weeks?
Well, you could look at the Fed put in a way and give that gives reassurance for folks to dabble in the equity markets. But for even conservative investors, there's many different ways to get market exposure. There's a number of different innovative products out there from different issuers. If you look at some of the products that actually will go into T-bills when volatility picks up to protect from downward losses, like some of the folks over at Pacer. And then you've got other innovative products like buffer ETFs that literally will protect to a certain amount of losses. These are things that investors should look at if they want some protection. Let's not forget, obviously, the low volatility funds. And those have been a less risky way to get U.S. market exposure.
And mitigating risk, always one of the things on the top of Warren Buffett's mind. But Alfred Eskandar, Salt Financial President, appreciate you sharing your thoughts today, my friend. Stay safe out there.
My pleasure. Good to see you guys.
All right, taking a quick break here on Yahoo Finance. Much more live market coverage right after this. Welcome back to live coverage here on Yahoo Finance. I will make one more plug for you to rewatch our exclusive coverage of the Berkshire shareholders meeting and Warren Buffett's thoughts if you haven't done so yet. A very interesting piece of his thoughts that he shared with investors was about the way that the Fed has been handling the response to this unprecedented crisis we have on our hands. A lot of praise for Fed Chair Jay Powell. For more on that, I want to get to our own Brian Chung, who has more on that. Brian?
Well, Warren Buffett in his shareholders meeting on Saturday saying that he puts Jay Powell, again, the head of the Federal Reserve, on a pedestal equivalent to that of Paul Volcker, the former Fed chair who helmed the central bank through the hyperinflation of the late 70s and early 1980s. And Buffett said, quote, Jay Powell, in my view, belongs up there on that pedestal. He said that the Fed's changes were guided by what they had seen in 2008 and 2009. And he actually said that the Federal Reserve has been more proactive than it was under Bernanke and under previous Fed chairs by launching the 9 liquidity facilities, launching aggressive capless quantitative easing, and slashing rates to zero in response to the COVID-19 crisis. He said specifically on corporate debt, that's really the area where the Federal Reserve has really knocked it out of the park. Keep in mind that Berkshire Hathaway operated as a lender of support for the markets in 2008, 2009. You'll recall that they gave massive loans to the likes of Dow Chemical and also Mars during that time. And the Berkshire Hathaway actually said that it had received some calls from some companies in distress before the Federal Reserve really stepped in on March 23rd to announce its own corporate debt facilities to the primary and secondary markets. So it seemed like Warren Buffett quite pleased with how Berkshire Hathaway hasn't necessarily had to step in as its own counterparty because of how aggressive the Federal Reserve has been. One thing that's worth mentioning, though, is that Warren Buffett did say he was kind of watching the ballooning balance sheet as one area of concern, but said largely he's been very pleased with Jay Powell.
All right, there you go. Brian Chung bringing us the latest praise from Warren Buffett for Fed Chair Jay Powell. That'll do it for us here in the 1 p.m. Much more coming up. Stay tuned. The CEO of Salesforce, Mark Benioff, will join us right after this.
Welcome back to Yahoo Finance's live market coverage. I'm Shauna Smith. As it turns out right now, we have the Dow and the S&P both starting the week to the downside. The Dow is off just around 185 points, so off its lows of the day. Now, this comes as investors weigh the reopening of the economy alongside tensions between the U.S. and China. The NASDAQ is the only major index to hold on to gains so far, up just around 0.3%. Sector-wise, we are seeing 10 of the 11 sectors move to the downside. Financials and industrials are the worst performers so far this afternoon. So for more on the markets, I want to get to Yahoo Finance's Jared Blickery. He's standing by with the latest. And Jared, when we take a look at the market's moves slightly to the downside this afternoon, what are investors keeping a close eye on?
Well, we have potentially a sell-off underway here, not just one day or 1 week. We've had a lot of traders eyeing the 2,900 to 3,000 level in the S&P 500. So we're seeing a little bit of continuation from last week's weakness. Especially, I would note that last Friday we had a sell-off into the close, something that we haven't had in about a month. But here we got the Dow down about 188 points. The Nasdaq, as you noted, is the one major index in the green, and then we have the S&P 500 down about 0.4%. But just looking at the intraday price action, really not a lot going on. Volumes are pretty light. A lot of the world is returning from holiday from last Friday. And just looking at the longer term picture here, here's the S&P 500. Now, we did have this 2,900 and change high last week. That was around the FOMC statement. And traders are targeting at a minimum 2,500 to the downside. Not everyone believes that we have to retest the lows, but it looks like so far we are in that sell-off mode, although it hasn't accelerated yet. To the upside, if traders manage to punch through 2880 again, then that scenario is probably off, and we have a short covering rally to potentially above 3,000, which would be pretty interesting. Looking at the sectors, now we have a few in the green. Technology, utilities, and energy all moving to the upside here. And crude oil, I would note, is up about 3% above the $20 per barrel level. And then let's take a look at some heat maps here. We got the Dow. We can see Microsoft is up 1.7%, Apple up 0.5%, tech outperforming. And then we have to the downside, financials under pressure, as you mentioned earlier, Shauna. JP Morgan down about 2%, Goldman Sachs off a little bit more than that. But some of the big losers today include industrials. Now, Boeing is down 4.5%. You can see the year-to-date chart is looking pretty grim. There hasn't really been able to mount any kind of rally off of its lows, although it is getting squeezed here. So whether it takes another leg lower or it ends up getting squeezed higher, we should have some movement in Boeing pretty soon. Another industrial under pressure is Caterpillar. That chart really not looking that constructive either. That's down about 27.5% year-to-date. And then let's take a look at our NASDAQ heat map. And we will sort by performance here. And we can see that in the lead is Tesla, up 5.5%. I don't think we've gotten any commentary from Elon Musk today on that share price being too high, but we'll have to wait and see what his next tweet involves. And to the downside, the airlines just getting whacked again. United, you can see at the bottom of your screen, is down about 8%. Also, Marriott is off about 4%, Wynn off 4% here. So we're seeing a lot of the names that were getting whacked early on in the COVID sell-off just really underperforming today. Shauna?
Jared, real quick, I just want to follow up about crude because you mentioned the little bump that we are seeing in the price of crude today, up just around 2%, but more importantly, crossing back above that $20 a barrel level. How critical is the fact that we are now above $20 a barrel?
Well, it's funny because now we're talking about things looking bullish with crude oil with a 20 handle, quite a reversal of a few months ago. But yeah, this is a psychological price target here, and this is for the June contract. A lot of people aren't even bothering to roll into the June contract, especially ETFs. They've moved out to September, October, November, December, even some of them buying next year. But here's December crude oil, and you can see this is more recently priced at about $28.79. And if you look at Brent, now this is July Brent, which just became the front month, that is up to about $27. Shauna?
All right, Jared, thanks so much for breaking that down for us. Well, one thing that investors are closely watching that we haven't mentioned yet is the latest development pertaining to the coronavirus. So the number of confirmed cases worldwide has now crossed 3.5 million with nearly 250,000 deaths. Now, this comes as businesses around the world are preparing to welcome their employees back to work. Now, several countries, as well as some states right here in the U.S., are beginning to ease their coronavirus restrictions. Now, today we had Salesforce announcing new products to help businesses navigate reopening during a pandemic. So for more on that, I want to bring in Mark Benioff, Salesforce Chair and CEO. And we also have Yahoo Finance's Julia LaRoche joining the conversation. And Mark, thanks so much for taking the time to talk to us this afternoon. Let's start with the announcement you made today for work.com. Just talk to us about how does this help businesses and communities safely reopen, and what do you think we'll need to do differently when we go back to work here over the next couple of weeks, next couple of months?
Well, this has been such a challenging time for all of us, and especially for our employees. We have 50,000 employees at Salesforce, 50 of them that have had the virus. And, my hearts have really been with them, and everyone has been affected. by this terrible situation. And as we've looked out, we've really seen this occurring in 3 phases. And the first phase has been this 90-day crisis phase. That's when we're all in our homes, obviously, and we are sheltering in place, so we're quarantined. During this time, the big thing we've done is we've purchased 60 million units of personal protective equipment, PPE, and distributed that to 200 hospitals. We've worked closely with our partners, including Alibaba in China, to get that prioritized for the United States. That's been extremely important to us. We've also worked with 6,000 organizations to deploy emergency versions of Salesforce.com, including the state of California, the state of New York, and others. But the first phase is really ending, just like you said. We really thought that was a 90-day phase, and we can see that we're getting ready to get back to work. In our office in South Korea, for example, our employees are already meeting with customers, and on May 11th, we'll reopen our doors there. And that's an indication to us that all of us need to be ready to get back into the office and deal with the new work environment. But we need to realize that when we do get back in the environment, back in the work environment, the virus is still going to be there, and we need to be doing things to mitigate that environment. And so that's why we'll probably have PPE in the environment. We will also be taking our employees' temperatures before they come to the office. And we'll be deploying information technology, like you mentioned, work.com, and deploying contact tracing to help our employees be safe in the office environment.
Hey, Mark, it's Julia LaRoche. Thank you so much for joining us to talk work.com. I want to dig a bit more into this idea of reopening. You are the CEO of San Francisco's largest employer, more than 36,000 employees. And you just mentioned a few things. What do you think the reopening looks like for you all? And what are the challenges that come along with that?
Well, I think that, many of those things that I mentioned, we will bring into our workplace. And you can imagine also that social distancing, which we're all doing right now, staying 6 feet away from another employee or customer or person, well, we're going to do that in the workplace as well. That will not go away. The reason why is the virus is still going to be out there when we get back to work until we're all vaccinated. So we need to kind of set up a work environment that makes it as safe as possible for our employees. So like an example, you know that we have a Salesforce tower there where you are in New York. We have one here in San Francisco. Well, we have these things called elevators. And elevators, well, you all admitted them. 10 people jam in the elevator and the elevator door closes. Not great in this pandemic situation. So maybe there's only so many people that can be allowed in the elevator at one point. Maybe people can only sit in certain parts of the office. There'll probably be shifts of employees. That's why we built shift scheduling into work.com, because you probably will have teams of employees, team 1, team 2, team 3. Maybe team 1 is in the office on Monday, team 2 is in the office on Tuesday, team 3 on Wednesday. We've already deployed this in Singapore, for example. That's because if someone on team 1 gets the virus, you don't want to lose team 2 and team 3. You want to keep your productivity going. So there's things that you're going to do. And we've taken all of that advice, medical advice, from people like Larry Brilliant, who's an epidemiologist, David Agus, who's our chief medical advisor, as well as Scott Gottlieb. And we've put all of that into work.com, as well as recommendations from the Business Roundtable, which is an organization that I belong to, of CEOs that is doing policy recommendations. So that when you go to work.com, you're going to get advice. You're going to have a community of people to learn safety from, and apps like contact tracing, workforce triage, shift scheduling, all in one place. Now, I could not have imagined that this is something that I would have had to do, Julia, just a few months ago. In fact, Julia, if you remember, we were in the World Economic Forum in Davos in Switzerland just a few months ago. We had no idea that this is where we would be today. But we've had to
certainly shift. A new world, Mark.
Yeah, amazing.
Yeah, and to that point, you all have been so far ahead of this, whether it's the PPE, leveraging Tableau's data, now coming out with work.com and really making it readily available to companies. I guess one thing that really stood out to me, Mark, and you just mentioned it, the contact tracing, leveraging your IT to do that, I guess. How do you think about maybe the privacy implications of that? I would love to hear your thoughts on how do you balance that?
Well, let me tell you the story, which is the governor of Rhode Island. She called me, and she's amazing. She said, we're doing a great job of managing risk mitigation here in Rhode Island, but we're doing virus testing, but it has to be coupled with contact tracing. So they're doing the testing, but then when they find somebody who has the virus, then they start to interview them and say, well, who have you been with? And who are your friends? Who did you have dinner with? Who did you see in the last week or two? And then they just call those people back. And that's an information management challenge. You know, that's contact tracers. They're almost like private investigators, if you will, using our technology, which is the contact tracing now built in work.com, to manage, okay, this person was with the person who is infected. Did we talk to this person? Did we notify them? Yes, and then move on. And so that is a very kind of a manualized contact tracing. It's a little different than the contact tracing that you hear in some Asian countries, which is all automated, where they've traced you through your phone, or they know where you've been, and therefore something just automatically appears on your phone and says, oh, you've been with someone who's received the virus. Well, we don't have that level of IT integration in the United States. That's not where we are. Plus, our privacy laws would prevent any such thing from happening.
Hey, Mark, I want to ask you, just follow up on work.com. And one initiative in work.com that you mentioned is reskilling employees. And we talk time and time again here at Yahoo Finance, just some of the changes that will come after the coronavirus outbreak has passed, and how it is already changing the economy, not only here in the US, but really throughout the world. So I want to get your thoughts. Just what are some of the biggest changes that you see from an employee perspective, from someone who manages thousands of people, that you could see happening within your company over the next couple of months or years?
I think that's such a relevant question because, you know, we're moving into a work environment, and a lot of people are going to be looking for jobs. That's why we've been seeing a lot of activity on Trailhead, which is our reskilling system that we've now built into work.com. And for people, we have almost 2 million people on Trailhead learning new types of skills. In fact, work.com was built in a non-programmatic environment, mostly by non-programmers, a lot of whom were trained on Trailhead. And this idea that you can learn marketable skills in that type of an online environment, this is something that's extremely important at a time like this. Another great example is we're going to have a big group inside of our company, and every company will have this, on reopening and reopening safely. And all of those skills are going to happen on work.com as well. In fact, we're already training people on how to reopen safely. Those will be experts. You can imagine, you know, training and certifying yourself as somebody who could be hired by a company to make sure their workplace is safe. You know, the future never equals the past, and we constantly have to be thinking about what it means to have a beginner's mind. You know, in a beginner's mind, there's every possibility. In the expert's mind, there's few. And we need a beginner's mind as we enter this new workplace and getting back to work. We need to have an open mind so we can be ready, you know, and all be a participant in this new economy.
Mark, I think that's so well put to bring up the beginner's mind, something we've often talked about. Another thing that we've talked about, digital transformation. We're seeing this acceleration, it seems like, because of COVID-19. And I want to cite someone in your own press release. It was a customer of Salesforce, and he said, I'm confident that without the digital quote-to-cash transformation we completed with Salesforce and the App Exchange, we would not have been able to adapt and respond as quickly. So my question for you, just looking at your clients, retail, for example, what kind of changes are we going to see as it pertains to digital and the importance of digital going forward?
Well, Julia, thank you for bringing that up, because we are getting so many stories from our customers of how they're using our technology to be successful at a time like this. And I think you're using a case study, which is Tough Shed, who sent us a note about how they've been able to increase productivity and get back to work safely and move their sales and service organization into their homes. We also saw that with Dell, which is a very large sales and service organization, move entirely into their homes overnight using Salesforce technology. And that's something that's really possible because of the cloud. It doesn't matter really where you're working. And you know, we can see that our customers have been able to be productive during this environment. And we want to continue to create more and more tools that allow them to do that. We even have a new service called Quip, which is a full productivity environment, spreadsheets and word processors and collaboration, that has been extremely successful during this moment. And I think that we're going to see more and more of this going forward, that people need tools that work not only in the office, but work well in the home or the mobile environment as well.
Mark Benioff, Salesforce Chair and CEO. We really appreciated you joining Yahoo Finance. We hope to have you back in the future.
Thank you for having me today.
All right, well, coming up next here on Yahoo Finance, taking a look at some of the airline names. They are taking a huge hit today, amongst the worst performers, specifically in the S&P. Now, this comes after Warren Buffett says that he dumped his stakes in some of the sector's biggest names. We'll have more on that right after this break. Welcome back to Yahoo Finance's live market coverage. Berkshire Hathaway posting a net loss of close to $50 billion in the first 3 months of the year as the coronavirus weighed on its business. Now, among the big headlines that came out of the shareholders meeting over the weekend was Warren Buffett's decision to dump his stakes in the airlines. Let's take a listen to what he had to say about this decision.
When we sell something, very often it's going to be our entire stake. I mean, we don't trim positions or like that. That's just not the way we approach it any more than if we buy 100% of a business, we're going to sell it down to 90% or 80%. I mean, if we like a business, we're going to buy as much of it as we can and keep it as long as we can. But when we change our mind,
next
go
question.
ahead. I'm sorry.
No, go ahead. When you change your mind?
Well, when we change our mind, we don't take half measures or anything of the sort. So I was amazed at how, frankly, now we were selling them at far lower prices than we paid, but I was amazed at the volume. The airlines always trade in large volume relatively, but we have sold the entire positions.
Now, for more on this, I want to bring in Kathy Seifert, as CFRA Research Equity Analyst. And Kathy, thanks so much for joining the show this afternoon. Let's start with Buffett's assessment of the airlines. What did you think of it, and what did you think of his decision to sell his stakes in them?
Sure, it's interesting, and it sort of comes against a backdrop of a quarter that, you know, Berkshire is sort of a microcosm for the broader economy. And I think people who were listening to the annual meeting were maybe a little bit surprised or shocked by the decision to sell the airlines. It sounded like he was almost a little uncomfortable with the decision, or it was a bit awkward in terms of in terms of how he communicated it. It's also a little unorthodox. I mean, typically you'd file an 8K. You don't just sort of drop that little bombshell at a shareholder at an annual meeting, but that's also the way Berkshire Hathaway operates. But I think it's a function of they're looking across the different sectors in the economy where there is going to be pretty permanent demand destruction. And I think they've probably concluded that it's in the airline space. But I also think that it needs to be looked at against the backdrop of all of the Berkshire operating companies that are also going to be exposed to an economic downdraft.
Hey, Kathy, you mentioned there that Berkshire is a microcosm for the broader economy. So drilling down into some of its businesses and what we know, the impact that coronavirus has had on some of Berkshire's largest businesses, what do you think we can gather from that just in terms of what we could expect for the broader economy here going forward?
Well, and I think some of the tone of, some of Buffett's tone at the annual meeting probably reflects what they're expecting, which will be a really weak second quarter in all of the sort of the industrial, the energy, the rail, the consumer-oriented names. Their core businesses in insurance, and unlike some other commercial lines insurers, I'm not overly concerned about their claims. I think they're going to have some workers' compensation claims. Geico could actually benefit from a reduced level of driving activity. Competitively, though, I don't think Geico is in as strong a position as Progressive and Allstate in terms of usage-based insurance, which I think is going to be a fallout or, as a result of all of this, I think that's going to gain in popularity. But I think if you look at some of their industrial, their energy spaces and their consumer spaces, I think they're heading into a quarter that could be very, very tough and will likely recover as well. But the tone that I got from listening to his comments at the meeting was one of concern.
When you talk about concern, there was a lot of conversation, I think, after the meeting just about some of Buffett's comments about the broader economy, what we could expect here in the short term. But there was also a lot of talk about why he hasn't made any big investments recently and whether or not Berkshire should have been taking a more aggressive action over the last couple of months. As someone who closely follows Berkshire Hathaway, what do you think about that?
Well, I mean, I think you have to look at it against the backdrop of a couple of things. Number one, they have dry powder, but so do a lot of private equity firms. And in this day and age, they're competing with private equity for acquisition targets. So the competition for sort of trophy names, if you will, is a lot more intense than it was 10 to 15 years ago. The other thing is Berkshire's recent acquisitions haven't really panned out all that well. I put in my note this morning, I just sort of highlighted to investors that they're carrying their Kraft Heinz investment on their books at over $13 billion. And the fair market value at the end of March for Heinz was $8 billion. Now, Kraft Heinz is a staples company, and they'll probably weather the economy a little better than more cyclical names. But, look at the Oxy deal. I mean, they struck a deal and people were cheering. The strike price of those warrants is $62.50. Oxy's trading below $20 a share. So, they made a couple of really large deals that are really kind of out of the money. And I think that has also maybe curbed a little of their enthusiasm for another big deal. And then the final point I would make is that, they still are an insurance company. We're heading into hurricane season. It's expected to be more active than usual. I think they'll also keep dry powder for that reason, which is obviously a prudent thing to do.
Yeah, that's an interesting take there. Kathy Seifert, CFRA Research Equity Analyst. Thanks so much for taking the time.
Take care.
We're going to take a quick break, but when we come back, Roche wins FDA approval for its emergency use of its antibody test, and they say it's 100% accurate. We're going to have more on that when we come back after this quick break. Welcome back to Yahoo Finance's live market coverage. We have news out today that the FDA is tightening regulations for its COVID-19 antibody tests. Now, this comes after Roche's antibody test won FDA approval for emergency use over the weekend. We have Anjali Khemlani joining us now with more on this. And Anjali, I know you spoke with the CEO of Roche this morning. What did he have to say?
Yeah, Shauna. So we know that, they got the emergency use approval over the weekend, but they're talking about how this is really an easier test to ramp up. We know that we're all pretty scarred from the nasal swab testing and the supply shortage that ran into for multiple reasons. But the CEO seemed to be pretty confident that the antibody testing ramping up in the next 2 months will be able to meet the demand of what we need in order to continue to look at reopening the economy. So listen to what he had to say about that.
I'm confident that we will be able to provide this test in high quantities and that this will allow the testing of broader parts of the population. Just to put this into perspective, in May alone, Roche will ramp up its production into the high double-digit millions of tests per month. So this is already at the very beginning a multitude of what we can produce of molecular tests.
That up, saying that it's a lot easier to ramp up antibody testing. And that's one of the things that everyone is looking at when you talk broadly to public health experts. It's a combination of having a treatment available as well as testing and continuing social distancing measures that everyone is looking at in order to stay safe. Shauna.
All right, Anjali, thanks so much for the latest on that. Now, for more on this, I want to bring in Dr. Lena Wen, emergency physician and visiting professor at George Washington University School of Public Health. And Dr. Wen, thanks again for joining the show. Let's start with what Anjali was just saying, the latest coming from Roche, the fact that this could potentially lead us to significantly ramp up testing. How do you think that this test, the approval of this test, is a game changer for testing? All right, Dr. Wen, it seems like we are having some issues. Looks like you just muted yourself. Leah, let's see if that works now. Okay, go ahead. Thank you.
All right, apologies for that. So I do think that this antibody test is important, but it does not replace the other test that we always talk about, the PCR test, the swabs, because the other test looks at whether somebody currently has the infection. And we need to know that if somebody has symptoms, we need to know, do they currently have COVID-19? Or if they don't have symptoms, we also have to know, because of the high number of asymptomatic carriers there are, we need to know whether somebody is actively infectious and able to pass on the virus to someone else. The antibody test is useful as an adjunct as well, because we also need to know, has somebody been exposed before? And ideally, if somebody has been exposed and they have immunity, that would mean that they may be protected from having COVID-19 in the future, although that's still a big if. So this antibody test is important, but I don't think it should dissuade us from getting more of those PCR tests to find out if somebody actually has the infection right now and can pass it on to others.
So Dr. Owen, we've been talking a lot about testing, why that's so important, why we need more tests. There's also been lots of talk about potential vaccines, potential treatments. I want to get your thoughts on what President Trump said over the weekend. And he was very positive in an interview last night. And by that, I mean that he was saying that we will have a vaccine by the end of the year. Do you think that this is within the realm of possibilities?
I mean, it is the most optimistic estimate that I've heard anyone say. And I think that has to assume that everything will align perfectly and we'll just strike gold and get really lucky. Now, still though, even if we have a vaccine by the end of the year, that doesn't mean that we'll have vaccinations. And I think that's really important, because even if you have a drug approved and it's effective, it's only going to be effective if everybody is able to receive this vaccine. And the idea of getting millions and millions of doses, maybe billions of doses produced by the end of the year, and for us to have gone through all these clinical trials, that seems like a pretty big stretch to me.
So Dr. Wen, what do you think is a more realistic timeline?
Again, I think even in the best case scenario, we should still be looking at a year to a year and a half of getting approvals for a vaccine. And then it will take even more time for us to get the vaccine into people's hands. A lot of that will depend also on what the federal government does when it comes to putting into place something like the Defense Production Act. I mean, I'm worried that we haven't really put into place this act for getting personal protective equipment and ventilators and swabs and reagents for these tests. So are we really going to be able to do that also if and when we do get a vaccine? If we do, then we'll be able to get it a lot sooner. But I hope that we'll.
Yeah, Dr. Wen, it looks like we lost your audio, so I'm going to try and ask this question, and maybe we can get it figured out while I'm asking this. But Dr. Wen, I want to get your thoughts on, so we've talked about the fact that we don't have a vaccine. We're not going to have one for quite some time. We don't have a treatment. We still have a shortage of tests, yet we're seeing more and more states scale back their coronavirus-related restrictions. And we have Florida today beginning their reopening process. What's your assessment of the reopening plans across the country so far? And from your perspective, do you think they're being done safely?
Well, the White House issued clear guidelines that were based on evidence about when reopening should occur. And the baseline criteria was that there should be a consistent 14-day decline in the number of infections. And I really worry that many of the states that are reopening have not met that basic criteria as it is, much less taken into consideration that because of lack of testing, we don't know the true numbers that are there in the first place. So I really do worry because we know what's going to happen. I mean, the one thing that hasn't changed in all of this is the virus. We still don't have a vaccine. We don't have a treatment. This is a highly contagious virus, including for individuals who don't have symptoms, can transmit it to others. And so I just worry that we are, by definition, going to see a resurgence in the number of cases. And the question is, what's our tolerance for that? Will we be able to dial it back and increase restrictions again if we see that resurgence? And how many of the capabilities will we have built in the meantime? Because the whole point of social distancing was to buy us time. It was to buy us time to get more testing, more tracing, more treatment, more preparations available. And I just hope that all those sacrifices that people have made will not be in vain if we roll back the restrictions too soon.
All right, Dr. Leana Wen, emergency physician, visiting professor at George Washington University School of Public Health. Thanks so much for taking the time this afternoon.
Thank you.
Well, coming up here on the other side of this quick break, we're going to talk about the housing market. Zillow is out with a new report saying just how fast they expect to see the housing market bounce back from its recent slump triggered from the coronavirus. We've got those answers right after this break. Welcome back to Yahoo Finance's live market coverage. I'm Shauna Smith, checking in on the market action with less than 90 minutes left in the trading day. We still have the Dow and the S&P trading to the downside. The Dow is now off just around 188 points. The S&P off just around 0.4%. The NASDAQ, the only major index, holding on to gains up just around 0.3%. I want to point out oil. We had crude oil closing just a few minutes ago. Oil closing to the upside above that $20 a barrel mark. So continue to monitor the markets here for you for the remainder of the trading day. But first, I want to get to the latest when it comes to housing. So we've seen a significant slowdown in the housing market nationwide. And this comes as buyers and sellers really put their plans on hold amid the coronavirus pandemic. Now, Zillow is out with a new report today on the impact from the virus and when we could expect to see a potential rebound. So for that, I want to bring in Skylar Olson, Senior Principal Economist at Zillow. And Skylar, it was a very interesting report. Thanks for joining us to discuss this. Let's start with how hard of a hit do you think we're seeing right now to home sales this spring because of the coronavirus?
Yeah, we are absolutely seeing economic activity being impacted in housing. Right now, actually, we are expecting that the bottom is here, right? So we saw pending sales, for example, hit bottom mid-month during April at negative 39% year over year. So much, much lower, of course, than those 2019 levels. Sales, coming after pending, we expect to happen at this point now. If I think about, where we were in February, which was actually going, we were on the way up, sales activity was increasing even in a seasonally adjusted way, as well as we were entering what would have been a very, very, very strong home shopping season. We do expect sales to fall anywhere from 50 to 60% from those heights, and that bottom is pretty much now. Now, we'll be able to confirm those home sales numbers when we start receiving those reported records from county offices. In the meantime, the pending sales do seem to confirm about the magnitude of this fall, and then we'll get into the business of steady but slow recovery.
When you talk about that recovery, when can we expect to see a rebound in the housing market? What is the timeline for that?
Yeah, if you want to think of the general shape that home sales are taking, it's like a check mark, right? An immediate fall. And then, at first, rapid recovery as we're seeing a lot of home buyers that were frustrated from previous years, low inventory, currently low interest rates, credit standards are high. But if you were ready, you're potentially looking right now. We'll start seeing that activity increase at first, but then we're expecting about a 10% increase each month off of those low bottoms, which will put us at a full recovery to those really solid February numbers, not really until mid-end 2021.
Skylar, when you take a look at the housing fundamentals, absent the coronavirus, which obviously is having a huge impact on the sector, but just strictly the housing fundamentals, do you think they're still pretty strong at this point?
Yeah, I mean, absolutely. If you take the virus out of it, that's actually one of the reasons why we don't expect prices to fall very much over the course of this recovery. The expectations are just anywhere from 2 to 3% dropping. Now, that would feel very large if we didn't just have an incredible example from 2008 to 2012 where prices fell 30%. Remember, that was an era of excess credit, excess inventory, so that when we went through joblessness, a lot of it came tumbling down because of foreclosures and distressed sales. Housing is so much more resilient leading into this crisis than it was before that one. Credit was still very tight. Home ownership rates still remained very low, and building had not really come back yet. Actually, it had just reached that million unit rate mark that we were waiting for to signal that builders' confidence has returned, and then this.
Yeah, Skylar, I want to, because it's interesting in your report. So you gave what you're expecting for home prices, but then you also have a pessimistic scenario and then also a more optimistic scenario. But I want to ask about the more pessimistic scenario, which you said only has a 25% likelihood that it will actually happen. But this shows the fact that we could see home prices drop in the 3 to 4% range. What are the key factors that you're looking at that could potentially trigger this scenario?
Yeah, so getting to that more pessimistic scenario really reflects a more pessimistic scenario in general for our greater economy because, housing kind of starts from a resilient place. We are absolutely experiencing what the rest of the economy is, right, which is the joblessness, the income loss, the lack of confidence, the greater uncertainty. So the pessimistic scenario is a pessimistic one for the greater economy as a whole. So a deeper fall in GDP than what we're expecting in the more likely scenario, and a much slower GDP recovery as well that will in turn lead to slower recovery in sales and prices.
Skylar, what areas, when we take a look at how coronavirus is impacting real estate, what areas of the country do you think will be hardest hit from coronavirus?
Absolutely. Yeah. Right now, economic activity, housing activity included, is much more correlated with the course of the virus itself than, say, shutdown orders or anything else. So the Northeast in particular is really struggling and still struggling on our housing indicators as well. So, much deeper fall in pending sales, for example, much deeper fall in search activity, and not quite as much of a turnaround yet in those areas.
And speaking of a turnaround, are there any areas where you're already seeing a rebound or that you expect to rebound the quickest?
Well, we're already seeing a rebound actually in terms of pending sales activity and in the course of new listings. So the number of homeowners that are putting their home on the market for sale, those absolutely fell in a very dramatic way, but we've since seen those numbers start to inch up slowly. The places that are where the fall wasn't so bad and the inch up is a bit more significant are places like Dallas and Houston, Minneapolis, kind of areas in general that haven't been hit quite so hard by the virus itself.
All right, Skylar Olson, Senior Principal Economist at Zillow. Thanks so much for joining.
Yeah, thank you for having me.
We're going to take a quick break, but when we come back, we'll talk about how coronavirus is disrupting food supply chains. You might have noticed this at your local grocery store, triggering food shortages at U.S. supermarkets here nationwide. We'll have more on that story and what exactly can be done to stop this shortage right after this quick break. Welcome back to Yahoo Finance's live market coverage. Now, coronavirus is disrupting the food supply chain as grocery stores are scrambling to keep their shelves stocked. Now, I'll take just one example. It's frozen French fries. Now, sales of this spiked in the beginning of April, and now there's a shortage at many U.S. supermarkets. But it's not because there aren't enough potatoes. Instead, there's, of course, problems with the supply chain. So we want to dig down into what exactly is going on. And for that, we have Blair Richardson, CEO of Potatoes USA. And Blair, thanks so much for taking the time to talk to us this afternoon. And we've been talking about over the past couple of weeks, the shortage that we were seeing, or the disruption, I should say, in the food supply chain. And so I mentioned the fact that frozen French fries, many grocery stores can't seem to keep their shelves stocked with them. And it's interesting because when you take a look at what's going on, U.S. farmers are actually sitting on a ton of potatoes at this point, yet we're seeing the shortage. So can you help explain to us what exactly is going on?
Well, sure. Thank you for allowing us to be here today. More than a ton. We have over 1 billion pounds of potatoes just in the state of Washington that are in jeopardy of being wasted this year. They're currently in storages. And it's primarily because of the changing supply and demand channels, where in the past, about 41% of all the potatoes grown in the United States were destined for processing plants in the United States that would produce frozen French fries, tater tots, hash browns, and other products. And when the food service sector was shut down this past couple of months, it totally disrupted everything that the system was allowed to or had created over the many years.
So, Blair, then what do you think needs to change? I guess when we take a look at the fact that there are serious issues with the supply chain, what can we do to best address this? What can we do to fix this problem from happening down the road?
Well, at the moment, in the short term, it's going to be very challenging to address this fully. Certainly, the industry is doing everything it can by helping move as much product as we can to food banks and other charitable organizations that are able to accept and utilize these potatoes. However, they're really not in the form that most organizations and distribution channels can accept. So they're coming out of large storages, have not been washed or cleaned, and most consumers and most retail outlets are looking for a clean and packaged product. Even if we wanted to put these potatoes into retail stores right now, the challenge with actually not having them in the right form, in the right packaging, to meet the FDA guidelines and rules for labeling, make it very difficult to move these potatoes through the channel. And then you have to consider who's going to pay for that. The farmers are already taking significant losses on this. Processors are taking losses. And now it looks, where do you actually move the potatoes from Washington, Idaho, and other states into the consumption centers?
Blair, you mentioned the FDA rules for labeling, how that's standing in the way. A lot of these farmers don't have the resources in order to be able to change this. So we take a look at what the government can do, what federal action can do to help this. Do you think government intervention is needed? And then what do the farmers want from the government?
Well, certainly the industry has been working with the U.S. Department of Agriculture and Congress to come up with some ideas and plans of action that would allow them to alleviate this situation to some degree. In fact, just this morning, U.S. Department of Agriculture announced a $50 million purchase through Section 32 programs that would hopefully help pull some of the product out of storage and move it into proper channels. Really don't have a lot of details on how that's going to happen. But when you look at the fact that we may have $1 billion worth of potatoes sitting out there without a home right now, that's a long way from making a big impact.
It certainly is a long way from making a big impact. So when we talk about the number of potato products that are clogged in the pipeline right now, any idea just exactly how long this could potentially last?
That's a fantastic question. And unfortunately, we don't have a lot of clear view of a great view of where we're going with that. Certainly the processing companies are looking at ways to address this. It's really going to depend largely on when restaurants and food service organizations get back into operation. With something like 81% or 85% of all frozen potatoes going into food service, if we don't have restaurants and bars customers eating French fries and tater tots, it's going to be a long time before we fix this situation.
All right, Blair Richardson, CEO of Potatoes USA. Thanks so much for taking the time, and we wish you all the best.
Thank you very much.
Well, we are going to take a quick break, but when we come back on the other side, we'll have more on J.Crew filing for bankruptcy. Now, this comes as retailers get slammed by the coronavirus. What exactly is ahead for the company? We'll have those details right when we come back. Welcome back to Yahoo Finance's live market coverage. I'm Shauna Smith. We have just over an hour left in the trading day, and the S&P and the Dow continuing to move to the downside, although they are well off their lows of the day. The Dow now off only 114 points, while the S&P is off nearly just around 0.1%. Sector-wise, we are seeing 8 of the 11 sectors moving to the downside today. The only sectors holding on to gains are energy, that's up just around 0.9%, as well as technology and utilities. So those 3 sectors are the only sectors in the green today. I want to get to a big story that we are watching in retail, and that is J.Crew filing for bankruptcy. Now, of course, this comes amid the coronavirus pandemic, forcing a wave of store closures. We have Yahoo Finance's Emily McCormick, who's been closely tracking this story. And Emily, when we take a look at so many of these retailers that are in trouble, J.Crew becoming the first real national retailer to file for bankruptcies amidst this coronavirus pandemic.
Absolutely, Shauna. So this is something that we really did see coming for a while now. J.Crew has had issues, particularly with its balance sheet that far predated the coronavirus outbreak. If we think about it, J.Crew had $1.7 billion in debt since its 2011 leveraged buyout with a couple of private equity firms. So this company had been highly levered for almost a decade now, and just now filing for Chapter 11 bankruptcy, according to today's filing. And specifically looking at the terms of this deal, this was an agreement to swap about $2 billion in debt for an 82% stake in the reorganized J.Crew. So it's now under new ownership by companies including Anchorage Capital Group, Blackstone's GSO Capital Partners, and Davidson Kempner Capital Management. Looking at the company overall, it has about 181 J.Crew branded stores, 140 Madewell stores, and 170 factory stores, most of which have been shuttered nationwide due to the coronavirus pandemic. So sales really have been dropping. We saw that in the fiscal year ended February 1st with a net loss of nearly $79 million on revenues of $2.5 billion. So a lot of concerns for this company, again, predating the pandemic, now finally culminating with this Chapter 11 bankruptcy.
And Emily, real quick, while we talk about who could potentially be next, Neiman Marcus is also in a tough spot right now as well.
Absolutely. So we do have some reports from media outlets, including the Wall Street Journal, that Neiman Marcus as well as JCPenney have been speaking with their own lenders about potential bankruptcies as well. Looking over across the retail landscape overall, we know that retail sales, as measured by the Commerce Department, were down more than 50% in March from February. So really troubling times for the industry, particularly these stores that have relied heavily on brick and mortar. Shauna?
All right, Emily, thanks so much for breaking that down for us. Just around an hour left in the trading day. Dow and S&P both moving to the downside. The NASDAQ, the only major index holding on to gains, up just around 0.5%. Now, this comes as technology is one of the only sectors to move to the upside today. Technology, utilities, and energy are the only 3 sectors in the green. Well, let's keep it right here on Yahoo Finance. Our live market coverage will continue right after this short break.
Go, Akiko.
Welcome to Yahoo Finance Live. We have about an hour left to go in the trading session today, and we're seeing a bit of a mixed picture right now. The Dow is down about 89 points, coming off of the lows we saw earlier in the trading session, but still in the red. The S&P 500 just hovering below that line right now, trading at 28.29, and the Nasdaq, the only one of the major indices in positive territory, that is up about 54 points right now. The big headline today, of course, the airlines in sell-off mode there after some very bearish comments coming from Warren Buffett at the Berkshire Hathaway shareholders meeting over the weekend. We're going to get to those comments in just a bit, but certainly airlines in focus, Tyson Foods also in focus after some grim numbers we got there today. And then we're seeing a bit of a bounce back in energy after oil turned positive, oil up about 3% or just over 3% today. So a lot of headlines to get through too, but I want to bring in my co-host Jen Rogers for a broader check of the markets. Jen, what stood out to you?
Hi, Akiko. I mean, of course, what we have seen with airlines and Tyson Foods sneaking in there with airlines to be among the worst performers of the S&P 500, as you pointed out. But I'm actually going to go on the positive side here because we are off session lows right now. And we have the NASDAQ in the green, in fact, the NASDAQ getting there mid-morning. So tech. The story with tech here seems still to be in place. Some of those big cap tech stocks that have taken us on this rally that we saw, at least in April, back in form today. As you noted also, energy there, I want to point out crude right now with a small green arrow as well.
And Jen, let's talk about the sector in focus today, because there was a lot of coverage over the weekend. Obviously, you were part of the Yahoo Finance coverage of the Berkshire Hathaway shareholders meeting, and a lot being made of Warren Buffett's comments on the airline. Some very bearish comments there, essentially saying he's dumped all his airline stocks. But I want to listen to what he had to say and then maybe get your thoughts on the other end.
Just to clarify on his question, he asked, did you sell your whole stake in all four of those?
The answer is yes. Yeah, when we sell something, very often it's going to be our entire stake. I mean, we don't trim positions or that's just not the way we approach it any more than if we buy 100% of a business, we're going to sell it down to 90% or 80%. I mean, if we like a business, we're going to buy as much of it as we can and keep it as long as we can. But when we change our mind,
the next
go
question.
ahead, I'm sorry.
No, go ahead. When you change your mind?
Well, when we change our mind, we don't take half measures or anything of the sort. So I was amazed at how, frankly, now we were selling them at far lower prices than we paid, but I was amazed at the volume. The airlines always trade in large volume relatively, but we have sold the entire positions.
So there you have it, Warren Buffett saying we have sold all our positions there. And Jen, I mean, this is what we expect to hear from him. In other words, we're either all in or we're out completely. And right now, he doesn't see a whole lot of value in airlines.
I think it was, I mean, there were, even though people maybe had inkling, some people were thinking, is he out? A lot of jaws hit the floor here because Warren Buffett is a long-term investor. He is the eternal optimist. He's seeing 10 years out. And so for him here to feel that airlines are in such dire shape, he's not watching the stock price day to day saying, oh boy, wow, Delta fell 20%. He's saying this world has changed and I don't see how Delta recovers from that. And that is really frightening to a lot of people. I think that sense that Warren Buffett himself can't see a turnaround for airlines is kind of what's really leading to the sell-off here. It really caught people's attention.
Yes. Yeah, no question about that. When you look at the moves right now, American Airlines down more than 8%, Delta down more than 6%, Southwest down 6%. I mean, Dan Roberts, what do you make of those comments that we got over the weekend?
Well, I was just going to add, you guys, that it's interesting how Buffett kind of fell all over himself to say that I feel great about the airlines. We wish them the best. They're good businesses. They're good companies. And yet to think that he's selling off the stakes entirely, it's not a vote of confidence. And it's funny because we know kind of the age-old philosophy that Buffett has of buying and holding for a long time. He reiterated that wisdom repeatedly over the 5 or so hours that he spoke over the weekend. And yet hard to really take anything away from his move regarding the airlines other than he doesn't believe that in the short term they're going to do very well. And it does sort of fly in the face of his investing theory. If he really believes that they're going to come out okay after a little while, then why not hold on, especially because obviously Berkshire had some losses here with these airline purchases.
Yeah, and then staying within the airline space, we did get some numbers out from GE today, planning to cut 13,000 jobs. That's about 25% of its workforce in the aviation unit. Of course, GE reporting last week an 8% drop in Q1 revenue. So that certainly doesn't instill confidence in this sector either. Another sector we've been watching really closely today is Tyson Foods, or not a sector per se, but we've been talking a lot about the food sector, the supply chains, and whether they will be able to withstand the demand. And we've seen the stock under pressure on the back of some comments we got from the company today. Net income, they're falling 15% in the previous quarter. Total volume was up, but it was what the company said about their supply chains and some of their manufacturing or some of their factories that led to the concerns, essentially forecasting a higher cost of production, lower productivity. And of course, Jen, we've been hearing a lot about coronavirus cases within these factories stopping production. There's concerns now about whether this could lead to some kind of shortage. We heard Costco today, so they're going to start limiting some of the supply. So how should we be looking at the space right now? We heard early on in the pandemic that we're not going to run out of food, but of course that didn't factor in workers themselves getting sick.
Right. I mean, all about the supply chain here. And one of the things that I've been thinking about with Tyson is going back to Amazon's earnings that we had last week. Obviously, very different companies, but Amazon having great demand for online sales as well, but telling us that they are going to have to spend a lot more on their employees, on PPE, on testing. Okay, Amazon. This company is seeing their margins hit. What do you think is going to happen to a company like Tyson? I mean, that is part of the profit issue here. It's going to be expensive to be able to keep your supply chain as you want it, given the state of labor right now and the way that this virus is acting. So I think it's important to note that while we're focusing on the food issue right now, this really does go across a lot of companies. It's more expensive to operate in this environment.
Yeah, and of course, there's going to be a lot more questions about liability, too, as we see a lot of these states start to open up. Okay, let's shift our attention now to the medical side of things. Roche today getting that emergency approval from the FDA for the antibody test. And I want to bring in Anjali Kamlani, who did speak with Roche's CEO earlier today. Anjali, what did he say?
Hey, Kiko. Yeah, so we know that, antibody tests are one of those key tools that public health experts are looking at when it comes to safely reopening the economy and really keeping the virus at bay. So Roche is one of those companies now joining that list of FDA emergency use approval. And the CEO was talking about how this is going to be a lot easier to ramp up, specifically because of the availability of supplies, as well as generally where we are in terms of manufacturing and production, and it requires fewer supplies, if you will, than the normal nasal swab testing. And so all of that put together makes it a lot easier to really distribute. And though they are looking at continuing a restrictive start, the same way that we did with nasal swabs, they are going to also be restricting the start of antibody testing to those who are high risk. So take a listen to what he has to say about that ramp up.
From a technology point of view, it is much easier to ramp up antibody tests versus molecular tests. So I'm confident that we will be able to provide this test in high quantities and that this will allow the testing of broader parts of the population. Just to put this into perspective, in May alone, Roche will ramp up its production into the high double-digit millions of tests per month. So this is already at the very beginning a multitude of what we can produce of molecular tests. Also, very importantly, there's a broad base of instruments out with labs which can run such antibody tests. So I'm very confident that we can make this test available fast in high quantities.
Heard really looking to ramp up that testing and make it more broadly available. And it just still remains to be seen, which areas we see that distributed to. Akiko.
And Anjali, what about the accuracy of these tests? I mean, it sounds like there's still question marks about whether, in fact, just because you have the antibodies, you are, in fact, immune from the coronavirus. I mean, what did he have to say about some of the false positives that could come out of mass testing and whether, in fact, you should conduct more than one test?
Right. So a lot of things there. Let's go one at a time. On the antibody testing, yes, there are still questions about what does it mean if a person has antibodies to this virus. And that is something that health experts are still looking to try and understand. But the CEO did say that with the antibodies, there is some level of immunity, at least initially. So whether it's a couple days, couple weeks type of situation versus the longer term where you would normally see in some sort of illness. And then looking at the accuracy of the testing, this test is supposed to be nearly 100% accurate, which is pretty high. And the company, did come out with waiting until they were validated to be able to put it on the market and wait for that FDA approval. We've heard about tests flooding the market and how many of them do not, in fact, have that accuracy in place. And so looking at that, the idea that you should be testing and widespread testing, it is one of, as I was saying, one of the tools. So it's going to be two different types of testing, continuing the nasal swabs as well as antibody, as well as ensuring social distancing measures, all put together to make sure that the strategy works in terms of keeping the virus contained. Akiko.
No question, multiple layers involved there just to try to get people confident enough to go out. Thanks so much for that, Anjali. I want to shift gears here to talk about the retail space. Certainly been hit hard by all these stay-at-home measures across the country with all the closures. Today, we got an announcement, the first casualty, if you will, J.Crew announcing it is filing for bankruptcy. The company's parent company filing for Chapter 11 protection, saying it will now hand over control to its top creditors. Melody Hum, I want to get your thoughts on this one, because of course we've been talking a lot about the retail names that could become casualties. J.Crew certainly one, Neiman Marcus another, JCPenney. Is this really a big surprise, and what do you think the brand goes from here?
I don't think this is at all a surprise to anyone who is even tangentially following the retail space, even pre-pandemic, right? And even thinking about the Toys R Us, the Barneys, the Sports Authority bankruptcies that we had seen over the last couple of years, I think this was kind of next in line. Of course, we know Madewell was one of the bright spots in the J.Crew empire, but even thinking about where people are spending their money, if they are choosing to buy clothes, it's still athleisure, right? It's the yoga pants, it's comfy clothing. No one is buying jeans right now, or cashmere sweaters for that matter, which is what J.Crew and Madewell are known for. I think being able to pin COVID-19 as the reason, right, as the nail in the coffin, if you will, I think is a little bit foolish and perhaps a little bit misplaced, because I think looking at the retail space at large, you mentioned Neiman Marcus, Gap, and the like, a lot of these companies were sort of hanging by a thread. So if anything, speaking with even venture capitalists out here, as they look at smaller companies, using coronavirus sort of as an excuse or couching their failure or the ultimate demise in that way, I think is a little bit erroneous. And this is one of those examples where I do believe that J.Crew will continue to operate. Of course, I think those lenders are giving J.Crew a lifeline of $400 million during this time to restructure. So it's not as though it's officially going away, but I do think it is kind of a slow fate sunsetting out, if you will.
Yeah, and guys, let me just add to Melody's point. It was J.Crew's fault, mostly. Coronavirus, kind of like a red herring. Same with JCPenney. It wasn't coronavirus that killed these companies, or at least not killed them, but led them to file for bankruptcy. I also think that there was one big example of something that maybe wasn't entirely J.Crew's fault, and that was that it was planning to get a lot of help from the Madewell IPO, which obviously was shelved. That was because of kind of the market downturn and things not looking very good for that IPO. So partially J.Crew's fault, partially not. I think that Madewell IPO started to look like it was going to be the last little lifesaver because the company was going to use some of that to pay down J.Crew's debt. Now, as Melody says, filing for bankruptcy, that doesn't mean this company's going away. And reportedly, the parent company wants to hold on to Madewell. But that was a kind of a big bump in the road that IPO didn't happen. I'd also say, and it was our own Heidi Chung last week when this was just rumored to be happening that pointed this out, but it's a brand that also did a lot too much of discounting. And Under Armour has the same thing. I mean, hard to be seen as a premium brand when everything is always on sale. Way too much discounting from J. Crew in the last couple of years. Once you see apparel brands start to do that, they're starting to get desperate, and that's when things are heading, for negative town.
And Dan, Akiko, I think this also illuminates a macro issue, right, with leveraged buyouts, which J. Crew was the target of in 2011 with those two private equity firms that came into the picture. I think it's very short-sighted, and I'm curious to see, even with the kind of salvation aspect of PE, which, to be honest, many lawyers and many folks on the front lines are saying that's never going to be a good outcome. There are very few scenarios where the legacy name ends up lasting the test of time after a PE buyout. So I think this will be an interesting test post-pandemic, whether those will continue to happen, whether chief executives will think that is the best alternative, because it almost seems like a doomsday scenario at that point.
Yeah, and Melody, to your point, I mean, this isn't a J. Crew only story, right? There's so many parallels across many of these retailers. And I guess the argument here is that coronavirus accelerated sort of the moves that we were expecting in the retail space. And certainly a lot of names we can expect to hear from moving forward, going sort of seeing the same fate as J. Crew. We're going to continue to follow that space. We are off for a quick break, but coming up, we're going to be talking about Disney, the company out with its quarterly earnings tomorrow. But one analyst not waiting for those new numbers to come out to pour cold water on the stock. We'll dive into MoffettNathanson, I should say, their report and why they are downgrading the stock. That's on the other side of the break. Well, Disney is out with earnings tomorrow, but MoffettNathanson, ahead of those numbers, coming out with a downgrade on the stock, downgrading Disney to neutral. Now they're keeping their price target or 12-month price target $112, but essentially making the argument here that it's not about Disney's operations or their financials per se, but about the broader economic recovery, how that is likely to weigh on Disney's business moving forward. I want to bring in Dan Roberts here because Dan, one of the things that you have highlighted before is, we're talking so much about the benefits of Disney Plus with everybody staying at home, but it's the park side that's really going to take a hit. And this seems to be at the central argument of this analyst report.
Yeah, Kiko, Parks and Resorts is really the profit engine of the company. And that has been the case for years now. And maybe in the last couple of years, it's kind of been the quiet profit engine, because the glitz and the glam is with the streaming, as you said, and with really the box office in the last couple of years. Because even though the overall box office has been in decline, Disney has had a lot of hits between Marvel and Star Wars. So even though that has garnered a lot of the media discussion, the parks has been the quiet performer. And in fact, in this quarter a year ago, Parks and Resorts were up 10%. That is not going to happen this time. So the earnings report tomorrow is Disney's second quarter. It's going to include February, March, and April. And so in contrast to some of the earnings reports we've had in the last few weeks, where companies in April were coming out with earnings reports that covered the 3 months ending with March. So some of those earnings reports were mostly okay, since coronavirus damage didn't really start until early or mid-March. This quarter for Disney includes March and April, and it is not going to be pretty. And as you say, it's not just the parks that are shut down, but it's really the idea that even once they're allowed to reopen, there is a lot of concern that that kind of trip and that vacation plan is going to be totally hurt by this time, that a lot of families might not be comfortable. They'll want to do social distancing. They'll be hesitant. And, social distancing is kind of antithetical to Disney parks. I mean, you've got kids running around everywhere. They're touching everything. They're eating things. You're standing in line to get into a ride and you're close to people. So even though Disney has now been smartly, obviously already selling coronavirus masks with Disney characters on them, it's hard to imagine as many people right away going to Disney parks as we're going before coronavirus. And then if the parks closures aren't enough for you, the studio division has been hit because they're unable to film new projects and they've been unable to complete projects that were in the works. So some of those exclusive new Marvel shows that were headed to Disney Plus, like The Falcon and the Winter Soldier and Loki, which were almost done, have been put on pause and will now be delayed. Now, luckily, The Mandalorian Season 2 is apparently done and will still hit the platform in fall. But man, this is probably going to be a dire earnings report tomorrow from Disney. The only silver lining would be probably an update of the number of Disney Plus subscribers, which will be an impressive number. But, ESPN even and ABC, which are also owned by Disney, no live sports. So the downgrade by Moffett-Nathanson makes some sense. Although my opinion is it's hard to believe people will stop going to Disney parks all the way through 2022, which is when a lot of analysts are predicting the damage will last until.
Yeah, Dan, to your point, kind of take your pick here. Aside from streaming, they are between a rock and a hard place. And Moffett-Nathanson really makes that clear as they go through the whole company in this 21-page note, which I would note, I could not find the mention of Iger or Bob anywhere, not even Bob Chapek. I searched Bob Burgers was the only, Bob's Burgers, some movie. But I think the idea of the Disney parks reopening, they had modeled for the parks only being closed for a month. Now the base case is July 1st. How does social distancing work, as Dan said? Can you imagine how long the line is if you have to stand 6 feet away from every other family? And then this goes back to what we were talking about with Tyson earlier and Amazon. How do they staff it? What's the minimum in terms of people they need to bring back from furlough to be able to make the park still have that experience? What do they do with the hotels? It is a real Pandora's box when you start to dig in here, like Moffett-Nathanson did, and the stock is off 2%.
Yeah, and Jen, to your point, in terms of how the parks reopen, I mean, this report says that capacity is likely to be at 50% once or if the parks reopen on July 1st, and then ramp up to 75%, only 75% in 2021, and then 90% beyond that. So certainly pointing to a very long road to recovery here. Let's kind of stay in the streaming space here, because we got some headlines on Quibi. Hedge fund Elliott Management backing a lawsuit against Quibi. The lawsuit's being filed by Echo, which is an interactive video company, and they allege that Quibi is using proprietary technology within the app. Melody, I want to bring you into this conversation. Any of us who have watched Quibi shows know when you've got the show, you can kind of toggle between sort of the landscape version and then sort of the vertical. And this company is arguing their technology is right at the center of that.
Yeah, and that was the innovation that was promised to us as the proprietary feature of Quibi, which they call Turnstile, which essentially was kind of even thinking about mobile content from the very beginning, what a lot of content creators struggle to do. As you mentioned, New York-based Echo is a startup, and now this dealing with Elliott Management essentially means that Elliott gets an equity stake in Echo for financing this litigation. We don't know exactly what percentage they would be taking out of the company, but this is by no means a good time for Quibi, right? They launched a month ago. They reported 2.7 million downloads within the first 2 weeks, which was a much lower estimate than anticipated. Originally, Meg Whitman, the CEO, was hoping to give a 10-day or 2-week trial for free. They decided to do a 3-month trial, which I actually am subscribed on. And to be honest, I haven't opened the app at all. And then now a lawsuit, and a very heavily financed one, to say the least. And again, this proprietary technology that Echo is claiming that it has developed has been used by the likes of BuzzFeed Tasty, a lot of other individual influencers and creators, and it's to be determined whether Quibi can actually stand its ground. According to the Wall Street Journal article that reported on this news, a spokesman for Quibi said there are no grounds here, that it is their own technology. But we'll see, Akiko. As we know, there was a lot of hype. I think the total funding actually amounted to $1.7 billion that Katzenberg and Whitman were able to raise for this splashy debut. And then, of course, the pandemic happens and everyone is actually able to couch surf and watch from their TVs. And so this mobile-only offering has faced a lot of macro issues, and then now a very targeted one.
Yeah, the timing or the stars haven't certainly all lined up for Quibi. I will say, Melody, I've been watching one show on Quibi, which is I Promise, which is LeBron's about LeBron's school. And I have found that, like, at least in that setting, you are able to sort of hold your phone for 6-7 minutes, but we'll see how what the attention span is for people on their mobile phones. Okay, we are off for another break, but coming up, we're going to be talking about the impact of the coronavirus in the boardroom. We'll be speaking to the CEO of Boardless, Shannon Gordon, about the recent survey looking at how boards have responded to the crisis. We'll be right back. A new survey out points to just how unprepared a lot of boardrooms were to the pandemic, but also the closures that have come, economic impact that have come as a result of the coronavirus. Nearly 40% of boards did not have risk plans or mitigation plans in place. To talk about that survey, we are joined by the CEO of Boardless, Shannon Gordon, today. Shannon, great to have you on today. Nearly 40% of boards, I mean, I guess the argument would be, well, no company's really prepared for a pandemic, but how should we be looking at the risk mitigation plans that were in place for some of the companies, or the lack of those plans?
Yeah, it's really interesting. I mean, of course, no companies are completely clairvoyant and have the ability to project the pandemic that we're currently in. But I also think that there are some commonalities between any risk mitigation strategy. You know, you might imagine scenarios where we'd had an economic downturn, or there might be an impact to a supply chain, to the supply chain. Companies, in theory, should be planning for these things. And so I was frankly surprised to hear such a high percentage hadn't.
Shannon, Melody here. Thanks so much for joining us. One of the silver linings that you point out from the survey is that 80% of the board members that you actually spoke with reported more frequent communication with the executive team, with the actual company, which kind of highlights, you know, normally when you're not in a crisis mode, does that mean that board members are kind of coasting, that they're not actually engaged in really deep dialogue? Do you feel like this is a net positive? Do you feel as though those communications have actually amounted to kind of proactive leadership skills from the CEO standpoint?
Yeah, I don't know. That's a bit hard to read because, you know, frankly, it's not necessary for a board to be in as frequent communication when the company's not in the middle of a crisis. So it's natural that that communication is going to increase at a time when the company is facing something they haven't faced before and are trying to figure out quickly how to react. So that makes a lot of sense to me. I think what'll be interesting to see is how communications will evolve going forward. You know, very often boards require in-person attendance to their meetings. You know, they're very sort of formally scheduled throughout the year. And so I think it'll be interesting to see whether or not that evolves now that, you know, we're all getting used to using technology to meet more remotely.
And of course, a little bit of context on the board list itself. Since launching about 4 years ago, you have influenced the placement of 100 board members at both private and public companies. When you think about the female representation on these boards, what kind of real value add are you seeing and are you able to witness real time?
I think in general, there is plenty of data to show that diversity leads to stronger teams, better problem solving. It really gives the board the ability to draw on a wider breadth of experience to help the company that they're serving be more successful. So that, you know, is the normal impact that we see. I think specifically during this crisis, what's been so interesting is you know, this is a time where a CEO is under duress very often, right? Their company is going through crisis. And so the board is fairly uniquely positioned to provide support for that CEO, both obviously from external perspectives, some planning support, et cetera, but also emotional support as they go through this really difficult time. And so I think that, you know, women are uniquely well positioned to be helpful in that regard. So I think no matter what, whether we're in crisis or not, having a diverse board is the way to building a stronger board.
So Shannon, there's been something going around the internet. I mean, there's regular stories about it as well, but it's also become in memes that countries that are led by women have fared better against the coronavirus. And as somebody that puts women on boards, do you care to say how women on boards have been doing during coronavirus in particular?
Yeah, I mean, I think one of the advantages to having diversity in general, but also specifically having more women on boards, is that there's very often just a different perspective that is brought to any problem that a company is facing. I also think there's research to show that women tend to think about issues from a number of different angles, right? And so particularly well adept at handling complex situations. And so it doesn't surprise me, given the complexity of a crisis, given the different angles that, a board, a leader needs to be thinking about, that women are performing particularly well.
Great to have you on today. I really appreciate your insight. Thanks so much for joining us.
Thanks for having me.
Coming up, we're going to get some more comments from Warren Buffett, weighing in on Berkshire Hathaway's role in the Anadarko takeover. He's also going to be talking about where he thinks oil is headed. You're going to want to hear his thoughts on the other side of the break. Just under 30 minutes left in the trading day, and we are seeing all three major indices in the green. Now the Dow is up 35 points, the Nasdaq up 91, and the S&P 500 up 12 points. Let's head on to Jared Blickery with the very latest on that front. Jared, what's caught your attention today?
Well, we got energy leading the way, and that's up 3%. That's on the back of a rally in crude oil. We'll get to a chart on that in a minute. But just looking at the Dow here, finally turned positive. We got a late day rally in place. NASDAQ, which had been positive the whole day, up 1% now. And the S&P 500 up about 43 basis points. Here's the intraday price action. And you can see started out in the red down here at the beginning of the day and kind of consolidated. And then here's that late day rally that we're looking at right now. On a year-to-date basis, we have a little bit of a downturn that started last week after the FOMC meeting, but not making much headway right now. Now, the bulls are still kind of in control, but the bears had a good day Friday afternoon, and they will have to cede 28.80 if they are to gain any traction here. Let's take a look at the VIX. That is still elevated up to 36. Wasn't able to get down into the 20s last week, and we are getting a bit of a bounce there too. And we can also take a look at the Dow heat map today because we do have some big underperformers. Now, it is nice to see tech leading. We do have Microsoft up over 2%, Apple up over 1%, but Boeing is having a rough day. It's trimming some of its losses right now, but down about 2%, 60% on the year. And also Caterpillar has been one of the big losers of the day. That's down another 3%. Just looking at the sector action, we talked about energy before. That is in the lead along with tech. To the downside, not surprisingly, we find those industrial companies that we just looked at as the laggards along with financials. And here is what is happening with crude oil. We can see the June contract now pushing 21, up over 5%, almost 6% here at Kiko. And that is a bullish structure at $21.
And Jared, to your point, we have seen, along with oil bouncing back today, the energy names come back as well. Certainly still big question marks around the demand picture, even as we start to see some of the states reopen here in the U.S. Warren Buffett weighing in on that over the weekend in terms of where he expects the price action to go. He also talked about Berkshire's role in the takeover of Anadarko Petroleum. Take a listen.
It was attractive at oil prices that then prevailed. And it doesn't work, obviously. It doesn't work at $20 a barrel. Certainly doesn't work at minus $37 a barrel, but it doesn't work at $20 a barrel. And everything the oil companies have been doing, whether it's Exxon or Occidental or anybody else, it doesn't work at these oil prices. That's why oil production is going to go down a lot in the next few years, because it does not pay to drill. Now, that's happened at other times in the past, but the situation is, you don't know where you're going to store the incremental barrel of oil, and oil demand is down dramatically, and for a while the Russians and the Saudis were trying to outdo each other in how much oil they could produce. And when you've got too much in storage, it doesn't work its way off that very fast. Now, you will have production of oil go down in the United States significantly. It does not pay to drill in all kinds of formations that paid before, and it doesn't pay to have paid the price that oil was trading at in the ground a year or two ago. And to that extent, if you're an Oxy shareholder, or any shareholder in any oil producing company, you join me in having made a mistake so far in terms of where oil prices went, and who knows where they go in the future.
Jared, I want to get your thoughts on that. I mean, he says $20 a barrel just doesn't work at that price. We're looking at WTI today, $20.83 is what it's trading at. Certainly, as Warren Buffett there points out, the big question is not just about demand, but where all the oil is going to be stored. How do you see some of those comments that we got from him today reflected in the market?
Well, it's a pretty simple economic principle that market's clear. So you don't necessarily need everybody in cahoots, some cartel to limit production. The markets are going to clear eventually, but it's going to be a painful process. We've already seen three bankruptcies, or at least hints of bankruptcies so far in this sector. I'm looking at Occidental Petroleum right now on the Wi-Fi Interactive, down 62% year to date. But we have some that are down more. Whiting Petroleum, for instance, down probably 83% year to date. They filed for bankruptcy. There have been some reports that Diamond Offshore Drilling will file for bankruptcy, and so you're going to see a lot of voluntary production cut, but only after significant economic fallout. And we're just in the beginning stages of this. I think there's still a lot of credit risk out there in this space. But I would mention one more thing, that Warren Buffett is making 8% of his $10 billion loan to Occidental Petroleum. So that's $800 million a year. And when you look at Warren Buffett's positions, it's not just a straight ownership of Occidental. He's usually getting a side deal, and that's where he makes his money. And I think he'll come out whole on this eventually.
I mean, what can you say? The man's right. It doesn't work at -37. To your point that we're going to clear here, where do we find where we eventually land? And I think it's interesting, Goldman Sachs saying that they remain bullish on oil prices in 2021. Still, you know, to steal something that Buffett has said before and said over the weekend, and it was about equities, nobody knows what's going to happen with the market. And anybody that does know, you know, probably doesn't. I think we have yet to figure out what is happening with oil demand, how much we will see production cut back, what that will do for prices. So there's a lot of questions out there. And for Warren Buffett and others, it is causing problems.
Yeah, and Jen, to your point, I mean, this is one of those things that we won't know overnight, right? I mean, these are a lot of economies globally are just now starting to consider reopening or just now starting to reopen. The demand picture is still going to be a big question mark moving forward. Let's do a big pivot here and talk about sports because baseball season is starting again, but not here in the U.S. We're talking about Korean baseball. And the reason we're talking about that is because there's no sports to watch here in the U.S. I want to bring in Dan Roberts for this conversation. Dan, ESPN, not sure they were always interested in Korean baseball, but certainly, you know, a lot of fans out there are just seeking out any sports they can watch. And right now we're just looking at the Taiwanese Baseball League and the Korean Baseball League.
Yeah, it is a weird time to think that a Korean baseball rights deal is such a big win for ESPN, but that's the reality we're in, right? I mean, every U.S. sports league is shut down. And by the way, it's worth mentioning, this fact has gotten a lot of attention, but South Korea and the U.S. had their first reported cases of coronavirus on the same date, on January 20th. And obviously, those two countries took a very different turn in terms of how their curves went. We can kind of shelve that conversation for now. But point being, that the return of baseball in South Korea is sort of an interesting study in contrast for U.S. sports fans because, wow, Korea gets to have baseball again, but in America, we don't. But ESPN getting the deal to broadcast those games live. ESPN will have 6 games a week. Now, they're very kind of strange times because of the time difference. You know, these games are going to air live on ESPN2, some of them at 4:30 in the morning, some of them at 1 a.m. But obviously, the games will also be on the ESPN app, so you can log into that with a cable authentication. And, you know, I think the key here is it's not just that ESPN gets to broadcast the games, it gives all of ESPN's kind of channels and talent something to talk about because ESPN also gets rights to show replays from any games, not just the ones that aired. You know, ESPN becomes the kind of exclusive English language broadcaster of the KBO. And I think you'll see SportsCenter showing highlights. I mean, there isn't much else to show. So I imagine that ESPN is really going to latch on to these rights. And what's interesting is there were reports just a couple weeks ago that ESPN had failed to get the rights because it tried to get them for free. So obviously this deal coming together really at the 11th hour because it was announced today and the Korean baseball organization starts up again tomorrow. And by the way, these games will be played with no fans in the parks, but KBO has gotten used to this. You know, the baseball league there has been doing this the whole month of April with no fans. They're testing players, taking their temperatures twice a day. And also there is a no spitting rule. The players cannot spit. The KBO has also said that if there is a case among players, it'll probably have to shut down for 3 weeks. So fingers crossed that won't happen. But this is the reality we're in. And you can also bet that MLB, Major League Baseball here in the U.S., is going to be watching what the KBO does very, very closely. The latest from MLB is that they're targeting late June to try to start their season, but we'll see.
I was going to say, Dan, are the leagues talking to each other? I mean, obviously, MLB is going to be looking at the success or how KBO is going to be able to ease this in. Are the leagues across countries talking to each other about how, maybe exchanging some ideas on how they're going about resuming these games?
I think they're definitely watching each other closely. I don't know how much they're talking. MLB does have some deals and partnerships in places like Japan and overseas. So I'm sure that they've talked to the people from the KBO. I would say that right now, there's probably a different map for every different U.S. sports league. There was a lot of optimistic talk about, maybe come fall, we suddenly have every sport going on at once. NBA, MLB, NHL, football. I don't know how realistic that is. We're going to see, especially because of broadcasting schedules. The NFL right now is insisting that it's going to be able to start its season on time in September, and that may be. And one thing the NFL has going for it is it's not as reliant on ticket sales. So the NFL could start up without fans because so much of the NFL's point is the broadcasting. College football doesn't have that luxury, especially because if you start college football with no fans, you're basically giving up on the claim of amateurism. Now you're admitting it's a business. And also to do college sports, if the colleges themselves don't have students there, I don't see how you can do that. So college sports are reliant on whether the colleges come back on time. I think the first thing to come back might be Major League Baseball late summer, or it might be the NFL in the fall.
No NBA, huh?
I'm not that optimistic about it. If just one staff member, whether it's a player, a janitor, a coach, gets it, you shut down again. So it's very hard to imagine that working.
Okay, we'll be watching. Thanks so much for that, Dan. Coming up, we're going to be joined by Stifel CIO Michael O'Keefe. He's going to join us with his outlook for the markets and where he's allocating capital in this environment. Just about 10 minutes left to go in the trading day, and we are seeing all three major indices in the green right now. The NASDAQ seeing the biggest gains there, up about 1%. Let's bring in Stifel CIO Michael O'Keefe with his outlook on the markets. And Michael, going into last week, it seemed like we were talking so much about this disconnect between the grim economic data we were getting and then where the markets ended up, especially in the month of April. It seemed like there was a bit of a reality check that we saw last week, though, given some of the earnings that we got from the tech names. How are you seeing the broader markets right now?
Yeah, no, broadly, I think what's super interesting about this environment is while we have to stay true to our fundamental work, right, at the end of the day, this is all about the economy reopening. And so what you're seeing, in my view, with this volatility is this back and forth between people sort of taking stock of where we've been so far, but then looking forward and trying to gauge, some optimism. So from here, we think markets are going to go modestly higher, but we're going to experience this kind of volatility.
So, hey, it's Jen Rogers. Why do you think we're going to go higher here? Because we have this reopening happening. It's a real patchwork. People have no idea how it's going to pan out. What makes you convinced that higher here is the trajectory, given all the concerns, especially everything we hear about a second wave?
Yeah, I mean, basically, it's sort of anchored in this view, in fact, that it's that messiness that keeps people a little bit guarded. So, and again, I think it's a little bit about our system and the way that the U.S. ultimately gets through these kinds of things. We're going to see these sort of patchwork kind of recoveries, but ultimately it's going to lead to things coming back online. And I would say that at some level, the markets have not yet fully incorporated that. So again, and I also say, Jen, we have three scenarios. We have that scenario, which is modestly higher, where we acknowledge the potential for downside and upside and kind of model that as well.
So having said that, where do you position yourself right now? As Jen pointed to, we've got the reopening in places like Florida and Georgia. There's still question marks on some of the major hubs like a New York or like a California.
Right.
How do you kind of take that patchwork and see where to allocate your money?
Yeah, I mean, basically, there's a couple of key tenets that we're sort of anchored on right now as it relates to putting money to work. The first is, unlike normal times, we're in a time when there is an increased risk of permanent loss. So think of within fixed income bonds going into default, within equities, smaller companies, for example, going out of business. So, usually things are kind of going along and you're trying to look at these subtle moves left and right. Nowadays, you're basically wanting to focus on quality. So in the equity space, for example, we might be a little bit overweight large cap growth companies that are going to be a little bit stronger. And then in fixed income, we're going to be a little bit overweight to higher grade paper. But the other anchor, I would say this environment is one where good active management is super helpful, because where that stress comes, so comes opportunity. So somebody good, for example, at buying small cap companies, doing the heavy work and deciding where to invest, there's good money to be made at that point.
The thing that we keep hearing is that any of the trends that we saw maybe pre-COVID are just going to be accelerated. It's not necessarily that there's a big shakedown that's coming. It's more that things have been kind of pulled forward as a result of these stay-at-home closures. One of the spaces we were talking about earlier, retail, J.Crew coming out announcing that they are filing for bankruptcy. Certainly a lot of other names in the pipeline as well. How are you looking at that space right now?
Well, yeah, it's a great point. We were late cycle, and late in cycle, you tend to see at some point sort of a slowdown and a little bit of a shakeout. And to your point, this has just accelerated that. So there's no question that companies that were on the edge, if you will, are really troubled by this. And, we have to be mindful of that as we're investing. And again, I think that's why, having good active management, looking at companies making decisions is very helpful.
Okay. Stifel CIO Michael O'Keefe, great to talk to you. Thanks so much for joining us.
Thank you.
And we are just minutes away from the closing bell. Coming up, we're going to do another quick check of the markets as we try to round up the first day in the trading week. We'll be right back. away from the closing bell. We have seen things turn positive within the last hour. All three major indices in the green, although the Nasdaq seeing the biggest gains right now, up nearly 100 points there. Airlines certainly the story of the day, at least in terms of sectors, largely moving today on the back of Warren Buffett's comments coming from the weekend where he said he had dumped all his airline stocks. That had certainly weighed on all major airlines here in the U.S. Going in the other direction, we have seen a bounce back in some of the energy names, given the gains that we have seen in oil as well. Another sector we've been watching today, retail, after J.Crew came out and said that they would be filing for bankruptcy. One of course, a number of names that we expect to go down the same pipeline. So certainly a lot to focus on with just a few minutes before the closing bell. Jen Rogers is going to take us through the next hour, and Yahoo Finance Live will be right back.
Welcome back to Yahoo Finance. That's going to do it for the day here. So you know how Warren Buffett told us over the weekend that no one knows what the market's going to do? Yeah, they're right, because he's right, because this market was down just about an hour ago, and now it looks like we are going to close here near the highs of the session. The Nasdaq had turned green the earliest here, big tech helping out, and the Nasdaq up just about 1.2%. Also looking at a green close on the Dow and the S&P. The Russell 2000, which has been really powerful as of late, ending with the smallest of green arrows, but green nonetheless. Crude here above $20 as well. Seeing a lot of strength in energy names today. The biggest performing sector right now, XLE, is up almost 3%. Want to bring in Editor-in-Chief Andy Serwer back from Omaha, Nebraska, where he was out there for the virtual meeting of the Berkshire Hathaway annual shareholders meeting. Although it was not virtual for Andy, he was there. Andy, we're going to get into the airlines in a moment, but just to start really big on Buffett and what he said, do you think that some of the concerns that we're hearing people talk about today is that he was not a buyer overall when we were seeing volatility and that the market was down? That there were people that thought, you know, if anyone's going to step in, it's going to be Berkshire. And the fact that they didn't, does that impact people's psyche a little bit?
Yeah, I mean, it was funny because we were trying to parse through it real time. And Jen, you've been there, and doing that can sort of be tricky. But I felt like this time was actually more nuanced than ever, because, he starts off with this expansive soliloquy in defense of America, the greatness of America, i.e. warts and all. He talked about the deficiencies when it came to founding fathers in terms of African Americans and how we've short-shrifted women throughout history. But basically, it was one big pep talk. And I was like, well, this is kind of real feel-good music here. And then I realized that actually what he was doing was mitigating the underlying more negative message, which was he sold all the airlines. He was not doing a big Berkshire buyback. The stock was not attractive. He was not going into the market and buying securities. So I think that if he had not said anything, it would have been like, wow, this is all negative. And what he wanted to do was assuage that a little bit by saying, look, the long-term case for America is still there. However, right now, things don't look so great for Warren Buffett. And actually, I think they're a little bit more negative than a lot of market participants. And, when he talked about the airlines, he was saying, it's just, this is not going to recover for a long time, like 3 to 5 years maybe.
And on that point about the airlines, Andy, we have Warren Buffett taking that question on the airline stake. Here he is from Saturday.
When we sell something, very often it's going to be our entire stake. I mean, we don't trim positions or that's just not the way we approach it, any more than if we buy 100% of a business, we're going to sell it down to 90% or 80%. I mean, if we like a business, we're going to buy as much of it as we can and keep it as long as we can. But when we change our mind,
the next question.
Go ahead, I'm sorry.
No, go ahead. When you change your mind?
Well, when we change our mind, we don't take half measures or anything of the sort. So I was amazed at how, frankly, now we were selling them at far lower prices than we paid, but I was amazed at the volume. The airlines always trade in large volume relatively, but we have sold the entire positions.
Stock, and that hit those stocks hard today. American Airlines, the worst performer in the S&P 500. Rick Newman, bringing you in here on this wholesale sale of the airlines. Warren Buffett is the most famous long-term investor, right? He's not in there watching what's happening with a given stock on one day. What does that say about the airlines when Warren Buffett throws in the towel?
I mean, you don't want to conclude that they're toast, but it sounds as if that's basically where he's headed. Now, I don't know if we know exactly when he got out, and that matters. I mean, if he got out in March, early March, he was getting out probably near the top. But if he got out last week, that would probably not the greatest trade. So that timing matters. But the way I am hearing all of this is about as grim as Warren Buffett has sounded in some time. Andy has followed him so long. I wonder what Andy's thoughts are about if you've ever heard Warren sound this grim. But to basically say, I'm selling everything and buying nothing, that is not the usual don't bet against America.
Andy, fair to say?
Yeah, I don't disagree at all, Rick. And, so this was what he was saying is that a lot of people are underestimating how much damage this is going to do and how much time it's going to take to recover. And, when you're into the airlines, you figure, well, I can ride this thing out. He was going to ride it out. But he just, and he said there are too many planes. It's going to take too long to get back to the passenger loads that we had just, 4 months ago. And the notion of sitting packed in like sardines is just not going to fly, pun intended. And so, there are a bunch of other businesses like that, and wrestling with all of these huge changes that are going to be with us for quite some time in America's largest urban areas. But also, you look today, the virus is, sweeping through Brazil right now, and it's bad in this area and that area. It's not going to stop on a dime. It may be getting better here, but it's getting worse somewhere else, and the implications are huge.
You know, the airlines 3 months ago, at the beginning of February, the airlines were about as healthy as they've been in at least 20 years. You know, after all those bankruptcies and consolidations, they had gotten rid of excess capacity, done a good job of right sizing their fleets, and they had high load factors. So that means they were flying the right planes. And I know there's some complaints about, they were buying back shares instead of stockpiling cash, but companies really cannot get away with, not many companies can get away with stockpiling cash. I think the airlines are the biggest set of collateral damage possibly in this entire wipeout we're seeing. And I guess Warren Buffett's saying it's not getting better anytime soon.
Yeah, just two quick things to add on there, Rick. By the way, I was remember I did that interview with Buffett on March 10th, and I asked him, are you selling airlines? Because that was sort of in the beginning of things. He goes, I'm not selling airlines today. And that was after the market tanked a couple times because of the coronavirus. So, he did that. He brought up that famous quote from John Maynard Keynes. What do you do when you get new information? I change my mind. What do you do, sir? And boy, did he change his mind when it came to that. The other thing is Buffett has a very, how do we say this? Not so good track record when it comes to airlines. I mean, you remember what the U.S. Air bid him in the Petunia one time, big time. One of his big stumbling blocks, big stumbling points. U.S. Scare, they called it back then for him, as you remember. Went to Pittsburgh. Didn't that airline go to Pittsburgh, Rick?
It was based there for a while. It was headquartered there, yeah.
That's correct. That's why you would know it so well. But anyway, so some wags are saying, well, there goes Buffett blowing it in the airlines again. I think there's a little bit more to it than that, however, at this point.
Well, Rick brought up the idea of collateral damage here, and today, aside from the airlines, also seen Boeing. Of course, they're a plane supplier. Boeing falling here today on that aerospace cautiousness. GE Aviation announcing layoffs. So this is not just about consumers not going and we're going to have flights grounded. This goes much deeper than that. In terms of another company that we're seeing as one of the worst performers in the S&P 500 today, along with the airlines, mixed in there is Tyson Foods, shares falling on production disruptions, really taking a toll on profits. And Akiko Fujita, I want to bring you in here on Tyson. I mean, we've had these headlines out there about the food supply chain, what's happening to it, how safe it is. What is the main issue for Tyson?
Well, I think the issue is, on the one hand, meeting the demand that exists right now, but also they've got employees who are getting sick. I mean, that's kind of the bottom line. What we have seen, a lot of these factories, these processing plants, is pre-COVID, workers moving with less space, trying to improve the productivity there. And that has in some ways backfired as a result of this pandemic. And what Tyson is having to deal with is trying to ensure the worker safety. We did hear from the president, I think it was last week, talking about how these workers, need to continue to show up to work. But the reality is there are going to be concerns. If one person is infected, then there are other workers, despite what Tyson says, who will say, I'm not going to show up to work as a result. So that's the big balance they're having to deal with. And Tyson spelled it out pretty clearly today in their forecast, saying there's going to be higher cost of production and then lower productivity. That's kind of the bottom line moving forward for them. And it's not just about Tyson. There's a lot of other factories that are having to deal with the same thing.
It always comes back to the public health part of this. And for that, let's get more details on the very latest developments from Anjali Khemlani. Anjali, today, the global cases, more than 3.5 million, but a little bit of hope here in terms of testing. Can now you tell us on some of the developments there? Bring us up to speed.
Absolutely. I actually got a chance to speak to the Roche CEO earlier today. And as we know, that's one of the companies that has been doing a lot when it comes to providing testing capacity. They have that high volume testing instrument that a lot of labs are using to test for positive cases. Now they've also added antibody to their array of options. They got the FDA approval for that, the emergency use approval. And so we had a nice little discussion about what that means. Is it sort of the answer to the question of, is it safe to reopen? And the answer was not really. It is just one of those tools. It is a very accurate test. They do have a high percentage compared to others on the market, but it is just another tool in the toolbox right now that health experts are going to be able to use, and the general health community is going to be able to use to help us assess how to move forward from here. And as we know, the cases, while they are on some sort of a steady, track when it comes to the whole United States, we are seeing that mix of flare-ups in other parts of the country. Meanwhile, some of the hotspots are slowing down. So still remains to be seen what just happens, but we are seeing that increased capacity. Even last week with Quest Diagnostics and LabCorp saying, there is more supply than demand right now.
Hey, Anjali, I'm just curious, have you heard any concerns about so many people, at least in the New York area, getting very interested in having these antibody tests and going out to Quest or LabCorp or the doctor's office, which could potentially be a hotspot, leaving their house to go do this because everybody wants it, but that it could cause more problems? Is that a concern that a lot of these places are thinking through?
That is something, and that is why there have been so many measures taken to make sure that there is a way to set up an appointment, either online through telemedicine, or even Quest launched a way for you to basically choose an appointment and get that test done. So that continues to be a concern. But at the end of the day, because the antibody test is a blood draw test, there's no other way to do it. It's not, you can't do it the same way that you can do a drive-through swab test as easily per se. And so that's one of the concerns that they have.
Anjali Kamlani with the very latest. Thank you so much. So one company that testing is going to be incredibly important for, because they want to get people back at movie theaters. They want to get people back at their theme parks. They need to get their employees back, is the Walt Disney Company, and Disney shares falling today ahead of their earnings. We've got MoffettNathanson out downgrading the company, say there is unrivaled earnings risk right now on COVID. So a big note here, Andy, sir, we're 21 pages detailing, nothing's looking good except for really Disney Plus and being able to watch some streaming properties that they have. But there are many concerns. Reading through the baskets of this note, do you think there's one area that is more concerning to you or to the street than others?
Yeah, I think parks, pretty obviously are the things that have to be the area of greatest concern, just because it's just, distancing just doesn't work in a park. I mean, the rides, the lines, the food, it just seems untenable. Now, we're reading this note, learning that there's one poor guy who tried to spend the night in a Disney park in Los Angeles. You saw that story, Jen. I'm not sure if that's connected to the story.
That was my dream. I saw that, not to joke, but as a kid, you always wanted to be like left behind and sleeping in the park.
And there was a kid's book about spending the night in the two kids who spent the night in the museum and for months in New York anyway. But I digress. Anyway, I think Disney, listen, I mean, the streaming business could be really good for them. This is going to be a great time for them I think it's a great time for them. I mean, everyone's in it, but they have such a strong portfolio. So I think that's good. ESPN, I'm not sure, how that recovers. And, that was, a lot of what's going on here, just to take a step back, is this coronavirus is exacerbating and accelerating already existing trends. So, ESPN, there were questions about it beforehand, and now all of a sudden there are no sports. I mean, holy smoke, right? That is not a good situation. For parks, there was nothing bad going on. So that's just a complete, black swan. The movie theaters is going to be bad, but I think they can make that up streaming. So, I mean, those are some thoughts from this note. And it's tough. And then you have the CEO situation where Bobby had to come back again. Jeez, right?
Andy, I searched Control F in here. There's not one mention. There's not one Iger or one Bob besides Bob's Burgers. Rick Newman, you also read this note. What stood out to you?
To me, these conclusions about Disney are the same kinds of conclusions we might be drawing about the overall economy in a few weeks or a few months. In other words, this could go on a lot longer than we thought, and it could end up being a lot worse than we thought. One of the worry points was as this recession drags on and more people are unemployed and starting to pinch pennies, are they going to start, are more people than expected going to start cord cutting? And could accelerate the accelerating problem at ESPN? And so I thought, this is the street kind of getting religion about Disney. And I think the street needs to get religion about a lot more names out there and about the overall outlook.
And Rick, to your point, I mean, about consumer confidence, it is not cheap to go to Disneyland. I mean, any parent can tell you the admissions. I mean, that is a big cost that a lot of these families take, obviously because of the experience. But I think it is worth considering when you look at this note about just how gradual they see the recovery process. It's not about a switch that just gets turned on come July 1st and everybody returns. These analysts are talking about a 75% capacity next year, and then not 90% until 2 years later. So I think that does point to not just the long road to recovery for Disney, but a lot of these companies who are going to have to take small steps forward, maybe a few steps back. That's going to be the reality of how these businesses operate over the next few years.
Yeah, and Akiko, one word we haven't even mentioned is pipeline. I mean, they've got to make the content too. So that is something that is 100% shut down. We had peak content in February, and we could be hitting trough content. They've got a huge catalog, but still, you need to make new stuff.
And one thing besides the catalog, Andy, as you point out, which is good for them, is the heavy reliance on animation, especially for properties like Pixar. And so they do have a leg up there with that, but it 100%. Is one of few bright spots for Disney right now. I, for one, am really interested, not just in the results tomorrow, but the division of labor on the call between executives, I think will be fascinating to get an eye on what's happening at Disney in terms of the management. Of course, Disney stock on that downgrade was off more than 2% today. Coming up, Tiger 21 chairman Michael Sonnenfeld joins us with his biggest takeaways from the Berkshire Hathaway shareholder meeting. Plus, we're going to get his take on the markets right now. We are back in 2 minutes. Welcome back to Yahoo Finance, where stocks actually ended higher after being down for most of the day. Energy names and some big tech names helping pull us back and just kind of claw ourselves out of the red here to get some small green arrows. Of course, this weekend was the live stream carried here on Yahoo Finance of the Berkshire Hathaway annual meeting. And usually when we are in Omaha, Nebraska, we sit down and talk to Michael Sonnenfeld, Tiger 21 chairman. He's there as well with some of his members. So, Michael, the headline that's really come out of the meeting is on the airline stocks. And I want to know if for you that really is the biggest takeaway, or if there's something else that we need to be paying attention to.
So I think Warren talked about the S&P, and there was a question about why had Berkshire not beat it in 5 or 10, and I think the question said 15 years. I think that was inaccurate. Berkshire has beaten it. So he has this huge growth of people who've been with him many years, who've had extraordinary returns, but not in the last 10 years. And he's basically said as they get larger and larger, it's going to be harder and harder to beat the S&P, and has even told his own estate not to stay in anything but the S&P. So I think you combine that and all the comments, all the positives that are really cloaking his basically bearish short-term view. I think those were the big takeaways.
Yeah, Michael, I mean, that just leads to my question, which was then why the heck should you own this stock, right? I mean, and that's sort of what that question was, but maybe you can answer it, or maybe you're going to say that you shouldn't.
Sure. So full disclosure, I own exactly 1 share of the stock. But the answer is that Tiger members have been debating between the S&P and Berkshire Hathaway. It is our largest non-index holding in the top 5 outside of technology. So we have wide distribution, and it's kind of like 2 racehorses. Berkshire achieves its results with a large amount of cash and an unusual structure. And in 10 years, that has not outperformed the S&P. But you can imagine certain scenarios where the S&P will outperform where Berkshire might. But basically, if you had to put $100 away for 30 years, you'd do well putting them either in Berkshire or the S&P, or splitting it between the two. I was looking before. If you just look over 15 years, there's been a 2% differential, which adds up to a 30% value difference for Berkshire over the S&P, but not in the last 10 years. It's basically been a push.
Wow.
Michael, a real range of questions that Buffett fielded. And there were a couple on the insurance portfolio, and I want to get a listen to him talking about Geico.
Sure.
At Geico, we're the 2nd largest auto insurance company, and different auto insurers are handling a sharing of the better experience with their policyholders in different ways. Our plan will deliver back $2.5 billion roughly or so in recognizing the reduced frequency of accidents during this period. What we don't know is how long this will continue. I mean, people want to drive their cars still, but conditions have reduced that driving dramatically, obviously. Now, we have instituted a program that runs saving people money for 6 months, and so far, other people have largely been 2 months, but some of them have given a little more for those 2 months than we give per month. Our total is the greatest at $2.5 billion.
So as with everything, it seems, in the time of coronavirus, there is good and then maybe not so good and bad. So people aren't driving as much and there's fewer accidents. But then Buffett also went on to say that as people lose their jobs and they might give up insurance, and there'll be more uninsured drivers on the road. He also talked about holding money back for litigation on different business stoppages as well. How do you think we should be thinking about insurance overall? Like, is part of why there's such a big cash pile because it's a question of what they're going to need?
So you're at the heart of the question that we debate in our groups. We have 60 groups around the world, and one of the big topics is, what does it mean that Buffett has this extraordinary insurance juggernaut? They're one of the great insurers in the world. And while you talk about COVID, the same issue is starting to come with electrification of vehicles, because with autonomous vehicles, you are going to have accidents going down, and they have been more nimble in repricing insurance to the risk. He talked about some of those risks in other areas where they've done great. And he talks about the structure of Berkshire as being with insurance and energy, and then all the rest of the companies, and how they work together in a unique structure. But it still adds up to the fact that in 10 years, they haven't been able to beat the S&P although they have different engines driving, if you will, down parallel tracks. So they have an extraordinary group of people. It's really amazing what they've done. And it's even more amazing. We were in a group with members who used to be traders, and they were saying when you come out of a marketplace like in 2008, on the upside, the stock pickers couldn't beat the averages. There's something about a broad recovery. We're not there yet. I think Buffett is saying we're going the other way, or at least we're stalled for a while. He can't put a number on when the airlines will get back. And he can't, he even says his own stock at a much lower value provides no more value today than it did 6 months ago, which means all the underlying prospects of the endless number of companies they have are down as well. So it's a pretty bearish outlook that he's giving you, even though the insurance is clearly the crown jewel in their portfolio.
Yeah, just to jump on that point, Michael, make no mistake about it. The insurance piece is at least one, if not the key differentiating advantages that Warren Buffett has. And it's a very complicated business. It generates a tremendous amount of cash. And if you put those two things together, which is essentially his brain and Ajit Jain's brain, together with the cash that it generates, there's really sort of no one else on the planet, no other entity that has those two advantages. But I wanted to ask you, Michael, about, where to from here. And of course, this whole idea that they're looking for a whale, it's been that way forever. They're always looking for a whale, but they really need a whale. And then this whole, I thought it was a fascinating point that Buffett made, that the Fed acted too quickly and too strongly for anything to sort of come well up for him to buy. What do you make of that whole notion?
Well, one of the members of Tiger who was in the small cap area sent out an alert right after that saying short the banks. It's not just Berkshire Hathaway. If the Fed is crowding out the best opportunities by what they're doing, it's going to be tough for the whole banking sector to compete. And on the other hand, Buffett went out of his way to congratulate the Fed on taking courageous moves. He really went out of his way on that. It was quite interesting how he did that. So there's no question that the market is as strong as it is precisely because of the actions that the Fed took. We're down, I forget today, but as of Friday, it was about 17% on the year or so. And in the last 20 years, the market has been down more than 40% 4 times, 2 of which have been more than 50%. So on a relative basis, we're only down about a third of these other 4 downturns. And yet when you look at it, the carnage of unemployment and business stoppages is much, much greater. There's such a disconnect that the only explanation for it is that the Fed has been flooding money into the system to try and keep it working. And even Buffett mentioned that if there had been a functioning FDIC during the Depression, it might have lessened the impact there as well, when in fact the market fell down 90%. And we're nowhere near that yet.
Hey, Michael, Rick Newman. Warren Buffett sounds less bullish on America than he has in recent memory. Do you feel that way? Are you bearish on America?
No, just the opposite. I happen to agree. And our members, by the way, in our most recent asset allocation, have a similar allocation in that over 50% of our assets are private equity and real estate, private real estate, and then another 25% in public real estate. So that's 75% of long-term risk-on assets. But it can be true that if you have the greatest faith in America's long-term potential, the near term can still be pretty upsetting and pretty scary. And I think all that's happening is that the nature of the black swan, the dual black swan between the coronavirus and what happened with oil, then precipitating the market decline, is really unprecedented. So it can be true that you can have a long-term view. And as Buffett said, if you bought the stock, it's one thing. If you buy it on margin and expect to have a return soon, it's another. Our members are seeing the asymmetry of the downside. We want to protect. We have large cash holdings. Most entrepreneurs learned how to weather through the storm. That's why they were successful. And he's doing the same. So he's basically saying cash is king. Don't make any assumptions about normal value. when you see values that are so dramatically low, that's when he's going to take it. But he's not looking for a 5 or 10% discount. I know I was on a member call last week with a real estate operator talking about industrial and retail and residential and the disasters there. But even there, he mentioned somebody who bought a mall. He was buying the mall for 10 cents on the dollar and he was able to reconfigure it for 20 cents. The owner lost 80 or 90%, but the buyer doubled his money. So you really need to have the expertise that a Buffett has at his scale or our members have at their scale.
Tiger 21 Chairman Michael Sonnenfeld, great to see you. Hopefully we'll see you in person next year when the annual meeting rolls around again. Take care.
Thanks so much. Bye-bye.
Up next, Rick Newman breaks down the big debate that's going on between reopening the economy and risking a second wave of infections. Lots more to come on Yahoo Finance right after this. Welcome back to Yahoo Finance. The S&P 500 erasing earlier losses, big tech and energy shares climbing higher here to start the week. So what we are seeing this week, and it looks to be continuing really for this month, is this patchwork of opening up across the country, different cities, different states, different industries dealing with this in their own way. Rick Newman has been looking at the debate that's really raging between opening the economy and risking a second wave of infections, and how exactly to look at this from an economic standpoint. Of course, Rick, we all know there's human tragedy in this, but as people try to evaluate it, they're trying to put numbers around it. What have you found? Hey, Rick, you're muted.
Senator?
My bad. I got caught. I was due. Yeah, and we're getting better tools for doing this, Jen. So today, the RAND, the research organization, published an online tool. Anybody can find it. I linked to it in my story. For every state, it allows you to apply one of 6 levels of restrictions on business closures and reopenings and people moving around, and then find out the results. So it tells you what the actual situation is in that state. And then you can say, well, what if you want to loosen the restrictions? What happens? How many more deaths, infections do you get? And how does it affect the economy? So I played around with some of the states, and I'll just tell you some of the really interesting things I found. So if New York relaxed its restrictions a little bit, we would probably go from 34,000 deaths from COVID-19 by June 6th to 39,000. So an increase of 5,000 deaths, but we would have a little more economic activity. We'd have a couple $2 billion of additional statewide income. If you look at Texas, Texas actually has a moderate level of restrictions in place, and that is going to lead to 13,000 more deaths than if they had severe restrictions in place like we have here in New York. So there's this really agonizing trade-off between life and death on one hand and economic activity on the other end. And there is no magic optimal point where you can say this is the amount of economic activity we should restrict. I mean, governors are just making this up as they go along. There's no playbook. And we're just at the beginning of this, which is kind of an experiment in states like Texas and Georgia that are being more relaxed with their restrictions. It's possible they're gonna see infections and deaths going up, and they're gonna have to change some of those policies.
Rick, I mean, nobody wants to put a price on life, but people are trying to do this math here, and it's some interesting work to look at.
I mean, by making policies that, especially if you're relaxing restrictions, you are in effect putting a price on life. And I just did the numbers. I mean, no one is saying this is the value of a human life, but the amount of economic activity you're gaining in exchange for the lives you're losing place the value of a COVID-19 life or death at somewhere between about $200,000 and $700,000. So that's saying we're willing to lose a life in order to have, let's say, $500,000 of increased economic activity. I mean, obviously an uncomfortable topic. Governors are not framing it this way, but this is the reality.
And you can go and it's interesting to go look at the RAND study online. Anybody can go check it out. It's on RAND.
Out in your state, for sure.
Yeah, good read out there. So we've been talking all day about Warren Buffett said at the shareholders meeting, but what about what he didn't say? Andy Serwer is going to break down all the unanswered questions next because he was there. We're back in 2 minutes. Welcome back to Yahoo Finance. Stocks ending higher on the day, and it is still earnings season out there as well. We've got a busy week on tap with Disney, the ride-hailing companies, as well as some coming out right now. Jared Blickery has been checking the charts and the tape for us after the bell here. Jared.
Yeah, we're looking at some earnings that just came out, and specifically Shake Shack. Not a lot of price action here. It is up 1% in after-hours trading, but just some headlines. So it was a wider than expected loss per share on an adjusted basis. It was 2 cents versus expectations of 1 cent. A little light on revenue too, coming in at 143 million. The estimate was for about 145. Not surprisingly, they have withdrawn their guidance for the full year, and they're saying that domestic shacks had sales increases in the past couple of weeks. So that is one positive that we're seeing there. And then American International Group too, reporting earnings, and just pulling up some of those headlines, which are not coming up for me right now, but I will have them in a second. There we go. Net income attributable to AIG stockholders is 1.7 billion, or 1.98, $1.98 based on a diluted basis per share for the first quarter of 2020. And this really doesn't compare that much at all to the previous year of 654 million, or 75 cents per diluted common share. AIG, if we can check out that stock here, that is down about 1% in after hours. And another one is XPO Logistics, kind of a bellwether for the shipping industry. Got a couple headlines there. Their transportation unit revenue was 2.46 billion versus 2.6 billion year over year. And they're saying that it was a pretty ho-hum quarter for them until mid-March, when, not surprisingly, things kind of fell off, and they have pulled their full year guidance as well.
All right, Jared Flickery, thanks for breaking it all down for us. So, of course, this weekend was the annual meeting for Berkshire Hathaway. We've been talking about it all day on Yahoo Finance because we had the exclusive live stream. And it's big news when Warren Buffett talks. Andy Serwer was one of very few people actually in Omaha for this event. And Andy, we've played a bunch of Buffett sound. We've talked about the airlines. We've talked about the fact that he didn't really buy anything. He was a net seller. But having been there, are there parts of this story that we haven't concentrated on? Or did Buffett, did you walk out and say, oh yeah, somebody forgot to ask him about that question? You know, was there any sense to you of something that was missing or that we haven't focused on?
Well, I just think the atmospherics, Jen, is something that I can talk about a little bit. I mean, I think the usual questions were there. And I think one thing that was different is that people were able to ask questions real time. I mean, Becky Quick was taking questions. You pointed this out in a way that has never been done before. So people were actually able to respond. And he had that 90-minute plus soliloquy that we've been discussing, the treatise on American history. So people were able to weigh in on that. But, you know, it was just bizarre to be in a place where there's usually 40,000 people and there were 11 people or 12 people, like, you know, depending on how you counted it. And that the whole town, the whole city is just filled with tens of thousands of people milling about, and none of that energy was there. And I think that, you know, Buffett really you could just see that he missed that. And, you know, you have to ask yourself, well, there's not so many of these left. Where Buffett and Charlie Munger are going to be there holding court. And, you know, Charlie Munger's 96 years old, Jen, and Buffett is 89. And so, you know, every one of these things really counts. And at the end, Buffett, you know, was saying, you know, well, we'll see you again next year. He was telling the cameras. And, you know, you could really tell that this was something that, you know, was weighing on him heavily. He did this only because he had to. And of course, he understood that why he had to, but it was just a strange scene.
Hey, Andy, as you know, I'm covering the presidential campaign. Joe Biden is 77, and it's kind of widely accepted that Joe Biden has lost a step compared with, you know, the senator he was 20, 30 years ago. He is 12 years younger than Warren Buffett. Would you say Warren Buffett has lost a step, or no way? I
mean, Warren Buffett's lost a step physically, right? I mean, you know, a 65-year-old Warren Buffett could beat up an 89-year-old Warren Buffett. There's no question about that. Mentally, as far as the acuity goes, you know, that's kind of a little thing that people on Wall Street whisper. I've talked to, you know, some of the top CEOs on Wall Street who kind of say, I don't think he's quite, you know, the same as he used to be. If he's not the same, it's pretty darn close, which is to say, more than 99.9998% of, you know, anyone who's alive in the United States. So that's pretty darn good. And, you know, here's a guy who's, you know, talking for 270 minutes straight in front of 1 million+ people without really skipping a beat. I mean, his voice wasn't quite what it used to be. His hair is shaggy. He acknowledged he hadn't gotten a haircut in 7 weeks. I actually thought it looked pretty good. Listen, I don't really think that he is behind the ball. Now, I've asked him this paradoxical question. We've talked about this, Rick, I think. He says, no, when I don't have all my marbles, I'm going to hand it off. And then I asked the question, well, the definition of not having your marbles is not knowing when that point is. So it's one of those sort of Rubik's Cubes question. He assures me he'll be able to see it. Well, we don't know.
And I think it is worth pointing out, because we did ask Ron Olson, who's a director at Berkshire Hathaway, is there anything to read into the fact that Greg Abel was up there instead of Charlie Munger? And he said, absolutely nothing. Charlie's doing great. We heard Buffett say a couple times that Charlie's on Zoom. He's loving Zoom and doing fine, and that we really should not read much into that.
Well, I will tell you about Charlie Munger. Now, first of all, physically, he's in worse shape than Warren Buffett. And then again, he's 96. However, if you had to put a gun to my head and say which one of them has slipped a little bit more, Charlie or Warren, I'd say Warren more than Charlie. I mean, Charlie is just scary, and he's an intimidating person. And he's just right there with it. He can just stab you with a steely knife. And you're like, wow. I mean, it's pretty amazing. I mean, I haven't seen him this year, so I don't know. But I mean, up till now. And then the Greg Abel point, Greg just happened to be closer. I mean, sticking Charlie on a plane does not make any sense. Yeah. I don't care whose private plane it was. And Ajit is also on the East Coast. He lives in New York. So Greg is nearby. And Greg, that was so funny when Greg said, I don't have anything really to add. And Warren looked at him and said, what are you, another Charlie here? It was pretty funny. But, and Greg is I don't know how old Greg is, but he's a relative youngster. And Ron also talks about how the board's pretty old. So, listen, comes with experience, right?
Sure does. And what an experience it was for all of us to get to watch that on Saturday. Coming up next, primary care going virtual, how one company is jumping on the stay-at-home trade with virtual medicine. That's next. So we have seen the stay-at-home trade really propel a number of trends during this time of coronavirus, and telemedicine is one of those. I want to bring in Adrian Ayoun. Forward is a telemedicine play here. Can you tell us about this company? What separates you from the rest of the pack that you guys are doing differently?
Sure. So Forward's a national primary care practice. We basically have locations in most major cities throughout the United States. And our whole model is we start by hiring the best kind of doctors you can find from Harvard, from Yale, from Stanford, all kind of the best doctors out there. And then we combine them with our own advanced medical technologies. The idea is that they can use those to identify biological signals sooner, helping you to prevent disease and illness. So let's kind of take a look maybe at how this has played out in kind of the COVID world. So a couple months ago, we launched our COVID assessment product. So this is even before the CDC had guidelines on how to assess risk, all of our members had access to an automated tool that they could answer some questions about things like their symptoms, their travel history, et cetera, and get personalized medical advice on COVID. Things like, should they isolate? Should they get tested? Should they leave the city they're in or stop a medication they're on? Now, within days of launching that, we then obviously had kind of nationwide testing at all of our locations, including kind of drive-through, walk-through, et cetera. Fast forward to a point where today we've actually cared for even more COVID patients than the majority of large healthcare systems like the Stanfords and UCSFs. Now, what you're asking about is a little more like, where are we going? And so one of the things that we had to do to start caring for all these COVID members. So let's just say you're worried about having COVID. Right now, your choice has been to stay at home or go into a hospital. And the reality is that's a really scary choice, right? Going into a hospital puts you at a lot of risk. And so what we said is, rather than having people just kind of stay home and avoid care, which in places like New York, you see almost 100 people dying per day, we said, why don't we go into the home and kind of deliver the care where they are? So we started delivering sensors into people's homes. We now do things like in-home blood draws, in-home urine analysis, which is basically we send trained professionals into your home in kind of full PPE, so we can kind of meet you where you are. Now, this isn't just live for our COVID patients. This is now live for all Forward members. It's something we call Forward at Home. And basically, coming back to that notion that we want to use our technology to truly understand you, we start with what's called a baseline. So rather than normal healthcare systems that kind of just wait for something to go wrong and be reactive, we're preventative. And the way we do that is we start by collecting a bunch of information. So
and that's like when I first join and everything.
Exactly. When you first join, we give you those sensors. We do that kind of blood test. We even give you a genetics kit so we can sequence your DNA. Then you can pull out your phone and you can build out your full profile. Things like, where have you traveled to? Things like, which surgeries have you had? Which medications are you on? Who in your family has had what diseases? What are your allergies? Yeah. And then what happens is we kind of think of all these as kind of clues or signals that empower your doctor to have the best insights about your care. So then what happens is it all culminates with you having a video conference with your doctor. But we use the Forward Smart Screen technology that we've pulled from our clinics. It's basically, as you're chatting, imagine a model of your body, an interactive model with all the information overlaid on top. And then you and your doctor can. Sorry.
I said it sounds expensive. You've got a lot going on there, you know. We have to jump, but I'm definitely interested. But how expensive is this for people?
Yeah, so it's $149 a month with no co-pays, no upsells, nothing else.
$149 a month, and you get all that done. Interesting. And what cities are you operational in?
So we're live in San Francisco, Orange County, LA, New York, DC, Chicago, San Jose, Seattle. Been in a bunch of different cities now.
All right, Adrian Ayoun is with Forward, a new model for primary care where it looks like you don't even have to leave your house, which is kind of convenient right now since we're all stuck there. Adrian, great to have you on the program. We have much more coming up in just 2 minutes.
Thanks so much.
Welcome back to Yahoo Finance. It's going to be a busy week. We've got earnings and a story you're going to want to watch tomorrow. Victoria's Secret sale has fallen apart. L Brands and Sycamore have terminated the deal, and we are seeing L Brand shares off here more than 15% after hours. You're going to want to watch that stock tomorrow. We will be there to cover it all. For now, that's going to do it for us at Yahoo Finance.